Very inspiring first day, and I'm pretty sure that the second day will be as just engaging, inspiring, and full of stimulating discussions. So today, the program will run in a fully fledged hybrid format with speakers joining us both in person and online, and several organizational issues to be announced. First, during some parts of our event, we will have a simultaneous translation, so the headphones are located at the end of the hall. And second, in case of air raid alarm, we will need to take a pause to go to the shelter, and after that, we will resume to the conference from the shelter. So the shelter is located at the National Bank of Ukraine. Dear colleagues, before we begin, I kindly invite you to honor the memory of all those who lost their lives because of the brutal Russian war against Ukraine. Thank you very much. Now, we have a very engaging and packed agenda, so without any further delay, I'm honored to introduce a special address of the Governor of Bank of England, Andrew Bailey, and to introduce our distinguished speaker and to welcome all of you here in this building. I invite first to this stage the Governor of the National Bank of Ukraine, Andriy Pyshny.
Good morning. Today, for the National Bank of Ukraine is a special day. I have a pleasure to introduce our keynote speaker of the second day of our 9th conference. Or let me wait while headphones are distributed. Today, we have the honor to have the Governor of the Bank of England, Andrew Bailey. On the way here, yesterday reading in the news and seeing the messages that, according to the Monetary Policy Committee, the Bank of England announced some decisions, I could not understand how Andrew managed to be in different places at the same time. Today, he told me, in order to get to our conference and to make the keynote speech here, they changed the procedure of communication. For the Bank of England, for the bank based on tradition, such flexibility is unprecedented. And I do value this because, as I said yesterday, Ukrainians learned to distinguish very well when formal protocol and when there is a human empathy, profound and sincere. And we really appreciate when people breathe the same air with us and stay under the same sky. And today we have the honor in our operating hall, under our glass roof and under protection of St. Michael, to welcome our guests and conduct the second day of our conference. I will not take long. Please welcome our keynote speaker, the Governor of the Bank of England, Andrew Bailey.
Well, thank you, Governor. It's a huge pleasure to be here. Before I start, it was so appropriate that we just stood and honored those who have lost their lives for the freedom of Ukraine. And of course, it's not just the freedom of Ukraine, it's the freedom, really, of all of us. But I particularly also want to express my condolences for those who lost their lives earlier this week in the totally appalling and unjustified attacks that Russia continues to carry out, and that those of you in Kyiv suffered earlier this week. It is barbaric and it is unjustified. Governor, as you just said, when you invited me to speak today, I was in no doubt that I was going to be here in person. Fortunately, we are able to arrange our monetary policy schedule to allow me to do that. And the reason that I wanted to be here in person partly was to make my first visit to Kyiv, but also because the UK and Ukraine share unbreakable bonds. And these have been recognized in the 100-year partnership signed in January. And that partnership cements our long-term friendship and lays the foundations for even greater collaboration in areas like science and technology, defense, energy, to go alongside the existing cooperation we have as central banks, something I'm going to come back to talking about in a moment. And as our Prime Minister said when he signed the partnership, we're closer than ever, and that's important. But beyond that, I'm quite simply in awe of what Ukraine confronts as a nation. And I want to emphasize that word nation. It's really important that Ukraine is a nation. And what you face as a central bank and how you have conducted yourselves through these most difficult times. Now, it's accepted best practice and good practice for all of us these days that we should all prepare for extreme events and develop contingency plans to respond to a range of possible outcomes. We spend a lot of time doing that at the Bank of England. But our contingency events don't begin to compare with what you have to deal with on a daily basis. The governor was explaining to me how when you had the attack on this building at the beginning of the year, you didn't miss a beat in terms of what you did. And this is important because the governor and I talk quite often, and we meet quite often, and we at the Bank of England have learned in our contingency planning from what you do when it comes to serious disruptions to payment systems and to everyday banking business. Because you do it for real. Now, although I've been determined to be here today, I can't claim, and I say this with all humility, to appreciate properly your experiences. And we must give you all the help we can. And by doing so, we must give a very clear message that our support is unconditional. I've just gone past 40 years since I joined the Bank of England. I haven't quite worked there all the time, but I joined in 1985. Before that, I was an economic historian. History does matter. You know this painfully well in Ukraine. I don't subscribe to any simplistic view that history repeats itself. But I do believe that there are a lot of strands running through history, and that long history has shaped your nation. And again, this word nation is critical because we share your belief in Ukraine's right to determine its own future. The answer to does Ukraine shape its own future as a nation must be yes. And of course, that's also critical to a central bank. Why is that? Well, modern central banking is built on the independence of the institution. This is critical for all of us to our ability to fulfill our objectives. But I always say that we must be clear what this independence means and what it doesn't mean. We're independent from governments under terms set out in legislation. But we're not independent of our people. We serve our people. Our independence is granted by their representatives in our parliaments. And our independence extends as far, but not further, than the objectives that our parliaments give us. We are, in that sense, as central banks, an emanation of the nation states, and through that, the people we serve. And we're responsible and accountable for our objectives. Our legitimacy and authority depends on our accountability. This is actually the essence of modern central banking. Now, there are typically two objectives of modern central banking for all of us: monetary and financial stability. And I'm going to spend most of the rest of my time setting out how I think we need to think of them together. But before I do that, I want to make another important point about our frameworks, which relates to their ability to manage shocks. These are the real tests of our policy frameworks in respect of both monetary policy and financial stability. It's one thing to develop these frameworks in relatively calmer times, but to persist, they must be able to stand up and deliver in the face of big adverse shocks. This has not always been the case in the past. I'll give you one example in the area of monetary policy. The classical gold standard emerged to prominence during the 19th century. It had existed before then, but without the same prominence. Now, the 19th century in Europe was not without economic shocks, but the gold standard of the day provided a system in which those shocks could be handled. Not always with ease, but it survived those tests. But it couldn't survive the much larger shocks of the period between the two world wars. Now, in modern times, we've combined floating exchange rates and free cross-border capital movements with independent monetary policy oriented towards the domestic objective of price stability. And central to achieving that objective are two things: the independence of the central bank and a so-called nominal anchor, usually an inflation target, which seeks to stabilize the real value of money. And we regard this, very correctly, as the best way to support activity in our economies. And I want to borrow some words from your web pages. We care about the welfare of Ukraine and Ukrainians by ensuring price and financial stability as a guarantee of sustainable economic growth. And the real test of these regimes in modern times is how well they've stood up to recent shocks. Do they provide us with a suitable and helpful combination of the rigor of a nominal anchor, inflation target, with some appropriate flexibility in how we respond to shocks without compromising that anchor? Now, we've had a lot of shocks in recent times. You've had, however, much more difficult shocks. But I think the answer to that question is an encouraging yes. Sadly, we can't prevent these shocks from happening. That's something central banks can't do because the causes of them are well outside our control. But we can prevent the inflationary consequences of them becoming embedded in our economies, and do so without causing consequences which undermine the legitimacy of our framework. And that is about avoiding the problem of the classical gold standard in the interwar period. Now, and central bankers are always cautious people, with the important qualification that the job is not done and is never done, I think we can argue that a focus on domestic price stability, a nominal anchor, and central bank independence has proved its worth. Now, the task is both to respond to the shock itself when it hits and to the consequences of the shock. And those can be different. And this is where appropriate flexibility and strong transparency and accountability are critical. Your experience has been extreme in so many respects. In the face of full-scale war, you have had to adapt a combination of interest rate and exchange rate policy instruments, foreign currency restrictions and other tools as necessary. But you've been very clear in public that after the security risks abate and appropriate macroeconomic conditions are established in place, you will return to conventional inflation targeting. That message seems to me to be very clear. And here the comparison with the gold standard is relevant, because it is a very clear commitment to get back to the established regime. And it is being done in a way that is not only critical, but it also, to my reading, is credible. So I do think that we can now start to assess whether the modern orthodoxy of domestic price stability with a nominal anchor in the form of an inflation target is robust in the sense that it can handle severe economic shocks. Because that's the critical test of it. And I do think that we can be positive here, always accepting that the job is never finished. So let me move on to my second theme. What are we learning about how our two objectives, monetary and financial stability, fit together? One of the most pleasurable parts of my job is traveling around the UK on a regular basis, visiting businesses and hearing about their experiences and what we can learn from them when we make policy. And when I do this, I try also to visit schools and speak to students and answer their questions. I usually say a few words at the start to summarize and describe what we at the Bank of England do. And usually my opening line is that as a central bank, we are in the money business. Now, this sometimes gets a smile from the students, but monetary policy, as I've described, is about the real value of money, about price stability and about low and stable inflation. It's about confidence in the future of money, the value of money in real terms. Financial stability is about ensuring the future nominal value of money. It's about confidence that the unit of money in one bank account is the same as the one in another bank account at another bank. And likewise, that they will be equal to and freely exchangeable with a unit of central bank money, say a banknote. I call this the singleness of money. And it is to ensure this singleness that we pursue financial stability, and that in doing so we regulate banks. And it's why, in my view, these activities have to be in the responsibility of the central bank. Because unless we pursue and achieve both our monetary and financial stability objectives, we're not fulfilling our role of ensuring the stability of the money system. And that's what it means to be in the money business. It also follows, in my view, that there is not a hierarchy of our two objectives. One is not more important than the other, because neither of them can be achieved satisfactorily without the other also being achieved. Now, I sometimes can understand why it seems odd that we have to keep on making this point, but to this day I sometimes hear it argued that there is or ought to be a hierarchy. Now, two other important points I want to make here. The first is that it's by no means, of course, all of the financial system that is made up of the money system. Moreover, the share of the non-money system in the total has grown of late. The second point that I'll also come on to is that there can be, of course, evolution in the precise form that money takes. So let me consider those 2 points in turn. I think that to understand the boundaries of money and the money system, it helps to define it. So I'll do it in two very traditional ways. The first is the uses of money, and there are three of them. Money as a unit of account, money as a store of value, money as a means of exchange. The second definition is about forms of money. As central bankers, we tend to think of two forms of money. Money in the accounts of commercial banks, bank deposits, and money in the accounts of central banks, banknotes, and reserve accounts held by banks at central banks. Central bank money is often referred to as fiat money in the sense that it has the full backing of the state. Going back to what I said near the start, this is another reflection of the subtlety of the meaning of central bank independence. And of course, it is to the sum of commercial and central bank money that this notion of singleness of money applies. And it's to that sum that the notion of preserving and ensuring nominal value also therefore applies. But when we look at the total world financial system at the moment, by most accounts, over half of it is not money, in the sense that it's held outside the banking system. We've adopted the term non-bank financial institutions to describe that part, or NBFIs for short. We love acronyms. I tend to think of NBFIs as the world of investment. Now, it's not a perfect distinction, but the key difference is that when you invest in a non-bank, you do so on the basis that the nominal value of your investment is not assured. And that's important because to grow our economies requires risk-taking for our investment, quite a bit of which would not be compatible with the assurance of the constancy of the nominal value of money. Risk has to be taken. Now, a key lesson for me of the global financial crisis was that banks needed to maintain higher standards of capital and liquidity in order to provide that assurance of nominal value. And it follows from that, and that change to the standards of protection of money in banks, that the non-bank world expanded, as some investment-backed assets moved out of the banking system into the non-banking system. But I want to highlight that there are at least 3 areas of potential difficulty in this arrangement on which we are and must stay very focused. The first concerns ambiguity. We have to be on the alert for the development of financial structures which are vague as to whether they are or are not inside the money system. If we go back a little bit, in the run-up to the financial crisis, banks created so-called off-balance sheet vehicles which were assumed to be outside the money system. But then when the problems of the crisis hit, the banks found that investors in these vehicles assumed that they actually were inside the bank, because of course it suited them to make that assumption. Moreover, the bank's own reputation came to depend on that being the case, and problems ensued from that. The second area of difficulty concerns risks which can originate outside the banking system but then spread into it. Banks and non-banks are often closely interconnected, for instance in financial markets. And as the non-bank system grows, so do those connections. And this is why we are spending so much more time now assessing the risks that can arise from non-banks. It's one thing to distinguish banks and non-banks in functional terms, but that does not mean that they are insulated from each other. Far from it. The third area of difficulty concerns a challenge that does arise nowadays, namely, have we overprotected the banking system via excessive regulation, and in so doing pushed more risk into non-banks, which could be safely housed in the banks? Put another way, have we increased overall financial stability risk by raising the bar too high in the banks? It's a fair enough question to ask, and it's an intrinsically hard question to answer. I think the best way to approach the question remains to ask what it takes to preserve the singleness of money. Because, as I mentioned earlier, this is the heart of our concern with financial stability. And the answer is that we have rightly raised regulatory standards for banks in the light of a financial crisis, the effects of which continue to be felt even 15 years later. I'm going to end with a few thoughts on the other issue I raised earlier, that is evolution in the forms of money and what this implies. When you mention this point, it's often followed either by the word crypto or by the term digital money. Now, I have to be clear, I'm not going to do justice to what is a very big issue, but I think there are a few salient points here. First of all, a few words on crypto. I see crypto as taking two forms: unbacked assets of the Bitcoin sort and backed assets of the stablecoin sort. I think it helps to see these two as distinct. Why is that? Well, the Bitcoin sort does not have the characteristics of money. Critically, it does not purport to maintain nominal value, and therefore it fails the test of the singleness of money. Instead, it's an investment asset with no real asset backing and volatile in price. It's a risky asset class which should be seen as such. The buyer should beware. So-called caveat emptor applies. Stablecoins are different because they purport to have the characteristics of money and to be usable as such. And there's nothing wrong with this. But to pass that test, they must provide that assurance of nominal value and therefore pass the test of singleness of money. Now, it's perfectly possible to achieve that pass mark, though I would observe that many of the current versions of stablecoins do not quite achieve that test, or not yet at least. So in my view, we must now focus our attention on standards for stablecoins which ensure that they do pass that test. My second thought in the area of the evolution of forms of money concerns so-called digital currency. What do we mean by this term? After all, money in the form of central bank reserves has been digital in form for many years. I think what we mean here is how do we get the benefits of new digital technologies in the area of payments, where money is a medium of exchange? For instance, how do we get the benefits of smart contracts in payments, and the benefits of using digital technology to fight fraud? Now, I start with the optimistic presumption that there should be a benefit here. It seems to me a failure of imagination if we think otherwise. Having said that, I remain to be convinced that we need to create new forms of money, such as central bank retail digital currency, to achieve it. Let me emphasize that the word retail is important here. We're well on the way to having wholesale central bank digital money, but that's really just a natural step up from the wholesale electronic money that we've had for, in our case, 30 years. And this brings me to my third and final thought in this area. Most payments these days are made in commercial bank money. That's natural. It's the form that all our bank accounts take. And we want to make payments straight from our accounts. Logically then, if there are real benefits to digital technology in payments, we should want to see them in commercial bank money. The buzzword I sometimes hear is tokenized deposits, which is a bit of a mouthful, but really it's the application of digital technology to the form of money that we have today. The challenge is to apply this to both domestic and cross-border currency payments. So to be clear, I'm not against stablecoins, but they do have to meet the test of singleness of money. I'm not against central bank retail digital currency, but I question why it's needed if innovation proceeds as I think it should. But you may detect from what I said that I do think that commercial banks need to step up to the challenge of digital money provision. So let me conclude. We're living in a world of much larger economic shocks, which have their origins outside economic causes. Sadly, what the rest of us are experiencing is quite minor compared to the tragedy caused by the illegal invasion of your country. Our independence as central banks is grounded in the nation state and the people we serve. This makes it of critical importance that you can exercise your right to determine your future as a nation. I've set out what I regard as important issues for central banks and their twin objectives of monetary and financial stability. And I wish you, at the National Bank of Ukraine, every success in addressing these issues as a free, strong, and independent Ukraine. I look forward to a future of strong friendship and collaboration between the National Bank of Ukraine and the Bank of England, as well as between Ukraine and the UK. Never have our countries been closer, and we must remain that way. Thank you.
Thank you very much, Governor Bailey, for this powerful speech. Your reflections about the role of central banking and independence and international cooperation are very, especially meaningful for us today. So now we have some time for questions from the audience. So if you have questions, please raise your hand. And if you are joining us online, please use Q&A feature or type in your question in the chat. So I promise we will take as much questions as time allows. So I will take a privilege probably to take the first question, if you mind. Governor Bailey, you spoke a lot about the importance of sound policy making and analytical frameworks. And the Bank of England indeed is an example of an institution with well-established and time-tested institutional setup. But today, as you said, we operate in a very volatile environment with large and frequent shocks and with geopolitical, geoeconomic fragmentation. And this calls us to be more flexible and adaptive. So you mentioned that as well in your speech. And yesterday, during our policy sessions, the speakers, our esteemed speakers, they mentioned and emphasized that actually economic and financial integration could be an answer to that, right? But at the same time, integration means probably can mean for many countries that they can lose their independent framework, independent policy. So my question is, how central banks should strike this right balance between integration and between maintaining their independent and flexible policies? What would you recommend to central banks to navigate these challenges?
Yeah, it's a great question. It's really central, I think, to the issues we face today. So to start with, as you were saying yesterday and I've said this morning, there is I think, huge amount of common ground between us in terms of our frameworks, what we believe to be the right, in fact, foundation. And I think it's helped that we spend so much time, talking to one another, understanding the challenges that we're each facing. And of course, some of those challenges are common and some of them are unique to each of us as countries. And I think the test of this, as I said, first of all, I think the good news is that these frameworks are passing the test that they would eventually always face, sadly, of, in a sense, dealing with very big shocks. But I think the question for all of us is how, and you put it very well, how we balance the absolute maintenance of the framework with sufficient flexibility to deal with the shocks. And what is the meaning of the word sufficient? And I think I'll illustrate it in one way. Early on in the when we had the very big and very difficult inflation experience a few years ago, quite a few people said to me, the real answer is to raise the inflation target. We have a 2% target ourselves. And I said, no, that is, to my mind, not the right answer. There is no good reason for doing that. Moreover, I would predict that if we raised the target, and the next time we get these shocks, somebody else would come along and say, you know what? The right answer is to raise the inflation target. And of course, that's the road to losing the anchor. On the other hand, as we've thought a lot about at the Bank of England, and particularly when you get these very big supply shocks, which are the ones that we've had in recent years, and particularly when you get a whole series of supply shocks that come immediately on top of each other with no gap between them. Because the classical monetary policy approach is to say that we can accommodate supply shocks if their duration is less than the transmission of monetary policy, and we can be confident that they will go away, and we can maintain people's inflation expectations anchored by their knowledge that we're committed to the target. But that becomes very difficult when you get this whole series of supply shocks, which just extends the whole duration of it. So the question we've had to face in terms of flexibility is how much flexibility in terms of, in the face of those sorts of shocks, you can give yourself in terms of the time that you take to return inflation to target. So that's distinct from changing the target. That's saying, I understand that when I get bigger shocks, and particularly big supply side shocks, it will take me some time to return inflation to target. And and I have to balance how much time I can take versus the, if you like, the consequences of that time above target. So we have got in our remit language about how we can exercise that flexibility, and I think that's appropriate. And I think it's sort of the appropriate way to think about your question, but we have to do it very carefully because we're always having to have regard to the integrity of the nominal anchor, the inflation target.
Thank you very much.
Somebody.
Thank you, Gleb Wishlinsky, Center for Economic Strategy, Economic Policy think tank here in Kyiv. I fully agree with your opinion on the need to maintain inflation target. However, I want to get deeper answers from you on how really to stick to this target in the times of these supply shocks, in this stormy world, as you mentioned. In fact, United Kingdom and Ukrainian central banking were not as different in the last 3 years. You had energy shocks, and the Bank of England was criticized to some extent on the reaction. Ukraine had supply shocks related to the war, then high dependence on agricultural prices that also resulted in significant challenges for the Ukrainian National Bank. What are potential ways to react to such types of longer-term shocks within inflationary targeting regime? Thank you.
Well, it's a great question, and you're right that I think, and you've obviously had it even more than we have. These are real tests of the frameworks, and particularly these supply shocks. I think the first thing that we have to do is to be very clear in our communication in explaining what we think is going on. You can never underestimate the need for clarity, it seems to me, but also the challenge of that clarity. I had some interesting experiences during this period. I think, to be honest with you, the ones that struck me the most was when I thought, in one of our monetary policy press conferences, I thought I'd made a pretty obvious point, and this is obviously relevant to Ukraine's situation, when I said, that Vladimir Putin has caused, a good deal of this inflation. If you trace it through energy prices, if you trace it through food prices. And I got a newspaper headline the next day saying, "Governor blames Putin." And the implication is that, I'm responsible. Now, I'm not trying to evade the responsibility for dealing with the consequences of it. But it really was the most powerful point at which I realized I thought I was making a perfectly obvious point, and it just wasn't, it wasn't getting through in that context. Interestingly, I think today when I read a lot of the analysis, I think there's a lot of obviously proper economics being done where now the data are available, you can go back and analyze those periods, and people say, yeah, I get it, I see what's going on. But it really forcefully reminded me at the time, how challenging those periods can be, and we can just never underestimate the amount of communication we have to do, both of what we can do and what we can't do. But even when we can't stop these shocks happening, how we're going to deal with them and come back to this point about how we get inflation back to target. So I think the lesson for me really is you just cannot underestimate the need for direct and straightforward communication. And you also can't underestimate the need to come back and keep looking at how you communicate as the world moves on, not only in what you say, but also the channels through which you say it as well. I'll give you an example of that to finish. I now, when we do our monetary policy briefings, I'm now taken quite often to doing a session, not only I do a session with journalists, I do TV interviews, and I also now do a session with social media influencers. Now, I have to say, my kids told me to do this. They're in their 20s now. Because they said, look, that's where we get our news. Now, I was shocked by this and said, what, you mean you don't read the Financial Times? You don't, now you're telling me. But they said, look, just look at how many people, actually that is the main challenge, the main channel, for getting information. So we have to we have to keep coming back and looking at how we do things.
Thank you, Governor Bailey. It is a great honor to have you here in Kyiv, in National Bank of Ukraine. Thank you very much for your visit. I am Viktor Kuzyuk, former National Bank of Ukraine Council member and professor at West Ukrainian National University. I have two questions to you. First one, as to my know, British Parliament had a hearing about CBDC, and the tone of that hearing was quite skeptical about the perspective of CBDC. What is your opinion? Does CBDC contain really great success, or CBDC just overestimated? And second question, what is your opinion about the role of legal origin in central bank independence? Do you think that common law countries really outperform civil law countries in terms of maintaining actual, rather formal central bank independence? Thank you. My second question is about the role of legal origins in maintaining actual, rather formal central bank independence.
All right, okay.
Well, start with central bank digital currency and the retail form of it. You're right. I mean, we did have quite a skeptical report a few years ago from our House of Lords, our upper chamber. I think, for me, the real question is a different one. It's how do we best get the benefit of digital and technology innovation in our payment systems? Because I'm pretty sure there is a benefit. I mean, two things I tend to give there as just as examples. I'm sure there are more. One is anti-fraud. The second one is that I think there's a big problem in Britain about particularly small firms and so-called late payment, where people people delay paying them for as long as possible. And I think smart contracts and digital technology, have real potential there to create better links between delivering goods and services and paying for them. So I think I said earlier, it would be a failure of imagination if we don't pursue this. The question I pose is, do we need to create a new form of central bank money to do that? It's not obvious to me that we do. I think most today, as I said earlier, most of our payments are done in commercial bank money from bank deposits accounts. By the way, we're fully committed to retaining cash in the UK, but I recognise it is not used as much as it was. So I hope and expect that our banks, with our assistance, will innovate to create digital money. But I am very clear to them that if they don't, for whatever reason, then we may well do it ourselves. But I don't see that as the first line of approach. I think it would be better if it was done in the banking system. I'm not sure it's obvious that increasing the proportion of payments done in central bank money versus commercial bank money is necessarily the way forward on that front. Having said that, we are fully examining the question. We will do it. Moreover, I'm very strongly in favor of us fully examining it because we need to understand what this technology can do, where the risks are, where the opportunities are. So that's generally. On the second question, sorry, on the this is what forms of independence, if you like. I mean, I think our independence is slightly different from, in one respect, from some other central banks, in the sense that right from when we started in 1997 in monetary policy independence, our government sets the inflation target and it renews it every year. It doesn't change it, and I would, frankly, would be worried if they did start changing it, at all, really much. So it's changed once actually in that period, and that was to change the measure of inflation, really, which was fair enough. Now, when we started off down that road, people said to us, I remember, well, that's not as good an independence because you're not setting the target. And our response to that, and the governor of the day, I remember, said, no, I'm actually very happy that the politicians set the target because then they're committed to it. They can't then turn around and say, that's nothing to do with us, the central bank thought that one up. They're fully committed to it, and I think that is important. Now, it does, of course, mean that we have to come back and say, the target has to represent price stability, because in our legislation, the legislation actually says that it is price stability that we must maintain. It then says the government will, every year, tell us as the central bank what we should take price stability to mean, and that is the inflation target. It actually doesn't say in the legislation there has to be an inflation target, but we've always accepted that it is an inflation target. There are other ways you could do it, but we're not doing that. And I think that's worked well, because I think it's meant that governments haven't been able to, in a sense, distance themselves from the central bank and say, I don't know what they're doing, that's not how we would do it. They have to accept that that is the definition of price stability, and they set it. So I'm a very strong supporter of that system.
Governor Bailey, thank you. Mike. Thank you very much. Although we don't have more time for questions, I want to take a moment to sincerely thank you again for your support and for being with us today here. Your presence and your words truly mean a lot to us. Thank you.
Thank you very much.
Now, before we continue with the next part of our program, we are honored to share a special video address from Marta Kos, European Commissioner for Enlargement.
Greetings to Kiev and to all of you taking part in this conference today. I wish I could be with you in person today, but I look forward to meeting Governor Pishny and colleagues from the National Bank very soon in July in Rome. This year's conference theme speaks of economic and financial integration in a stormy and fragmenting world. If there is one country that embodies resilience in such a world, it is Ukraine. Under unimaginable circumstances, your financial sector has stood the test. The banking system did not collapse. The payments infrastructure continued to function. Inflation, though high, was contained. Citizens, soldiers, displaced families all retained access to banking services when they needed it most. Congratulations. The leadership and work of the National Bank of Ukraine, your swift emergency measures and your bold and balanced policies were key in this success. And you could rely on Ukraine's international partners, including the IMF, the World Bank and the EU. Through emergency funding, debt relief and wartime financial instruments, they provided crucial breathing space in the most difficult moments. The results speak for themselves. Your comprehensive resilience assessment showed that most banks in Ukraine remain well capitalized and profitable. The sector has demonstrated a high margin on safety, even in wartime. At the European Commission, we greatly value our excellent cooperation with the National Bank of Ukraine. Together, we are advancing the reforms identified in the Ukraine plan, including preparations for the next resilience assessment of the banking sector in 2025. And together we are progressing at record speed in preparing accession negotiations. The screening of Chapter 9 on financial services was a milestone. I want to thank the National Bank for its excellent preparation. Now it is essential to maintain this pace. Further regulatory improvements in the banking sector are important as it brought societal engagement in the reform process. The Commission will continue to do its part. We will carry out the technical work to ensure that Council has all the information to decide on opening all negotiating clusters in 2025. At the same time, we are making sure that Ukrainians' gradual integration into the EU delivers real benefits already now. For example, by extending the single euro payment area to Ukraine. This will bring real benefits to citizens and businesses long before full accession. Looking ahead, we all know that reconstruction will require massive investments. The financial sector will be the bloodstream of Ukraine's post-war rebirth. It will channel capital, drive innovation, and anchor stability, and it will do so with the credibility it earned under fire. You can count on the European Union to stand by your side, now and during the reconstruction. Every time I travel to European capitals, I meet business leaders to tell them about the opportunities in Ukraine and how EU loan guarantees can help turn those opportunities into profitable investments. Let's continue to work together in speeding up Ukraine's accession journey and in laying the groundwork for the swiftest possible recovery and reconstruction. My team here in Brussels and colleagues in the EU delegation in Kiev are working full steam to get the best possible result out of the Ukraine Recovery Conference in Rome. I look forward to seeing many of you there.
It was a special address. It was a special address of Marta Kos, European Commissioner, and we are grateful for her leadership and for supporting Ukraine in our European aspirations. And now we are moving into two parallel sessions as outlined in our agenda. So the parallel session, policy session 1A, will take place here in this venue. However, I will kindly ask our online participants to reconnect using a separate Zoom link. If you have missed this link, please you can find the correct one on our webpage. The parallel session, research session 1B, will help place in a different venue, and for our in-person participants, please follow the signs to reach the correct location. Our colleagues will help you to do that. And virtual participants can join this research session and stay in this stream. The session will begin shortly and will be moderated by Paweł Kopec from Narodowy Bank Polski, who will open the discussion in just a few minutes. Thank you very much. So we have like 10-15 minutes break to reconnect and adjust everything, and then I will introduce Tony, and he will invite, but basically we can go to the stage. And by the way, I want to introduce you to Michne. Oh, you're right.
So he's with us, but we don't have a full coffee break now, yeah, because otherwise people are leaving. Maybe you should say that we really start soon. Because if everybody's out, then it takes ages to get them back.
I will announce that they should take their places like in 5 minutes. Yeah, so exactly. Now I guess Governor Bailey is still there, so they will see.
It's good that we have this break. They should have stayed.
Okay, dear participants, so now we are ready to begin the parallel session titled Financial Sector Reforms on the Path towards EU Accession, aligning with EU legislation and getting the reporting right. So, to chair the session and open the floor for discussion, I am pleased to invite Tony Deary from GBRW. Tony will join us online, so I will ask you to show him for others. Okay, so Tony, the floor is yours. You may start.
Okay, great. Thank you. Welcome and good morning, everyone. Thank you for joining us for this breakout session 1A, Financial Sector Reforms on the Path towards EU Accession. Aligning with EU legislation and getting the reporting right. Before I begin, a quick introduction from my side. My name is Tony Deary. I'll be the co-moderator for this session. And for this panel, we decided to structure things a little bit differently than yesterday, so this session may be a little bit more dynamic. Given that it is a hybrid virtual physical event, and we have quite a few audience members joining remotely, and two of our panelists plus myself are participating virtually. So we have planned 90 minutes for the session. I understand we have the room for 2 hours, so let's see how it goes. The panel will be organized into 4 blocks, essentially. So in the first block, we'll discuss aligning with the EU financial architecture. The second block, we will introduce the link to financial sector development, innovation, and inclusion. And the third block will be a chance for industry reflections, and that's a session that will be co-moderated by my colleague, Wolfgang Bücker. And then we'll open the floor for a sort of open Q&A. So some quick background on myself. I'm a director at a firm called GBRW Limited. We're a London-based banking and finance consultancy that specializes in financial sector development, regulatory policy and advisory, and capacity building. So it is truly an honor to moderate today's panel and share the floor with these distinguished panelists. I am moderating today in a personal capacity. I was invited to co-chair, given my previous experience with designing and implementing financial sector reform programs over the last nearly 10 years at GIZ. Before that, I had a career in the US Federal Reserve System, working on system integration initiatives and supporting the Federal Reserve Financial Services Policy Committee. In 2023-24, our team performed a study on Ukraine's financial sector on behalf of GIZ to identify potential reform areas needed for EU alignment and providing recommendations for technical assistance. So that's a bit background on myself. Our panel today addresses a critical dimension of the accession process. It is at the intersection of regulation, supervision, and institutional capabilities. It's not just a technical journey, it's a deeply strategic one. Getting the reporting and supervision right is not just a compliance exercise. It's about building the kind of trusted, transparent financial system that underpins the long-term integration, market stability, and public confidence that was discussed so much yesterday. The theme of our session is actually deceptively simple: alignment. But alignment, especially in the context of financial sector reform, goes far beyond legislative transposition. It's not just about ticking a box on a directive. It's about a functional shift in how banking and financial services is conducted and how supervision is carried out. It means having, amongst other things, reliable and timely data as a backbone of oversight. And it means building institutional systems that don't just exist on paper, but operate to the EU standards under real-world pressure. So for Ukraine, obviously, this is unfolding in extraordinary circumstances. And the momentum, as we heard from yesterday, is real. There is enormous ambition and capability in Ukraine, and there is clear support from European partners. Still, as we know from past experience, it is laws and frameworks will only take you so far. What ultimately matters is implementation, especially by financial institutions. And that will be one of the core themes of today's discussion. We'll hear about challenges around data governance, risk-based supervision, and reporting alignment, which aren't just barriers to overcome, but should be considered catalysts for better decisions, stronger institutions, and ultimately a smoother path towards EU integration. Before I introduce our panelists, I would like to invite Wolfgang Booker to share some opening remarks and reflections from GIZ's perspective. Wolfgang Booker is leading the financial sector development team for GIZ's reform program in Ukraine. With over 15 years of experience at GIZ, he formerly headed the Global Competence Center on Financial Systems Development. And since then, he has provided advice and direct support to the German government on G20 initiatives and implementing various financial sector development projects on financial stability, financial inclusion, and sustainable finance across Eastern Europe, Central Asia, and in Africa. So without further ado, Wolfgang, I will hand the floor to you for your opening remarks.
Yes, thank you very much, Tony. And yeah, it's a real honor to be here in Kiev at this conference. I've been to many conferences in my career, but yesterday the whole start was really, really special because so many speeches were really insightful and stimulating and also personally touching, to be honest. And it's an honor to be here. And I decided last night after this great concert we heard that I would like to make a very personal little introduction to our discussion today. And I arrived last Monday at 10 o'clock in the morning, so it was also in this regard feeling the aggression very closely this week was also a new experience for me. It was so great that I had time this week to meet so many trusted partners and also new colleagues here in the financial sector. I personally was working in Ukraine in the past in different projects, once working in 2006 with a bank where I was a consultant to this bank, and also in 2010 at that time with GIZ on some agricultural finance program with some banks and also credit unions. But it is my first time here in Kiev again during this horrible war. As Tony already mentioned, in 2025 we conducted this study on financial sector reforms. And I understood a lot. I got many facts and figures on the financial sector and the current situation. And I'm very thankful that this was done so well by GBRW. But in this week, I learned so much more in all these direct communications I had. And so I think the study is a good basis also for the future cooperation. And I understand now, after the communication with various associations this week, what challenges lie ahead of the financial sector with regards to new standards and so on. And it was also in this regard very interesting to hear yesterday the debate. So is there room for negotiation really, or is it a bit like take it or leave it to go on this path? So in general, I'm very, how should I call it, impressed that the energy and the ambition to go and follow this path on towards EU accession is so deeply in the DNA of so many players here in Kiev and in Ukraine. So I learned so much, and I listened really carefully to the colleagues from the NBU, several departments, Ministry of Economy, banking and insurance associations I met in the course of this week, and I'm glad that I have time also next week to meet some other friends and partners. Talk to several banks, business development fund, and also donors, and this is very crucial that we are fully aware that we are not alone on this path to support the NBU, support the associations, and also the financial sector. Why did I do all this? And why am I telling you all this? Because there's this new program, 3-year program, it's called Step into EU, financed by the German government. And it started last month. And we are currently in the phase of doing a proper operational planning. And in this regard, I really want to understand and fine-tune what can really create value added in our cooperation, technical support, also financial support here and there to really push this process towards financial sector reform forward. And I'm glad that next Monday we also have a chance to talk to Sergei Nikolaichuk and also Sergei Khudiash and their teams on the next steps also with the NBU. So there are many things to do. And also today, I understand this panel, and thanks, Tony, for your moderation, that we have a chance to do, as Stefan Ingves mentioned yesterday, do the plumber's work. So what really needs to be done now, where can we really make a contribution after the very, let's say, big picture discussions yesterday? I think it's now timely to also look a bit deeper into the next steps, and I'm glad that also Giancarlo is with us as an example to just also allow some deep dive into something very hands-on, which is future required reporting lines, for example, towards the EU. So back to you, Tony. Please introduce the panelists.
Thank you, Wolfgang. I'll introduce first the gentlemen on the stage. So the first one is a person who needs very little introduction, Deputy Governor Sergei Nikolaichuk. It's nice to see you again, sir. Sergei oversees monetary policy, statistics, and international relations. He has been instrumental in implementing the inflation targeting regime in Ukraine and strengthening the central bank's research and analytical functions. Important to this panel also is that Sergei serves as chairman of the working group on Ukraine's negotiating position for EU's accession on financial services. And that's a critical role in shaping Ukraine's path under the Chapter 9 of the EU Acquis. Accompanied by him is Mishne Konstantinescu. Mishne is Deputy Governor of the National Bank of Moldova with responsibility for economic analysis and policy. He brings a multidisciplinary perspective, blending expertise in macroeconomics, forecasting, and digital transformation. Michelet's background spans executive roles in central banking, as well as real estate and financial innovation. And he has a particular interest today in the data-driven policies and demographic change in Moldova. Joining me online is Sanja Turkovic. Sanja is Executive Director for Prudential Regulation and On-Site Supervision at Croatia National Bank. She is responsible for aligning Croatia's regulatory and supervisory framework with EU banking legislation. She's led work on the SREP, that's the Supervisory Review and Evaluation Process, internal model validation, and stress testing. Sanja is also an active contributor at the European Banking Authority, where she serves as an alternate member of the Board of Supervisors. And also accompanying us online is Giancarlo Pellizzari. Giancarlo serves as head of the Banking Supervision Data Division at the European Central Bank. He leads the development and governance of supervisory data infrastructure for the single supervisory mechanism, overseeing data quality analytics and reporting for over 5,000 banks. His team plays a vital role in supervisory decision-making and advancing the EU's long-term data strategy for banking supervision. So that is our panel today. I would like to start, Mr. Nikolajchuk, with you. As I mentioned, it's very nice to see you again, although I'm in a virtual setting this time. And congratulations on a very successful day yesterday. The thoughts shared by Governor Pichne and Madame Lagarde were really quite emotional and thought-provoking. The question I'd like to start with is related to the EU accession framework. So perhaps for the audience, under the EU accession framework, negotiations are structured around these 35 thematic chapters, each representing a core area of the EU's legal and institutional framework. That's the acquis communautaire. Chapter 9 specifically covers financial services, and that includes banking regulation and supervision, insurance, securities markets, and financial market infrastructure and payment systems. For Ukraine, Chapter 9 is technically demanding and strategically vital, right? It underpins not only the market access and investor confidence that we spoke of yesterday, but also financial stability and trust. According to recent statements by the NBU, Ukraine has achieved approximately a 70% convergence with the EU acquis in the financial sector. And I will echo that comment earlier from Marta Kos from the EC. The fact that Ukraine has already achieved 70% convergence is a major achievement, especially in the extraordinary challenges of the past years. Could you share with us, Sergey, about the experience so far, what that journey has looked like from the NBU's perspective, and what are some of the key enablers of progress that you see and challenges that you now face to close the remaining 30% gap, particularly in the context of wartime and financial stability? How do you balance those issues?
Thank you very much, Tony, for this introduction and for this question. I would like to start with highlighting that Euro integration track is high priority for the National Bank of Ukraine, and actually we, for many years we were involved in different Euro integration processes in different formats and so on. But then, back in 2015, our vision of the central bank was amended or introduced actually at that time. So it included very clear statement that the NBU wants to be the part of the family of European central banks. And I would say that that was the milestone when we started, I would say, the accelerated integration of different European standards. And of course, this process even more accelerated as in 2022, Ukraine received this candidate status and clear vision of of the task to fully align its financial regulation with the EU standards. Yes, it was correctly mentioned that we already did a great job, and frankly speaking, so the last estimate we received from the consultants of the PVH was more than 70% of our regulatory alignment in the banking sector. We recognize that most probably this alignment is much lower for non-banking financial sector institutions, and there is a lot of work to be done. Regarding the institutional way how to proceed and how we did that, actually, so I would say that many departments of the NBU are directly involved into this work. The coordination of this work is ensured by the International Cooperation Department, and in order to facilitate this process, last year we established the working group inside the NBU for the Euro integration initiatives. So, and I would say that the work of this working group was rather instrumental in facilitating the needed changes. And for the discussion of the ways how to proceed further on the priorities and so on. Also, if you talk about the institutional arrangements, I would like to highlight that at the state level, a negotiation team was established under the Deputy Prime Minister for European Integration and the Minister of Justice of Ukraine, so Olga Stefanishina, who yesterday also participated at one of the panels. And this team consists of senior officials from Ukraine's key public institutions, and I'm honored to represent the NBU within this team. And what was also important and actually very helpful, that was the introduction or launching of special working groups for each negotiation chapter. And these negotiation groups include the representative of ministries and government bodies involved in the process, but also the representatives of civil society, think tanks, and also associations. Actually, for example, if we talk about our working group on the Chapter 9 financial services, the representatives of both banking associations which are presented today, Independent Association of Banks of Ukraine and Association of Ukrainian Banks, so are presented in this group. And well, actually, it seems for me that the meetings of this working group were quite important in getting the feedback from the market participants, from the experts from civil society, how to shape our negotiation position. Maybe I would prefer more involvement and more negotiations within these groups and also with market participants, but well, we have to run in a quite fast pace. So we, again, as Olga Stefanishina mentioned yesterday, so we want to open the negotiation on clusters 1, 2, and 6 by the end of June, and technically we, again, so we did our job for that, but we hope that the political decision will be in line with this achievements. But well, I would like to admire that the efforts to achieve that, to form the negotiation position on Ukrainian sides were enormous. Most of all from the participants of the official organizations involved in that process, but also the support from think tanks, from business association, and also from our partners, our consultants from different areas, again, was very, very instrumental in that area. If you talk about the challenges, again, let me put aside the topic which was raised by Olga Stefanishina yesterday regarding the political will from some member states to support this track. So, of course, in our case, the most significant challenge comes from the environment in which we operate, and all-time search for the balance between, moving fast with adapting our regulations to the EU standards, and also the efforts we need to apply for the to keep the financial stability and the stability of our financial institutions. Again, my personal opinion is that in the long run, actually, there is no compromise between these two goals. So for sure, in the long run, the accession to the EU will support our financial stability. But in the short term, sometimes some, I would say, difficult trade-offs arise, and we have, find the right, correct priorities at the moment and balance, again, our desire to move as fast as possible and the need to preserve the stability of the system. And of course, the active war hostilities does not, help in that. So that is, again, so our main, I would say my main challenge is to avoid imposing excessive burden on market participants, but at the same time simultaneously maintain the pace of the reforms. And that is especially critical given our ambitious goal to implement the majority of EU financial legislation by the end of 2027. Another challenge, which is, again, from my point of view, common for all candidate countries, and it was raised many times already, that is the evolution of the legislation in the financial area. And again, yesterday our Polish colleagues highlighted that in times, comparing the financial legislation in 2004 during the previous large wave of accession and nowadays, well, so that are completely different worlds. And even more so, this legislation is continuously evolving, and in such we are essentially pursuing a moving target and have to adapt ourselves to this changing environment. Well, again, so we do our best and hope that we will be able to reach this moving target, but well, that is not easy. Probably I will stop here and and pass the floor to other participants.
Thank you, Sergey. It's very well noted that this is a moving target, and this will be a topic for some of the other panelists. I would like to pass the floor to Giancarlo For the benefit of the audience, Giancarlo, particularly those less familiar with the EU framework, and at the risk of oversimplifying a relatively complex process, what are the key features that make the single supervisory mechanism distinct from a national supervisory model? And how does the ECB coordinate with national supervisors across the EU area?
Thank you very much, Tony, for the question, and also good morning, everyone, from my side. It's, I have to say, also a pleasure to be, even if it is online, to be present to this conference. I hope that next time I'll be able to also join on site. So, with regard to your question, I mean, the obvious and the first answer to that is that the SSM is a cross-country entity. So we have a lot of different nationalities. We were coming at the start from different national competent authorities with very different practices, with different ways of supervising banks, different ways of managing data, and so this was at the start quite an adventure to find a common way of working together. So as I said, we are obviously centered in Frankfurt, so the ECB banking supervision is centered in Frankfurt, but we have a very important part of our work which is done in the different countries, in the different NCAs. So most of the teams that are supervising banks are indeed multinational, and part of the team is always located in the different member states. From a high-level perspective, so the SSM, as we talk about it, the SSM is really the ECB banking supervision and the different NCAs. And the way the work is divided is the ECB banking supervision is directly responsible for the significant institutions. So we have around 110, 115, depending on the quarter, significant institutions that are directly supervised by the ECB, and then we have around 3,500 less significant institutions that are supervised directly by the different NCAs and indirectly by the ECB. In terms of data, because as you were saying, Tony, at the start of your speech, is the supervision is really a data-centric work now. So a lot of our work is based on data, and I mean, basically, without data, we could not take any decision. So in terms of data, how do we work? We have created what we call the sequential approach. So the sequential approach is basically banks are still reporting their data to their own national competent authority using the systems that you have currently in place. The idea of that sequential approach was also allowing banks to reduce the cost of onboarding into the SSM systems and then replicating that cost partly to the competent authority. The other important element of that sequential approach is that we allow to have one flow of data. So without going too much into detail, you may understand that if you have different flows of data, so basically if a bank would report to the National Competent Authority in one flow and to the ECB in another flow, you may understand that at the end of the day, the result is that basically you would have different databases, and it would be a bit annoying that the ECB would take a decision going in one direction and the NCA going into another direction because we have different data. So ensuring that we have one flow of data was also super important for us. As I was saying at the start, we have very different practices, very different way of supervising, and we had to find a way to work together and to have a standardized and harmonized way of working and managing data. So we had to work a lot on what we called harmonizing that sequential approach, ensuring that we have a clear level playing field when we are assessing banks at the level of the ECB, and avoiding to have the NCA influencing the way we look at data and the way we assess data. Because at the start, when we were looking at data quality, we could clearly see differences between the different NCAs. Again, trying not to go too much into detail. If you are using Excel as a way to report data, or if you are using XBRL as a way to report data, you may easily understand that Excel is more error prone, and so the data quality of those NCAs using Excel was lower than for the other NCAs. So we were trying to harmonize to harmonize the controls and harmonize practices between the different NCAs. One of the most important feature that we have implemented in the recent years is what we call the immediate forwarding, which means that to the contrary of the past, where NCAs had 10 business days to send the data to the ECB, now we have reduced that to an hour. So when a bank is sending a report to the NCA has 1 hour to forward that data to the ECB. It allows, again, to have a full level playing field between the different NCAs, ensuring that when we assess banks, we can assess with the same, the same level of information between the different countries. It comes at a cost, of course, but it's worth the effort because we are now able to really work as one, understanding altogether exactly the same way the data we manage, and without big differences between the different countries. Maybe two last points I wanted to make on this. We have, as I was saying, this supervision which is centered in Frankfurt. We also offer at the ECB the possibility to the NCAs to use centrally the systems that we have developed in the ECB to control the data, to manage the data, to use the data. And we are going more and more in that direction, trying to have one single platform where all supervisors, wherever the country they are able to work using the same tools, using the same dashboards, using the same key risk indicators, really having the same environment to work on, whatever the country you are located. So that's also super important for us. And the last element, of course, a lot of work is also needed in terms of coordination. And there we have a lot of meetings. We have a number of networks that are focusing each and every web network on a specific subject, ensuring that when we are discussing, we understand each other, and that we are ensuring that the definitions are the same, that the processes are the same, and for that meeting together. Also face-to-face, not only online like I'm now, is also very important for us. So to coordinate together. I would say this is the main element I wanted to bring on the table. Thank you, Tony.
Thank you, Giancarlo. That's very comprehensive, and we would like to hear your views later on in the panel regarding potential coordination and cooperation for Ukraine. So that's very, very helpful. Okay, I will move now back into the room for Mishne. Moldova, like Ukraine, is pursuing EU accession under complex macroeconomic and institutional conditions. You've been closely involved in modernizing Moldova's financial sector, including in innovations in data analytics, forecasting, and digital infrastructure. Moldova faces a tight timeline and a broad reform agenda. Could you share with us how the National Bank of Moldova is approaching the alignment with EU financial sector standards?
Thank you. So we share a lot of history with Ukraine, more recent and more distant. If we look at the more recent, both national banks had to rebuild their credibility following terrible financial crisis, banking crisis, which exposed cracks in regulation, cracks in methodologies, and so on and so forth. So since 2015 and onwards, the banking system has been cleared up, and a lot of regulations started to be implemented back then. So if we go forward, right before EU integration, along functional areas of the central bank, a lot of the legislation was already starting to be aligned. Whether we talk about supervision, resolution, and so on and so forth, AML or payments. So, for example, in payments, we've aligned with PSD2. In anti-money laundering, for example, we had a second Moneyval report. Supervision has been revamped, and also internally at the bank, there's a lot of new analytical tools that are put in place. By and large, this process started before the EU accession, but obviously the EU accession gives it additional impetus. I'm not going to repeat many of the things that Sergei already said because they are very much similar. We are engaging the private sector quite a lot, other state representatives, in order to make sure that the accession process is not just about translating laws, but they lead to tangible changes, improvements, and that the inevitable constraints are well understood, and as much as possible their impact of these constraints is assessed. With this new legislation, unfortunately, comes also a very different business environment, and I think this is one of the big challenges that remains there. It's a little bit outside our scope, but I think this is should not be ignored. Whether we talk about the banking system, whether we talk about insurance companies or payment processors, they will face a dramatically more dynamic environment in which they have to operate as soon as the markets open. We're having different types of discussions. I'll give you a very simple example. The insurance for deposits, it's much lower in Moldova now than it is in the EU. If we were to align immediately, many Moldovans have perhaps a second passport. Would they want to keep their money in a Moldovan bank that offers just a fifth of the coverage of a EU country? So these are particular questions. I think Ukraine to a certain degree also shares them. So this is by and large, the challenges that we're looking at, even though at times they are beyond the perimeter of the central bank.
Thank you, Mishne. We'll come back to you on the financial innovation topic in a moment, but I wanted to go over to Sanya now to continue on this line, on this thread. Sanya, one of the additional complexities Ukraine faces is that the EU banking regulation isn't a static framework, right? And this is what was brought up yesterday, and Sergei referred to it today. It's a moving target. The acquis itself continues to evolve with the updates to the CRR and the CRD, the ongoing implementation of Basel reforms, and the evolving expectations around ESG risk, digital resilience. So from your perspective and experience both on the EBA Board of Supervisors and a head of prudential regulation at Croatia National Bank. Can you describe the regulatory policy-making process to some extent, and how can Ukraine manage this challenge of aligning with a framework that is itself shifting?
Yes, well, thank you, Tony, for all those questions. First of all, let me also say that I'm deeply honored, and it's my huge privilege to participate in this conference, even in this hybrid form at this time. I would also like to express my utmost admiration to Sergey and his team at the NBU for keeping the business as usual at a time that is nothing but usual. But as I am an optimist and I'm confident that the war will end soon, I'm looking forward to see Sergey at the EBA-BOS table discussing future of the EU banking regulation and supervision like we do. Coming back to the questions that you asked, Tony, well, after the Draghi report and its cry for increasing competitiveness of the EU market, the issue of proportionality has become even more eminent. But I have to say that EBA, in its role of developing level 2 and level 3 regulatory products, has always tried to be proportionate. And almost all of the documents have included caveats for simplified implementation by the small and non-complex institutions. So even though the framework looks complex, if you know how to navigate through it, you will see numerous opportunities to simplify its implementation. You just need to know where to look. We at the EU cherish our small credit institutions because they are more flexible to adapt to new opportunities. They are more equipped to support SMEs, and that is what every small open economy like Croatia really needs. So the huge banks do not have this perspective on the SMEs that we really need. As I have emphasized, the EU regulatory framework for credit institutions is complex, but it offers numerous possibilities for national discretions in order to better fit the framework for the distinct features of the local market. So my proposal is to use your ONDs, options and national discretion, wisely. Further, the industry needs to be aware of all the possibilities the framework offers for small and non-complex institutions. So somebody needs to tell them. And only after the country has explored all the national discretions and all of the possibilities for simplification, then the country needs to carefully develop the strategy and plan for negotiation. So this is how we did it. We found the inputs from the industry in that particular phase extremely helpful because they can detect potential issues with the implementation of the framework better than we as supervisors. So we need to be open-minded and listen. But like Sinatra has sang a long time ago, after listening to all the industry has to say, to all the advisors needs to say, then do it your way. So I'm confident that Sergey and his team will know what are the best solutions for the Ukrainian financial industry, which will have to support the rebuild of the country and its economy. And I'm sure the Mishnah will do the same for Moldova. The one thing you have to be aware is that the EU regulatory framework for banks is mostly based on regulations. This is something that I want to stress out. The regulations are directly applicable in the EU regulatory framework on the day that the Ukraine will become a member state, or Moldova. So you have to start preparing much before.
Sanja?
Yeah, sorry.
Sorry. It's not so easy to understand because you're speaking very fast and there's also a bit of translation going on. Maybe could you just repeat your second message and speak a bit slowlier, then it's easier for us also acoustically to understand your messages better. Thank you.
Okay, Wolfgang, sorry for that. Yes, sure. I said two things are very important. One, to use the ONDs wisely, so the national discretions, then explore all the possibilities for simplification, and then carefully develop the strategy and plan for negotiation. Listen to industry. And the last thing that I mentioned is that the EU regulatory framework for banks is mostly based on regulations, which are directly applicable in every member state. So you have to start preparing way advanced. So you cannot wait the accession to start implementing regulation. The reporting, for example, is also a regulation. So the reporting, the ITS, will be implemented the day that you become a member state. So you have to start preparing in advance. So this is my key message.
Thank you, Sonia. We'll come back later to hear about the experience in Croatia, if we have time permitting. Wolfgang, over to you. I have a question. GIZ has worked extensively in supporting financial sector reforms globally, especially in fragile or high-pressure contexts. From your perspective, what are the most critical elements for aligning this national financial architecture with the EU Acquis, and how can development partners best support that journey?
Yes, thank you. I would like to share some of my thoughts here quickly, that we use the time also for more exchange between the central bankers here on stage. As GIZ, we worked in many countries to improve the stability and also promote the process of reforms. In several African countries, I was designing these kind of programs and so on, also in Vietnam, Myanmar, and I remember very well Mexico. I don't want to go into any examples here, but what was very interesting, especially after the financial crisis 2008 and 2009, and I will refer to what was discussed yesterday. What we usually do, and we are all in our development sphere coming very much from financial inclusion, SME financing, microfinancing, but after the financial crisis, the issue of financial sector stability gained so much more importance. And what we do is, as also mentioned earlier, a proportionate approach, discussing with the central bank and the industry. I like the point that Sonia, you just made in this regard, listen to the market and the industry, and Sergey, you mentioned this too. So we really started a discussion. So should it be more Basel I or Basel II in some countries? And that was very intense and took us a while. But it was always country specific. So there was always this option to say, okay, what is best, what fits best for a country like Namibia or Vietnam or Mexico. Here we have a given set, and that makes really a big difference. And however, maybe coming a bit from this background, I'm always asking myself, okay, how can we bring in more exchange? Even Ukraine wants to move very fast, bring in feedback from the industry, from the market, from the associations, etc. But this is actually how we usually do it, and having a very balanced approach with regards to reform. And also, I think, Sonia, you mentioned that point too, that we do not overwhelm the financial institutions with more and more and more regulation, that the proper financing of the economy is no longer really taking place. So it was always also this discussion to make sure that we have this good balance, that the market can really function in a good way. And actually, we did this discussion, and that might be also of interest to this audience, in a very close exchange with the Basel Committee, with the International Association of Insurance Supervisors, so Access to Insurance Initiative. It was interesting maybe to note that these institutions like us and many development finance institutions as well address these issues coming from the financial inclusion angle, but brought really successfully on board the FATF and the Basel Committee and others. So this is these are some thoughts in this regard, and yeah, and for Ukraine, it's a given set. Yeah, it's an EU accession path, and this is clearly defined on the data side and in so many other aspects. What does that mean for Ukraine? And also Governor Prishny mentioned yesterday, so is there room to design our own roadmap and so on? And other colleagues say, well, you just need to do it, don't talk about it. Yeah? But maybe it's a bit something in between, because I think leaving the market behind, leaving or not talking enough with the various savings banks, commercial banks, state-owned banks, I think this could possibly be beneficial also to make sure that that we still, and this is nice about our new program on SME financing, that we do not forget that angle because of ESG and 1,000 other standards that need to be implemented rapidly, obviously.
Thank you, Wolfgang.
So I think this is very important, the financial inclusion discussion, but I think there's something very specific in Moldova and Ukraine. We look at financial inclusion in order to solve the problem of financial exclusion. Yeah. The problem we face is financial aversion, because this recent history that I was referring to meant that overnight you woke up and your savings in a bank were gone, or inflation was rampant and the central bank couldn't do much. Therefore, people had an aversion towards everything that was finance, financial product, financial institution. And this makes it a little bit more complicated to think in terms of financial inclusion as, oh, we give you a card and a bank account. And then what we observe is that certain categories, perhaps older people, perhaps in the countryside, they use it to withdraw all their cash and keep everything in cash over to, and if there's savings, it goes under the bed or in a tin box somewhere, right, in storage. And I think it's very important to think of it, but I think we need to definitely go along this line of adjusting these to the country specific.
Yes, thank you so much. Tony, back to you in a minute, but I think it's worth going back to this issue maybe a bit later, because I was working in Bosnia immediately after the Yugoslav war for a couple of years, and also there the trust in the financial sector was -100, not at all, and also there through credit line, SME financing and these kind of things, really offering good products that is really needed by households and by firms. And so this is, let's come back to that. Sorry, it's a bit of a co-moderation here, but Tony, back to you. Next question.
Yeah, I mean, I think we should keep going with that. I mean, this link to financial sector development, innovation and inclusion. It was mentioned yesterday several times. I recall the Polish FSA, Mr. Jarczewski, he said, be innovative, right? Ukraine should develop your own solutions and don't just blindly copy these EU models, and encourage Ukraine to find approaches that best fit their market. So let's open that for broader reflection from the rest of the panelists. Maybe over to you, Sergey, for reflections on this point.
Yeah, for sure, our final goal is to completely align our financial regulation with the EU standards. And on the one hand, I agree with Sanya that there are a lot of regulations which we have just transposed, almost blindly into our legislation. But at the same time, I would say that in the EU we have a lot of directives where actually we have a lot of room and to choose our own way how to deal with that. For example, yesterday on the panel, Minister Marchenko paid a lot of attention regarding the implementation of AML CFT legislation into Ukrainian one, and he referred to one particular law on the SEPA implementation, directed for the, creating the environment for the SEPA implementation. And well, we have a lot of talks in the country, in the parliament, regarding, the way how this European directive has to be implemented here, where this public register should be created, either in the tax authority or maybe in some other place. And well, from my point of view, so that creates, on the one hand, the flexibility for the authorities to look for the optimal, solution for the country. But on the other hand, it creates a lot of tensions, and that actually, I would say, decelerates the process of legislation alignment. Another issue, well, it seems for me that also we may, proceed with a different calibration of the, I would say, of our legislation, especially in the banking regulation. We may apply different coefficients. We may apply, the capital buffers, taking into account the Ukrainian specific and the level of or our assessment of, credit cycle conditions, credit conditions in Ukraine. And again, it seems for me that we may adjust some parts of our financial regulation in order to find this optimal balance on which I was talked already. Another issue that is, another issue is, some strict regulations in the EU which we have to just transpose. And for example, here is, the bright example is this levels of interchange fees, which are set on the European level directly, and we don't have any room for maneuver here. And at the same time, we have a lot of complaints from our market participants who, consider that applying this rates in Ukraine will decelerate the cashless projects substantially. And well, I don't know. So it doesn't seem for us that we have here any room for maneuver. We have to apply these rules as fast as possible in order to avoid any, I would say, delay on our Euro integration track. And well, so that is not easy issue to discuss in the public domain due to these very vocal voices from the business community, from banking community. Let me say in this way. So again, it's not an easy process, and to find the optimal way. And another bright example is the implementation of the BRRD directive here in Ukraine. Actually, we still have not the clarity regarding the resolution authority in Ukraine. So we are still struggling to find the optimal model for the resolution framework here in Ukraine, and the BRD creates a lot of room. And if you look at the experience of European countries in that regard, so it's completely heterogeneous. So, and that is very difficult to find, you know, some optimal model which we may just take and copy. And that also I would refer to the words of Vlad Rashkovan yesterday, who said that we don't have European banks actually in practice. We have Italian banks, we have French banks, and many others. And in the same way, I may say about the resolution framework. So we have very different examples in different countries. So, well, that's the area where we count for, I would say, not only on our own resources to find the optimal solution, but also on the expertise from our colleagues on the national level, on the expert level, and we hope that at the end we will be able to, you know, to find the optimal solution for Ukraine. Thank you.
Mishne, we spoke previously about some of these topics as well. I'd be very curious, and if you could share with the audience how you see the role of, for example, public infrastructure in Moldova for accelerating alignment with EU standards. You know, being a country that's perhaps less competitive with the other financial markets in the EU. How do you see that?
Yes, so we started from recognizing that we have a very, very small country, 2.5 million about people. We grew all before we grew rich. Again, something that means you do not have a lot of savings on the side or so on and so forth, and that we need to solve many problems at the same time. So those are, let's say, the broad lines. One thing that is extremely useful here is, again, innovation and technology allows us to a good degree to jump several development stages. One I would mention, which hits the inclusion target and improves transparency, reduces the shadow economy, is the launch of MIA. This is an instant payment system that's integrated in the, it's operated by the National Bank, it's integrated in each banking app. We grew, it was launched last year, we grew to almost 600,000 users on a population of 2.5 million. That's quite something. It started as a peer-to-peer for small payments, but what we see that helps a lot, especially SMEs, is the ability to sell your product and get money via a QR code. A QR code means with this printed little thing on a piece of paper, you can be in the countryside, you can be at the fair, and you can still charge your 5 euros or 10 euros for your manufactured product, for your agricultural product. This is very important in order to reduce, of course, the shadow economy and this reliance on cash that we discussed in the beginning. And what I hope is that we can build, you know, around this infrastructure, which is this payment data that's produced, to create some interesting companies and some interesting further products. SMEs generally don't have capital, but they will build a reputation. I mean, imagine you have a stream of payments that you can show to someone 6 months, 9 months, 12 months, and that almost creates your borrowing capacity. And you know, if this is an open source standard, and you can take your data and take it to Bank A or Bank B or Bank C, maybe each bank would be willing to lend some money, even though you don't have collateral or you don't have a financial statement for 5 years, or you know. So I think there's lots we can do in this area if we turn around the problem and think from what technology allows us to do to achieve our objectives, not just objective. Yeah.
Thank you, Mishne. Sanya, I would like to come over to you for a question. In 2013, it was a different world in Croatia when you joined the EU. What experiences can you share from Croatia? Perhaps in what sense did working groups or other methods to bring in the, let's say, banking sector realities and to overcome the resistance, perhaps, from the banking sector, and maybe connected to that, if there was any specific or deliberate effort for financial inclusion in that process.
Yes, quite a lot of spam of the question. Thank you, Tony, for that. Sure, 2013 was a long time ago, but it was actually the first year when the EU has implemented the regulation. So the first year when the regulatory capital adequacy, the LCR, the normal prudential elements were actually embedded in the regulation directly applicable in the. So when I talk to you about the preparation well advanced, it was our experience. We had to prepare the banking sector in order to have this direct implementation of the regulation, which in effect lowered, actually increased the capital adequacy, lowered the requirements for almost 2%, which is huge. So over the night, our banking sector were more capitalized by 2% because we had a huge capital buffers. So this is also something that I think that you need to have in mind. I mean, Sergey mentioned it, Mishkin knows as well, that there is no one size fits all. So you have to really, really carefully analyze what are the regulatory issues. You mentioned some, like, for example, deposit insurance, the maximum fees that will hurt maybe or impact the system. And you have to do your own analysis. You have to do the cost-benefit analysis. You have to make sure that you have the numbers right when you come to the Commission and you say, this is really important for us, and we need some time to bring the deposit insurance, for example, to the level of 100,000 euro, which is a huge deal. Or maybe have a transitional period that you have to, but you have to, as I said, detect which parts are most likely to impact the banking sector. But I'm just going to say there is no one size fits all, and after all, European Union's strength is in its motto, united in diversity. So, but what I wanted to also mention, one thing is that we are different, but also we are not in the same phase of the economic cycle. That's also important to know. After a war, Croatia, we had a loan expansion when nobody else did, because it was normal to expect that after the war there is a huge increase in the loans. So you have to prepare your strategy to, let's say, focus your resources on the origination phase. And later on, you have to also be aware that at that good time of increasing loans or increasing assets, very good position, you have to build the capital cushions, because what is inevitably going to come after this huge loan expansion, after the war has ended, there will come the situation when the NPLs will start rising quite rapidly. This is what happened in Croatia because it was normal. You need to expect that, and you need to prepare for that. So you need to build up capital while the expansion is going, and then prepare for a timely detection of the NPLs at the time when that happens. The NPLs, the large exposure, were the issues why we in the 98, the war stopped somewhere, 95, and the 98 hits a crisis which did not happen in the other member state, because it was the consequences of our huge growth. And actually what happened there was a liquidity crisis, but the liquidity crisis that came from the NPL rising. and the NPLs are going to rise because you are going to grow quite significantly. You need this institutional boost. The financial sector needs to be able to finance the economic growth that is going to happen quite soon when the war has really ended. So the macroprudential perspective will be important, and some capital cushioning needs to be prepared for that. So I hope I did answer. But you mentioned also one other thing, and that is that we live in the digital world. So the risks are not the same as in 2013. The flood of deposits is quite huge, but that needs to be taken into account when you do your analysis. That if you do not increase the deposit insurance and you open your boundaries, maybe the deposits will flee. We have fintechs operating in the EU, which are quite aggressive, and they do take a huge share of deposits as well, because they are insured in a different member state. So that is an element that needs to be carefully assessed when you are proposing your negotiation position. Yeah, I hope I did answer all the spam of the questions that you put on me.
Thank you, Sonia, very much so. I'm conscious of time, and we should probably move to the next section. But before we do, Wolfgang, I just want to give the floor one last time to Giancarlo, because I'm very curious how he is reacting to the idea of doing it my way when the ECB has a very strict process. So, Giancarlo, over to you for some final words on this.
Okay, thank you for the question. So how can I answer that? I mean, I think Sanya said it, and I think what she said is really important. She said preparation is key. And I really believe this is really the most important thing. So you need to schedule very well in advance what are the steps you need to go through to get into that process. She was also mentioning the ITSs. So indeed, I think it was also recognized by Sergi. You have part of the regulation which is something that you can interpret and that you can do it your own way, indeed. But there are also some regulations that are rather strict. If we again take the ITS, this is quite strict. It is defined by the EBA. You have very rigid rules, very rigid formats to report. So you have to prepare very well in advance. And okay, then it also depends whether you are going to join the SSM or not. So there is joining Europe, and then there is also joining the SSM. So one may not happen, and I mean you may join Europe, but not the SSM. That's really up to you. If you decide to join the SSM, that can be also being part or not of the discussion of joining the Eurozone. So we had in the past a country that joined the SSM without joining the Eurozone and joined the Eurozone later on. So if you join the SSM, we are also there to help. And I really mean it. I mean, when Croatia and Bulgaria, for instance, joined the SSM, I remember very well around 2 years before the date of joining the SSM, we were already discussing with the colleagues. I was already sending people from my team in Croatia, in Bulgaria, to look at the system, to look at how we can work together, how we can define the data together, how we look at the data in the ECB, and preparing then the colleagues in the different NCAs to make sure that when you receive the data from the banks, it rather goes smoothly to the ECB, and the process is then much cheaper than it would be if you prepare very well in advance. Because yeah, data management is rather costly. Huh? So this is also something not to underestimate. As you may be aware, we are going now into a process in the ECB, but in Europe, generally speaking, about simplification and trying to reduce burden on banks. And clearly reporting is one of the biggest elements where we try to reduce the cost and the burden for banks. So do not underestimate that and prepare very well in advance.
Noted. Thank you, Giancarlo. Okay, Wolfgang, over to you for the final block on the industry reflections.
Yes, thank you very much. Yeah, very well perceived what you just said. Also the approach, and I think, Sanja, we talked about it last week, to reduce the burden of regulation. So that's also a big topic on the EU level, and reduce the burden also for the banks with regard to data, as you just mentioned, Giancarlo. I think this is also, well, a new topic for a new panel. As we spoke a lot about, well, both getting feedback from the industry, and also yesterday we spoke about communication. Yeah, if you remember well, there were some questions. How do we keep the momentum of reform? How do we make sure that the society is on board in all these processes ahead of us? So to put this in practice, I would very much like to invite Andrej Dubas from AUP to sit here next to me, and also Ruslan Kachenko. Please join us on this panel. In the last, I don't know how much time we have. I'm a bit lost on time here. I think we have some more 20 minutes. It would be good to just get a bit of feedback from your side. Maybe just quickly introduce yourself, Ruslan, and then I will just ask some question with regard to provide a bit of feedback, what you heard, what you understood, listened to, and what does all this mean for the banks in Ukraine. Ruslan, just quickly introduce yourself, and then...
Yes, thank you very much. My name is Ruslan Gritsenko. I am currently holding position of Executive Director for Banking Association called NABU. But before I worked 15 years in the Central Bank, so it's very hard for me to say whether I am like a banker or central banker, and my mentality sometimes reflects both sides, which sometimes useful, sometimes not. Please.
No, I can imagine it's very useful. Just keep the mic on, please, then I can talk. Thank you. And also, Andrej is with us. Please introduce yourself. You see there are two associations of banks, and we will involve both of them in our future cooperation.
Thank you. So,
the mic. It's on. It's on. It always takes a second.
Okay. So thank you so much for invitation. My name is Andrej Dubas. I'm the president of Association of Ukrainian Banks, which operates on the market for 35 years. And now we represent not only the banking sector, but banking and non-banking financial sector, as well as since 2020, our national bank as a main stakeholder is regulator not only for the banking sector, but also for the financial sector. Mm-hmm. Thank you.
Okay. So yeah, maybe Andrej, just continue. So we talked about the path of EU accession. Many things were done, many steps were also taken on the banking side with regard to capital buffers, ICAP implementation, and so on. Maybe you make some, well, comments from your side, from the banks which are member of your AUP association with regards to EU accession. Do you think they are on board? Do you think it's even too much, and so on, too much regulation? And how, yeah, maybe you could imagine a closer exchange between the central bank, the National Bank of Ukraine, and the banks in general. And Ruslan, I will just ask the same question to you in a minute.
If I am able to talk from the banks who are the members of AUB, We have different banks. We have representative of state-owned banks, big banks, international banking group, and also private banks, big, medium, and small. So different banks react differently on increasing some regulations or reporting or etc. That's probably not very new to all participants of the panel and to our colleagues in the room. But why does it happen? Bigger banks apply this new way of regulation, new regulations, as something which will be done. So, and they understand it, and they are well prepared. They have resources for this. And also, on the other hand, they understand that new implementation and adopting new regulations probably will give them some opportunities. For example, new contracts with IFIs, with new programs, or more, I don't know, strengthness, some new opportunities. If we talk about smaller banks or medium banks, for them it is a little bit harder, but they accept it as well as the biggest bank, because we are all working in the same market under the regulation, and we all know where we're going as a country, to the European Union, as a choice of Ukrainian citizens. But for the smaller banks, I think this pushing the new regulation, this implementing of new reporting, and as our colleague Gianluca said from the ECB, simplification and digitalization of the processes, compare it, as Gianluca said, with the Excel and the LBR documents, is a very good way to understand and to be as a bank, doesn't even matter small, medium or big bank, to implement new digital techniques, I don't know, some digital platforms, to be on the line, to be ready to this new reporting. And I think what are we doing together with our stakeholder, with National Bank, is to see the clear picture, to see the final target is very important, strategic target, and the roadmap. Because if we yesterday, if I'm not making mistake, Ms. Christine Lagarde said this, the answer on this question about the communication. How can central bank communicate this clarification and clear targets and roadmap when all stakeholders, all players of this market understand what will happen in closer future in EU accession? It is the answer of the good implication and joining EU accession with all market, with trained market, with all Ukrainian banking sector. Thank you.
Yeah, thanks, Andrei, for that statement and message. Ruslan, also from your point of view, you have also some very big international banks in your portfolio.
Yeah. Actually, Andrei said a lot of...
Please add some points from your perspectives.
Actually, Andrei said a lot of important things for the market, and really banks usually are very resourceful institutions which have money to implement any reforms, to take the challenge of digital reforms and so on. But at the same time, it's very important to see how non-banking market is regulated. Because actually we are doing all our financial transactions, partially in banking sector, partially in non-banking. And it's very important for the regulator, for central banks, not to create kind of a regulatory arbitrage when non-banking sphere is regulated less than banks. But in general, you said about burden of regulation. I would look at this problem with another angle. The more regulations you have for the market, the better it's regulated, the more trust the banks have on the market. So the better is regulated, the more trust. It's easier to go to
trust. You said
trust, confidence,
right.
Confidence to the banks, and banks are based on a trust, on a confidence. So it's, I would say, important to have such burdened regulation or well-regulated market. And when we're talking about regulations, it's not about only rules; it's about values and principles. And European values and principles are very common for us. We already accepted that. So for us, it's not a big challenge to implement regulations after we share the same values. Thank you very much.
Yeah. Thank you for that comment. And now we heard also from Sergey, I mean, there is a strong pressure to also go, let's say, the next miles with regard to Chapter 9 and to reach that level of compliance and so on. Do you think it's, or what would you recommend? Is there already a good exchange taking place that the various banks can provide good feedback to the NBU with regards to priority? We actually had a workshop together with the AUP, and there were some banks, especially the medium-sized banks, saying, well, it would be good to have a bit of more clarity, what you mentioned as roadmap. So that was a feedback that came from some of these banks. So how to proceed? What are the next steps, and what should we get prepared for? So do you think it's already happening in a good way, and do you see room for improvement? That's a question to you. And then Sanja, I would also like to address you to get you on board again, how you did that in Croatia, as you just mentioned, also to get the industry on board. How did you actually do it? What kind of formats did you use? But Ruslan first.
Yeah. Frankly speaking, I think banks already implemented a lot of European practices. We conducted quite complicated procedures like stress testing for the banking sector. We implemented like full-scale anti-money laundering legislation. So it's not like it's always room, space to improve, but we are like going ahead with a good speed. And the only thing we should understand that there are like bigger banks and smaller banks. Sometimes bigger banks doing all necessary work inside. They have like IT departments, methodology departments, but even capacity of such departments is limited. So you have to have like right time given to the banks to implement anything. And this right timing can be only found in communication with the central bank. For smaller banks, they're using usually outsourcing companies, but capacity of outsourcing company is also limited. So they also should give them time like to set the task and to implement everything. So, but the answer to all these problems is just communication. So you have to be in constant communication with the central bank. And actually, that's what I should mention here, that currently the central bank is communicating with banks in a very good manner, and we do not have lack of communication. And the only like dangerous things would be is like politicians who are playing in populistic games. Sometimes they are changing rules or affecting rules in a way that the banking system or trust in a banking system could suffer. So that we should keep in mind that confidence and trust in banking system is the most important things to be saved during any reforms.
Yeah, if I can add a little, I absolutely agree with what Ruslan said about the trust and confidence. And one thing which probably were not mentioned in this panel, Ukrainian banking sector went through the reforms. I think the main stage of reform were already done since 2014 until 2019. I call it like a biggest phase of the reforms. And probably thanks God and thanks National Bank of Ukraine that have been done together with the banking sector. This, in beginning of Russian invasion in Ukraine, the banking sector was prepared and had a lot of buffers and a lot of things which they could use to survive in this absolutely dramatic history page, let's call it like this. But if you say about is there room to improve, there always is room to improve, but for example, what Sergey mentioned a little bit earlier, we already signed it together with NABU and one other Interpayment Banking Association, the common letter to the Governor Pyshny about the interchange fee payments. So first point is we have to keep communication as well as we do have. Because the way how we do and how Sanja mentioned that Croatia went through the EU accession into a different period of time. Ukraine are going in absolutely a different way of time. So we have to keep the communication as well as we have, and hope in 3 years we will be there where we want to come. Thank you.
Thank you, Andrei. Sanja, would you like to comment something about good formats, and again speak slowly? And because here on the stage it's not so easy to understand everybody very easily because of the loudspeakers are, let's say, of course, in the other direction. So, but some thoughts from your side would be very helpful.
Yes, being mindful of time. Well, I couldn't agree more. I have always seen industry as an ally and proposed to listen to their arguments. We kept the dialogue with the industry open and intense all the way, because it is the only way to identify potential problem at an early stage, with more time then to find the proper solution or a negotiation position. I have never experienced a resistance by the industry. After all, our role as supervisor is to help banks correct issues that will help them survive in a difficult time. So we are, I believe it or not, on the same side. What we have observed is that different banks warrant different supervisory strategy, regardless of the size. Even more important difference comes from the fact that some banks are local and some are part of the larger international groups. Local banks need support in navigating through this complex regulatory framework, while the banks that belong to the larger groups need to stay focused on the local risks, sometimes overlooked by the parents. So you have to have different strategies towards different banks, regardless of the size. So this is also something that a couple of panelists already mentioned, so nothing new from my side on that point.
Yeah, thank you. Thank you very much. What I liked is this issue of making sure that a really good financing is going to happen besides all the implementation of all these new regulations, even with some moving targets. Before we close this session, and I hope you're still awake here in the Saal, wonderful hall. As I said at the beginning, I spoke to several banks and also insurance association, etc. And it was interesting to hear that, well, the obstacles with regard to financing are considered as still high. Access for companies to financial services is not yet easy. And this is something really on the top of my heart I would like to address in the next 3 years while I'm working in this program to improve this. On the other hand, we spoke about financial literacy in the banking sector, better communication, making Ukrainian households also fully aware of the financial products that are there. But then the banks also need to serve this demand. If we transport the message, okay, there are these products. And I spoke to one bank where that is getting very, very digital, you know, filtering out so many applications from companies all around the country. Others are doing more, let's say, old school, and I'm also a bit old school maybe, you know, having the contacts to the client, and so giving loans more on the basis of trust and not collateral and more collateral, because then at the end of the day, not many people, companies will really get access to financial services. So this is also an issue, and we earlier raised the topic of financial inclusion that I would really like to address in some more detail, or we as GIZ also in our new program called Step into EU, as I mentioned at the beginning. Maybe Andrei, Ruslan, some comments in this regard?
I would like to finalize and say very big words of thank you to GIZ as an initiator of program Step into EU. We as Association of Ukrainian Banks, we signed a couple of days ago the memorandum with the GIZ, and I'm very thankful to Mr. Wolfgang and to those steps which we decided to go through. Really, we made a couple of workshops, and if I'm not making a mistake, National Bank also works together with GIZ and made some workshops. And after this, we see a lot of interest, interesting from the banking sector about the EU accession. So we decided to create a specific new committee in the AUB, which we called Euro Integration Committee, and we hope it will work until we join the EU. And the head of this committee is the member of the board of Crédit Agricole Bank, French bank, which is operating in Ukraine, Vitaly Kucher. So if there will be interest to join, welcome, and thank you GIZ for this.
Thank you, Ruslan.
From my side, what I would like to mention is that inclusion could be treated from very different angles, and actually you may perceive inclusion as an avalanche which is coming to us whether we do something or we don't do anything. So like we've been born in a years when people didn't have even phones, not even mobile phones. But now currently people get born already with phones in their hands. And maybe in a decade, they will not even know that bank exists at all on the street. So they will just know that they're doing everything with an application on their cell phone, and like they wouldn't even know whether it's a bank or non-banking institution. But from another side, it was very interesting to recollect that Christine Lagarde yesterday mentioned that bankers usually speak in a very weird language, and usually people don't understand what bankers say. And when we are treating or providing products for people like in a rural area, sometimes they don't understand what bankers telling them. So sometimes we need kind of mediator, or we need to teach bankers how to talk to regular people. So that's another kind of inclusion that we have to keep in our mind.
Interesting perspective. Yeah. Thank you so much for this discussion. We tackled several issues in view of feedback, but also in view of outlook. So what are required tasks for in the future? So Alexander is there, so it's time to close, right? And Sergey, would you like to react? Is there any word from your side?
Well, first of all, I would like to thank all participants for this terrific panel. So we definitely discussed the Euro integration of Ukrainian and Moldovan actually financial system on a completely different angle. And of course, actually, I completely agree with Michne that we share a lot of problems back from the financial crisis both our countries experienced in the past. And actually, again, it seems for me that both countries learned a lot after these countries did their homework, and again, at least in our case, that helped us a lot to, to navigate the financial sector during these extremely challenging times. But we still, I would say, somewhere in the middle of the process, and we understand that we have to do a lot in order to be, fully aligned with the EU standards. And again, so here we count on our partners, on the expert community, on donors, and of course on our neighbors and partner national banks. Thank you.
Yeah, thank you so much. Thanks for this panel in a hybrid format. It's the first time in my life that we did a mixed, let's say, setup hybrid and in person here in Kiev. Thank you, Tony, for the moderation. Sanya, Giancarlo, for your participation. I'm sorry, and we will stay in touch. And yeah, thanks to all of you. I think it was a good discussion and good reflection on the way forward. So now lunchtime and back. Alexander now to you. I think we did not take too much time.
Thank you very much, Wolfgang. So now we have a break for lunch and see you here in an hour.
Yes, we start 60 minutes.
Okay, dear participants, so we proceed with the agenda. So now we move to the second research session that we have today. So we titled this research session as Quantifying Fragmentation and its Economic Consequences. And today we should expect to hear how our speakers try to measure fragmentation and consequences of this fragmentation. So I suggest to stick to the schedule and to have a 20 minutes presentation, then up to 10-15 minutes for discussion. Then we will give a floor for questions. I want to invite the first speaker, Antoine Cornevin from Geneva Graduate Institute, with the topic on geopolitical risks and economic expectations, the role of trade linkages. Antoine will join us online, so I please ask my colleagues to show. Yes. Antoine, do you hear us well?
Yes, very well, thank you.
Yeah, we can hear you as well. So the floor is yours.
Let me first share my slides. Okay. Can we do that full screen? Can you see my slides as well? Oh. Okay, so I didn't hear that, but I presume this is fine. So first, I wanted to thank you very much for inviting me to this great conference. Today, I'm going to talk about a paper called Geopolitical Risks and Economic Expectations, the role of trade linkages. And needless to say, I wanted to start with a small motivation, but needless to say, like why geopolitical risks are important, when it has been thoroughly discussed during this conference. But the point here and the motivation of this paper was to say there has been a lot of work on the impact on real variables, macro variables in the economy, but not so much on the expectations. And we know that expectations drive decisions of household, firms, and policymakers. And another interesting feature about expectations is that they provide rapid responses to new information, and that helps better understand the transmission mechanism of geopolitical risks. And why the trade linkages part of this paper? Well, we know that shocks transmit internationally through global value supply chains. There has been many literature on it. And the point here was to say, when these expectations are being formed, do they take into account these trade linkages between countries? And I want to start with another motivation slide. What I'm plotting here on the horizontal axis are the months around Russia's full-scale invasion in Ukraine. And I'm plotting here actually the median real GDP growth forecast. I'll come back to this data of the Russian economy. And the dashed line is actually the level, so where forecasters think the economy will go. And you can see that there's almost instantly a sharp drop after the invasion. Of course, it has recovered a bit in terms of expectation after that. And the second black line that you see here is actually the uncertainty around these forecasts. And again, here you see a huge spike the months following the invasion, and this uncertainty remains pervasive over time. And I just showed this for real GDP. I'll come back to the fact that I'm covering many more variables after that. But the idea was to say, is there something systematic about any geopolitical risk event, or is it just anecdotal and driven, for example, by sanctions and other factors? So let me guide you through the key research steps. So there's been a lot of data work on that. So the idea is to take these forecasts from consensus economics. I'll again explain why consensus compared to other data set. But basically, we have a pool of 32 countries and monthly data since 1995. And I look at different macroeconomic variables, so GDP, but also the investment side, consumption, the current account, and also inflation expectations. And the idea is to understand, how these geopolitical risks impact these expectations. So the domestic geopolitical risk expectations I take from the well-known Caldara and Iacoviello. But then the idea is to say, you also have exposure to countries that are also likely to be facing geopolitical risks. And for this, I construct my own measure of foreign geopolitical risk exposure via bilateral trade exposure. And this will be done in a cross-country panel regression setting. And for the international transmission of geopolitical risk shock, I construct two different measures. One measure of trade substitutability, so I use elasticity estimates, and one measure, a product level measure of trade concentration at the product level. But I'll come back to that. And just to highlight the key results before going into any details. So the first question, research question, is like, how does geopolitical risk in general affect economic expectations? And what I currently find is that geopolitical risks do not systematically affect median economic forecast. One variable that is systematically affected, though, is investments. But you systematically have like an increase in dispersion of the forecast, so uncertainty rises massively. And what I found also is that geopolitical risk in a country's main trading partners spill over to the domestic economy and also generate uncertainty. And on the second part of the paper, the second question is, do trade concentration and substitutability shape the forecasted impact of these shocks? And here I also have two key results. The first one is that countries with elastic exports, and I'll define again what elastic export mean, tend to experience higher forecast uncertainty from foreign geopolitical risk shock. And at least at this stage, trend concentration has a limited impact on forecasts. So how do we measure domestic and foreign geopolitical risk index? So I'm going to start with the one that I take simply from the shelves, and I take it from the literature because it has been used extensively and was a good way to compare my own results. But for those who do not know how this indicator works, it's a news-based country-level index of geopolitical risks. And it's basically, it's a bag of words based on news articles. So we can come back to what words should be included for specific events. And the second condition is to have a reference to a country's name or major cities or major regions. The coverage is quite nice, and it's available at the country level. 44 advanced and emerging economies since 1985. It also has higher frequency and also different indicators. And why this measure compared to others? Well, the frequency is relatively high, and you have tend to have rapid media coverage to support identification. And the authors have shown in their paper that it's quite exogenous from other macroeconomic, financial, and other uncertainty developments. And for the foreign geopolitical risk index, so I take these indicators at the country level, and basically for each trading partner, I compute the trade exposure to each trading partners, and that is being scaled by GDP. So the idea is that when something happens, when this index moves in your main trading partners, it will affect your exposure to these risks. And just to keep like an example of this index at the country level, again, I'm showing what is happening with this geopolitical risk spike around Russia's full-scale invasion of Ukraine. And I mean, no surprises. You have Ukraine and Russia in red because they have been mentioned quite significantly in the newspapers, and also some neighboring countries. And then if you look at more the foreign geopolitical risk exposure, you start having countries that have trade links. For example, Brazil appears a bit more red with trade links with Russia. So that's the idea of this foreign exposure to countries. On expectations, a quick word. I use consensus forecasts. So it's a survey of professional forecasters. So it's a forecaster level data. I'm just wondering if I No, it's all good. Sorry. So it's a forecaster level data, also has a broad coverage, and they have many different macro variables that you can look at. So have real GDP growth, consumption growth, investment growth, current account, and inflation. And the reason for using this data is that, well, at least literature professional forecaster tends to possess more homogeneous information to analyze these complex events, and also because of the wide country breadth, time coverage, and the set of macro variables that it covers. And again, just to keep the same example as before, this is the distribution of forecast for Russia and for Poland. I picked the different countries, the months just before the invasion and after. And the idea is that, like, you can see what's happening in the distribution. It tend to be like quite much higher for Russia, but also after the invasion, not only lower, but also much more uncertainty of what is happening. And same applies to Poland. A quick word on trade substitutability and trade concentration before I move into the actual results. I leverage a work done by Fontanier and co-authors. They estimate tariff-based product level trade elasticities. They have different level of granularities for several reasons. Go at the HS4-digit level, so it corresponds to elasticity for about more than 1,000 products being exchanged between countries. And what I do is that this elasticity at product level, I look at the composition of imports and exports of each country, and then aggregate by volume-based these elasticity for the import base and export base of a country. On the trade concentration, again, this trade data is taken from Comtrade, but harmonized by Bustos and Yildirim. And here the idea is for each product, to control, or industry, if you want, depending on the granularity of your data. The idea is to say, like, how concentrated is from a country's perspective, the imports and exports from a product perspective, like how many trading partners. Of course, if you have only one trading partner, the HHI index would tell you that this would be 1, and the closer it is to 0, the more diverse your partner base is. I have many examples in the paper on how to the examples for China versus US over time, why these measures and the aggregation method, but for the sake of time, I will not go into these details. But I wanted to also make a quick word on how elastic, how substitutable are key products in global trade. So here what I'm plotting is the share of products by the share of global exports. It's again at the 4 digits level. And this on the vertical axis, you have the absolute elasticity. How you should interpret that is, like, the higher the elasticity, the more substitutable the products tend to be. So no surprise here, coal, energies and petroleum gases tend to be easier to substitute, but in the same category, if you go to refined petroleum, this gets a bit more difficult to substitute. And also here you have the usual suspects, the electronic integrated circuits, so semiconductors and so on and so forth. And the idea here was to say, okay, when you aggregate that at the country level, when I look at the data in 2022, so China, so this is the import base on the left-hand side, and then this is the export base on the right-hand side. And again, the bigger the number, the more substitutable it is. So China seems to top the list in terms of how easy it can substitute its imports. Whereas, I took the US-China case, and US tends to have a bit more inelastic imports. On the other side, what is very interesting is that China tends to have now, at least in 2022, the less substitutable exports versus the USA is about in the middle of the pack. Same on the concentration. So again, a value of 0 means you have extremely diversified partners based, versus 1 means you only have one partner. No surprise here that you have Mexico and Canada being, so high in here because they have a huge exposure to the US, and the Germany being, the less. Countries in the euro area is also not a surprise because you have a lot of intra-euro trade. So now about the model. So it's a baseline panel data model. So on the left-hand side, I have this different moments of the distribution of expectations for the different categories that I discussed. In this paper, I only focus on two, on the median and the interquartile range. It's just a more robust measure of than the standard deviation with a lag value of itself. And then you have the two measures of geopolitical risk, so the domestic one and the foreign exposure. And I also add to that, country and time fixed effects. So I run that for 32 advanced economies and emerging developing economies. I couldn't do more than that because it had to match both the expectation data and the geopolitical risk index data available. So let me show you the results for the impact of a domestic, so something that has happened within the country that you're studying. And so on the left-hand side, you have the impact on the level of the forecast. So this is the median on the left-hand side. And on the right-hand side, you have like the uncertainty that's happening. So maybe it's written in too small. I don't know if you see it, but this is real GDP, consumption, investment, the current account, inflation, and how you should read it. For example, one standard deviation of domestic geopolitical risk shock cuts the median investment by, here you have minus 0.05, so it's by 5.8%, and it raises the interquartile range, so which is a measure of dispersion, by 3%. So yeah, the main point here is to say, okay, not so much, or at least a lot of uncertainty on the uncertainty seems quite persistent, except for inflation, on these variables, whereas in terms of levels, the picture is not so clear, except for investments. Let me check how I am in terms of time. Okay, so in the second part of the paper, the idea was to leverage the use of this trade granular product level trade data and this measure of substitutability and concentration. And so it's just an extension of the previous model. You still have these two geopolitical risk shocks, so the domestic one and the foreign one. And then I just split categories into two. I split the countries into two different categories. One that have low export elasticity, then some that have tend to have higher trade concentration. And also look at the export elasticity, like how broad they are. And the idea is to say, okay, when a shock hits, does it matter for when the expectations are being formed, the actual structural dimensions of trade of a country? And I didn't want to show all the variables because this would have been a lot of regression tables. So I picked an example for the current account. So as I discussed earlier, no effect of these shocks on the levels. The first column is the level effect, and the second column is the uncertainty effect. So you still have this, this positive impact of a foreign geopolitical risk shock on the dispersion of the forecast when a shock hits. But what is interesting here is that for countries that tend to have lower export elasticity, so that tend to have export that are not so easy to substitute, well, the uncertainty generated seems to be much lower. Actually, I think I went probably a bit fast in my slides, but I think this is okay. So basically, the conclusion of this paper is that from this exercise, what I find is that geopolitical risk raises uncertainty, and it lowers investment forecast, at least when the shock is domestic, and that this uncertainty spillovers that I find through the foreign geopolitical risk shock are stronger in countries with that have elastic exports. And well, there are several policy implications. Of course, there's a need to better understand these risks and improve the risk assessment and management of these geopolitical risks. And, you know, as this generates a lot of uncertainty, there might be a need also for enhancing policy communication to reduce this uncertainty and let people better know what will be the action in the face of these geopolitical risk shock. So I'll stop here and, well, thank you very much for listening.
Thank you very much, Antoine. Now I want to introduce to the stage the discussant of the paper. So this is Giovanni Ricco from CREST, École Polytechnique. Giovanni, the floor is yours, please.
So first of all, let me say Dakuyu. Thank you for inviting me, for sharing this beautiful city with me and this sky over us. And thank you for offering me to discuss this timely and interesting paper, which looks at how geopolitical shocks propagate through expectations, which is a building block, if you want, of our understanding of how geopolitical risks affects or may affect our economies. And Antoine did a very good job in presenting the paper, so I won't really recap all what he does. It's a quite dense paper with lots of robustness checks. But essentially, it looks at this measure of domestic geopolitical risks from Caldana and Iacoviello. He specialized it, if you want, in two different indices, one for domestic and one for foreign risk, using trade linkages. It looks then at consensus economic expectations since 1995, 32 advanced economies, some advanced and developing economies, and then he has different measures of trade linkages and concentration of trades, and he also looks at elasticity of exports. Now, what he finds, and I think his conclusions were already mentioning that, he finds that changes in geopolitical risks do not shift median forecast. However, they increase the dispersion. But that's for measures of output, essentially. If instead you look at inflation, there's not much of an action, either on the first or on the higher moments. So let me show you, first of all, one of the charts we're looking at before. On the left, we have the response of median forecast. On the right, you have the response of the interquartile range. Think of that as a measure of dispersion or distribution. And these are the effects for the foreign risk. Now, as you can see, the bands are large, so there's a bit of uncertainty in the estimation. Investment for foreign risk stands out. There's an increase in investment associated to an increase in foreign risk. Antoine is very kind of straightforward on that. He says that it's not a robust result, so let me not dwell on that. But you also see on the right there's an increase in the dispersion of expectations. He calls that volatility sometimes in the paper. So let me just start mentioning a few things, and then I'll have a few more comments. I think the paper is already at a very nice stage. It's a nice paper to read. Perhaps there is something more we can understand from this data. First of all, bands are large. You might think perhaps adding controls will mop up a bit of volatility. Also control for different business cycle positions of different countries. You might also want to look at different objects that are in the data set, actually, as, for example, fiscal accounts. There's a variable called balanced budget. Perhaps if we need to understand what is going on with investment, we might need to look at what is happening on the fiscal side. And also, there are variables that are not for every country in the data set, but for a subset about inventories, which is, again, important to understand the dynamics of investment. And then you might want to look at interest rate as well. And perhaps there's more to be done moving outside this data set and looking at financial market implied expectations. There's a lot that we can look at. But also, perhaps we might need to think about whether we are looking at movements in variance, that is some symmetric movement on the two sides of the mean, or we are looking at shifts in the tails, risk scenarios. And then perhaps we might want to look at differences between advanced economies and emerging markets. Let me move to a second comment, and please flag me when I need to stop. What is this GDPR risk we use? The definition of the GDPR risk is the threat to occurrence and escalation of adverse events that disrupt the peaceful course of international relationships. It's a definition comes from political theory, essentially, and this paper is very important because it provides a key measurement contribution and shows that these things have large macroeconomic effects. In a way, the results of the original paper are a bit at odds with the results in Antoine's paper, but geopolitical events are complex things, and you can think of them as bundling together a very different mix of underlying structural shocks: energy price shocks, shocks to supply chains, fiscal shocks, military build-ups, diversion of demands, refugee crisis, you name them. So it's a very complex mix and potentially a very shifting mix from one event to the other. How do we unpick that? How can we make sense of all of these things bundled together? The third comment I have is that when you look at the measure itself, this is a chart from the original paper, you have in the sample that Antoine uses very few large spikes, very few clearly identified events, and potentially lots of noise. The light blue range are the daily measures of the same index. And you see that effectively we are looking at very few events, and there's a large bands of things fluctuating around. You might think of that as noise. Now, in the case of Antoine, there's one more event, which is sadly the beginning of the full-scale invasion of Russia, but not more than that. So are we looking at just a subset of things that can happen, a very specialized set of cases? The fourth comment is, this index, as the definition says, pulls together risks in the sense of non-realized shocks and actually realized shocks. And in the original paper, there are two different measures, and perhaps we might want to look at them, to look at how different things affect differently expectations and the economy. Risks that do not materialize, and then actual events. My fifth comment is about this puzzle and the responses of inflation. And in the paper of Antoine, it seems that forecasters do not react to these events by changing their expectation about prices or the dispersion of the expectations. Now, this is a chart that comes from a paper of Marco Pinchetti at Banque de France. It looks at GPR events, and it separates events that relate to energy, let's say, tensions on the energy markets, and other events. Now, if you look at the inflation for the US, you see that the events below on the bottom of the charts that relates to energy crisis effectively push up prices, while the others potentially push down. So they look more like demand versus energy supply shocks. So perhaps there's a lot to unpick here. There's a lot of different shocks bundled together we might want to think about. My comment number 6 is mostly harmful econometrics, but it's not about the econometrics in the paper, it's about econometrics that touches questions about wars and peace. Now here the econometrics is not straightforward as was mentioning. First of all, the two indices, the foreign and domestic GPR shock indices, are correlated. They're just re-weighting of the same index. So it's hard to think of them as distinct objects. They're effectively the same one. They, as I was mentioning before, bundle a bunch of very different structural shocks together, potentially together with shocks to higher moments, news shocks, and sunspots. So this object, this GPR index, cannot be thought of as an IV in an IV regression model. It's not exogenous in a way. And potentially is also affected by non-classical noise at high level. And that might cause all sorts of problems. So it's difficult to interpret regression results, if you want. And the lack of robustness is very likely. And in fact, you can think of the lack of robustness in some regressions that are in the paper as effectively a violation of the exogeneity conditions. Now, the question I was posing before is whether we want to look at risk or uncertainty. In the paper, the words are used a little bit as synonym, but clearly these are different things. An increasing uncertainty gives you both upside and downside sort of events probabilities, while an increase in, let's say, one tail events is a very different thing, and is just about downside risks often. The additional comment here is, this is essentially a static regression model. Why not to use a dynamic model and to think about how these things propagate over time? And perhaps that could also help in mopping up noise in the data. My last thoughts, kind of stepping a little bit out and looking at the broader things, is that scenarios are probably a good tool we should think more of when we think about geopolitical risks. And they, as was highlighted by Bernanke's Bank of England review, they have the potential to offer better means to think about the balance of risks around outlook, and we can combine them with, for example, dynamic models or dynamic quantile models in the spirit of growth at risk framework of the IMF, and they have a very powerful sort of tool for policy making when we have to deal with nighttime uncertainty, complex events, things we cannot really quantify, and that can help in essentially wargaming potential events, in thinking about how different scenarios will play out and how we respond as economists or as central bankers or policymakers. And that can help in making contingency planning and building resilience. So let me conclude, because I think I'm out of time. This is a very stimulating paper in sad circumstances. Perhaps more granular, more detailed analysis of the variables and of the events could deliver robust stylized facts. And more broadly, I think we need to think more about scenario analysis as a fundamental tool for uncertainty times. Thank you.
Thank you very much. So Antoine, you have a chance to respond to this discussion.
Yes, so first of all, thank you very much for the very valuable comments. And of course, some of these raise good questions, notably on refining the model. So it's definitely something that I will work on. So I will not, it will be difficult to cover all the points. On the fiscal accounts, so the additional variables that I could use to for this model. So yeah, this was a long discussion because consensus has a lot of different variables, but they differ in terms of coverage, time coverage, country coverage. So the idea was to focus on what we had, where we had the biggest coverage, but fully agree, to have the full decomposition. Fiscal accounts are extremely important, inventories and so on and so forth. On the variance, while not looking at the variance and the skewness, that was also, the paper is already somewhat big, so it is possible to derive more moments of these expectation distributions. Just not to have too many charts. I have done it, but I didn't put it in the paper, but point well taken. Same as with the split of advanced versus emerging economies, it has been done, and I think there's more to do on the heterogeneity analysis. And one point that I think is also very crucial, and you're very right to mention it, is what is, it's complex. So what is geopolitical risk? The idea here was to take something from the shelf already, to be able to compare like real variable with expectations. So I went for the Iacoviello and Caldara index, but I agree. Depending on what wants to be analyzed, if it's just like pure sanctions, probably this would not be the index to use. Let me just check, so the bundle of shocks. On the correlation between the domestic and foreign geopolitical risk index, it's true. It's a reweighting. In the paper, though, I show a correlation table, and the average correlation is not more than 30%. So of course, it's not perfect, but at least it's not completely correlated. And yeah, on the models, I fully agree. There's much more to do on the distribution side. So the models such as growth at risk, and other model that looked at what happened in different part of the distribution would be extremely useful. So I think I'll stop here, but I want to thank you again for the opportunity to present and for the very thoughtful comments. Thank you.
Thank you, Antoine, for the answer. Do we have any questions from the audience? Okay, I have a very short question. So you use trade linkages, right? But why don't you use financial linkages? Since, well, geopolitical risk, I would expect it will first spread out through financial channel.
You're right, and so that point has come in several other presentations. I think there was a WEO chapter at the IMF that looked at financial linkages. But that came out after I started my project, so the idea was also to extend on financial linkages, and this is definitely in the pipeline. But as the paper was already long, I started to look, at the trade linkages first. But it's a very, very fair point. I think this should be a discussion in how to construct these linkages.
Right. Okay. Thank you very much. We have one question in the auditorium.
Thank you. Really fascinating study do you have. And if I'm not wrong, one of your assumptions was that the geopolitical risks is actually propagates primarily to the nations which have strong economic relations with those nations which were affected the most by the conflict or the threat of the conflict, while then it doesn't explain why United States and Canada are among those displaying the high geopolitical risk increase, while they have really a weak economic connections with both Ukraine and Russia. Thank you.
No, thank you very much for this question. This comes back to the measurement of this index. I'm just saying it's a good base to start comparing other studies. At the same time, I'm not saying that this is the right, the only indicator that should be looked at. It is a news-based index. So, as I explained in the rules, for this index to spike, it has to be that a certain bag of words of conflict is being mentioned, and then the name of the country or its regions are being mentioned. And since the US, Canada, I'm not sure, I need to check the data, but since the US tend to have a large economic presence overall, it's also highly likely that for reasons I cannot fully explain, that they would end up much more they would be counted because they would be, the terms United States would be mentioned in these newspapers. The second bias that needs to be taken into consideration is these are mainly English and US-based, but English-based papers, so there might be also a bias towards the US views as well. So again, all of these factors may explain why you might see an increase when you might not want to see one, but this is part of the limitations of these indicators.
Thank you very much, Antoine. Thank you for the question. Indeed, this is a very interesting and very timely topic, but we need to move with our agenda. And now I want to, so we thanks to Antoine one more time.
Thank you.
Now we move to, now we move to the second paper, and we usually researchers usually talk a lot about economics, but now researchers will talk about researchers, right? So I invite Olga Zadorozhnya from Kuzminski University with the paper Borders of Integration, the CEU relocation and fragmentation in the European Union academic labor market.
Thank you very much. Thank you for the invitation to this conference. I'm honored to present this research, which is co-authored with the two colleagues of mine, Martin Kahanec from Central European University and Alexander Talavera from University of Birmingham. So I would like to present to you a paper on the borders of integration based on the special case of Central European University relocation from Budapest to Vienna. So first of all, let me start my talk by outlining the foundational principles of the European Union, which are based on the freedom of movement of goods, services, capital, and people. And in this paper, we're looking at the movement of people at the labor market. And we notice, and probably all of you here, you also notice that in the current reality, there are some challenges and disruptions in terms of this freedom of movement, and they are based on, rising nationalism and democratic backsliding in several countries of the European Union. They're based on institutional divergence between the member states and the persistent institutional heterogeneity between countries as well. So we look at the fragmentation of the labor market, and we actually noticed that academic labor markets can be an ideal testing ground for the persistence of fragmentation. And why is that? Well, first of all, because the academic labor force is highly mobile. It moves across borders. It has very standardized output, which is the same in any country. We need to publish papers, and preferably in top-ranked journals, and get more citations. We also tend to have extensive international networks with many co-authors living in different countries, and the academic community usually is very responsive to new opportunities of funding or any other opportunities that arise for us to do the research. And the main determinants of the research productivity, they are affected by the, institutional quality and governance, both on the micro level, at the level of the universities, research centers, but also at the macro level, which is the level of the countries themselves. The funding structures and research support, they matter a lot because without the funding, very often we cannot do our research. The knowledge spillovers are important, the collaborative networks are important for the researchers, and especially the regulatory environment. When the rules of the game are very clear, when we know and have a clear career path, then it's easy for us to develop our research output. So what is known in the literature on that? First of all, let me look at the labor market overall. And the research has shown that there are persistent barriers in terms of the labor integration in the European Union. And we had some discussion yesterday during the panels about the barriers existing, both in terms of language barriers, because, for example, it's not that easy to move from Sweden to Italy, for example, because you need to know the language, the local language. We have uneven recognition of qualifications very often between the member states, and some divergence in national policies in terms of the labor law. When we look at the research on the academic market and academic labor market in particular, we see that there are some supportive factors because EU supports research in general through its research frameworks and funding frameworks, such as, for example, Erasmus Plus program or Horizon Research and Innovation programs. But at the same time, the fragmentation still persists, and there are some empirical challenges when we look at the very mobile and junior scholars especially. We see that there may be some structural disadvantages that they are facing when compared to senior scholars, for example. So the main gaps that we find in the literature, they consist in a general methodological weaknesses, because it's very common in this line of research to have the selection bias in your methodology. And that is because researchers usually choose to move from one country to the other. And even if you follow the path of the researchers when they move from one country to the next one, still you cannot account for all of the potential confounding factors that affected that decision. And so the endogeneity will be there in your modeling. And there is also a limited availability of natural experiments to eliminate the selection bias and to eliminate endogeneity. So it's difficult to isolate the institutional effects from the personal career choices. And so we need some exogenous variation, and that is why the case of the Central European University relocation from Hungary to Austria, it is an ideal testing ground for us, and that's why we look into this case. So let me give you some context what actually happened. Back in 2017 in Hungary, they adopted the amendment to their Higher Educational Act, which meant that the institutions accredited abroad, not in Hungary, had to either establish campuses in those countries or basically be forced to leave Hungary. And there were mass protests against this law, and many people went out on the streets supporting the Central European University, which was actually accredited in the United States, and that's why it was problematic. And this amendment to this Higher Educational Act was very much political decision. And those of you who are from Ukraine, you know this context really well because you can relate to, pro-Russian propagandists referring to George Soros in Ukraine, supporting the activists as a negative thing. And the same thing happened with the Central European University, because actually George Soros founded this university back in 1991. And so that was very politically motivated decision on the part of the government, and the Central European University went to the Court of Justice to oppose this law, but in the end of the day they decided to relocate, and they announced the decision in 2018 and relocated in 2019 to Vienna, Austria. And for us, it's an ideal natural experiment because we have the exogenous shock, which is the politically motivated relocation of a university. It's an identical institution, so we follow the researchers from Central European University and their research productivity before and after the relocation. So we're essentially looking at the same people when they moved from one country to another, and we are looking at 2 member states of the European Union, which again gives us the possibility to test the fragmentation hypothesis. And we're able to collect the high-quality data, which I will discuss in a second. So the key question that we want to answer in this paper is whether the EU labor markets are fragmented and whether there are barriers to freedom of movement of the talent of the researchers. And the main hypothesis we are trying to look into is the following one. So if the labor markets are perfectly integrated in the European Union, then this relocation should not matter for the research productivity. We should find no effect of the relocation. And the research design that we are establishing is the, difference in methodology. We'll look at the CEU researchers and compare their research output to 2 control groups, the researchers in Austria and researchers in Hungary. And the main outcome variables that we're analyzing are, first of all, the number of publications, which is our research productivity. It is the number of citations, which is the measure of research quality, and it is the number of new co-authors that the researchers have post-relocation compared to before relocation, which is basically the research network size. And in terms of our contribution, well, it's a unique natural experiment, and it's the first paper to look at the academic labor market using such natural experiment. And we also look not only at the research productivity through number of papers, citations, etc., but we also look at the heterogeneity of the effects, looking at junior scholars versus senior scholars, looking at different disciplines, and this has been overlooked in the previous research. So we have an interdisciplinary contribution when we look at political prosecutions, politically motivated relocation, and its effect on the labor market of academics. To give you the preview of the main results, so first of all, we find a significant negative effect on the number of publications post-relocation, and the number of publications decreased by 19% compared to the Austrian control group and by 15% compared to the Hungarian control group. In terms of the career stages, we see that junior scholars were affected the most, while mid-career researchers were not affected at all, with a slight negative effect for the senior researchers. In terms of new collaborations, we find a very short-term positive effect, especially compared to Hungarian control group, and we find the evidence of citation stickiness because we find no effect whatsoever. So the data that we use is the bibliometric data from Scopus. We have around 18,000 publications tracking the research output of EU researchers and also the control group researchers over the course of 1991-2024. And our treatment group, these are, well, CEU researchers that had at least one publication 5 years prior to the relocation, and then at least one publication after the relocation. And we do this to make sure that we are tracking the research output of people that actually are active on the academic labor market. And we do the same selection criteria for our control groups. In terms of the model, so the outcome variables, these are number of publications, number of citations, or number of new co-authors, and we do a bunch of different measures and a bunch of different robustness checks when it comes to the definition of our outcome variables. And then we have our treatment group, and these are the CEU researchers, and then our after dummy is equal to 1 if it's a time period after the relocation. We use the research and year fixed effects, and our estimation method is the Poisson pseudo likelihood regression. Just to give you an understanding of how to interpret our results, because this is the Poisson regression, we need to exponentiate our coefficient to translate it into the percentages, and that's what I will be doing as well. So our baseline results suggest that there is a high negative effect on the number of publications, and it is robust to different measures, whether we weight the number of publications by the SGR ranking or we just use the dummy for the publication. Still, we find very persistent negative effect, while for the number of citations and the number of new co-authors, we do not find these effect at all. When we look at the dynamic effects, we find that, pre-relocation, we find basically the effect oscillate around 0, and then we find a sharp decline in the number of publications when the relocation happened, and then by 2022, still the research productivity didn't increase, so it's still below the pre-move levels. When it comes to the number of new co-authors, an interesting finding is that when the relocation, the move happened, there is a sharp increase in the number of new co-authors, especially compared to the Hungarian control group. But then it reverts to the pre-relocation baseline by 2022. When it comes to this short run versus long run effect, so the short run effect is defined as the effect over the course of 2018-2020, while the longer run effect is defined as the effect over 2022-2024. And we do not find anything for the longer term, so it's a short-term effect, both in the number of publications and the number of new co-authors. When we look at the heterogeneity, we look at different career stages, and we find that the highest negative effect is experienced by the junior researchers, and some mild negative effect by senior researchers, and mid-career researchers are not affected at all. When it comes to the number, the CU researchers with research grants, obviously they do not have these negative effects on the number of publications, but people without the research grants, that they have high negative effects. And the co-author network size seems to be important as well. And the CU researchers with the lowest number of co-authors, they suffer the most. When it comes to researchers with co-authors from either Hungary or Austria, we find very similar effects there, with obviously some negative, higher negative and significant effects for those without any co-authors in the control group countries. And then when we look at different disciplines, we find that natural sciences and engineering actually had positive effect, slight positive effect on the number of publications, while social sciences had a mildly negative effect. So to conclude, we do find that there is fragmentation in the academic labor market. There are still some barriers, persistent barriers to talent relocation. And the main policy implication here is that the political barriers to mobility should be eliminated in order for the talent to flow freely in the spirit of the main foundational principles of the European Union. And we have a lot of, a couple of limitations of our paper. First of all, this is the relatively short post-relocation window. We may have potential unobservable confounders, and we also look only at one special case of one university, and it would be interesting to look into the broader context. But the next steps that we are considering is to look at, first of all, the gender differences and how male versus female researchers were affected, and also the parental status and how researchers with and without children were affected. So that's it from me. Thank you very much.
Thank you, Olga. I invite Timofey Brik from Kyiv School of Economics to discuss the paper.
All right, so while we're waiting for the slides, I just want to mention that I really enjoyed, reading about your research and your findings, I apologize. So, and the reason why I really enjoyed your paper is because I'm not an economist. My training is in sociology and social science in general, and we really love reading such papers, and I want to compliment you on that. And I also have some points to discuss, in which I will proceed now. So, first of all, indeed, it is a very nice timing, and I really like how you sell this paper, because we live in these current political debates, whether we ask these big questions, whether integration of European Union falls versus polarization and nationalism. And also you mentioned about 4 freedoms, and now this is, kind of big political message in the European Union that maybe we have to think about the fifth freedom, which is a freedom of innovations, freedom of ideas. And your case is exactly about that. It's about the freedom of how ideas and innovations travel between countries. So it's a very nice framing. And it's a really clever research design. In a way, as you also said, when introducing the paper, we love reading about other scholars and research outputs. There is the whole field in philosophy of science, sociology of science, in graph theory and social network analysis. There is the whole field of citation networks. So I think your paper really fits well in this realm. I really like that you had several dependent variables, research productivity, quality, and networks. And then what I really want to debate now is your case of natural experiment, because I know it's a very big deal for you economists, you know, to talk about the things, but I have some pinch of salt here and a bit of skepticism. I think that your research design is quite well set on its own. I would argue that you do not need to call it natural experiment to sell it as a good research design. In sociology and in political science, we would rather call it a case study. And the reason why I'm a bit skeptical here is because, at least to me, it's not clear that that people were not affected by these political rumors in the first place. So consider the very recent case. It's an analogy. The very recent case of two scholars from Yale University who moved to the University of Toronto, Timothy Snyder and his wife, another famous historian, Mercy Shore. They moved to Toronto, and it is perceived as a reaction to the Trump's administration. However, everyone in the field knows that they made these decisions 2 years ago. The same can be argued about Central European University. Even though you mentioned that your first co-author is actually from this university, so he has some insight, he must know things, but even I knew that this university is going to move eventually. The rumor on the street was, it was out there. So quite a lot of people knew that they're going to move to another country quite soon. And I know that quite a lot of people were on the market looking for alternatives, maybe like 1 or 1.5 years before this move actually happened. So I don't really know whether you can really confidently argue that this is kind of a natural experiment situation. But my point here, I don't want to destroy the methodology, because my point is that I think the very fact that the university was forcefully moved outside of the country, it is already a quite unique situation that deserves our attention. And as a case study, it definitely can be published in sociology, it can be published in political science literature, maybe in economics as well. So I think that was my main critical argument. So, you presented the results quite well, and I also wanted to address another aspect of your paper, which is more about kind of big picture. The way you frame this paper is that it is about integration and some blocks for the integration. But when I read your research and when I read your tables and everything, I thought that maybe it's actually just a paper that it sucks to be kicked out from the country. So it's not just about the barriers, it's just about the fact that authoritarian regimes attack universities, and therefore universities have lower productivity. So I think this story is more convincing, because you don't have to, kind of pretend that this is a natural experiment and think about some other ways to sell this paper. And it is already have a very strong policy advice. Authoritarianism is bad. Intervening in the academic life is bad. And also, since my role is educator and I'm the rector of university, I actually had an idea, maybe we should rethink the way we judge academics. Because one of the typical ways we judge academics and we promote academics is by looking into the number of their papers and number of their citations. And your paper actually asks, I think, big philosophical questions, like maybe we should not judge academics by these metrics because these metrics are affected by all these political and economic circumstances. And I think just raising this point would be also very beneficial for the discussion. I would add a few other ideas to your next steps, because I think you already said that you want to study researchers depending on the gender, maybe children presence, etc. I would add a few more ideas just for the brainstorm. Maybe we should also compare scholars who publish papers versus those who publish monographs. I think Central European University is specifically famous for having a very strong graduate school in anthropology, history, political science, and they don't really care about papers. You know, they publish like one monograph per 7 years, and they're quite happy about it. And I think maybe you're missing this in your analysis. And then it's a type of contract. So you already address the status of the scholars by looking in their status as a junior, mid-career, or senior scholar, and you measure it through the years of a contract. But I would argue that the type of a contract can be more straightforward way of measuring that, because sometimes people have tenure tracks, people have tenures, people have adjunct positions, and sometimes young people have tenures, and sometimes senior people do not have tenures. And this can also influence their productivity and their decision, because basically once you know that your university is going to be pushed away to another country and you are in the middle of your tenure track, maybe it's more beneficial for you, to quit this university at all and go to Germany or United States or something like that. And yeah, and I feel that you're missing also quite a lot of factors that are related to the human nature, irrational nature of our behavior, emotions, pressure. You cannot measure it directly from abstracts and from metrics, but in social science and sociology, we usually do field work. I think it would be perfectly fine for you to conduct some qualitative interviews or run a small survey. I know that it's not typical for publications in economics, but why not? Given the interdisciplinary nature of your research question, I think it would be also nice to add some interdisciplinary techniques. Other than that, I think it's a really good research. I think it asks correct questions in a correct time, and yeah, and I really liked reading it. So I wish you success. All right.
Thank you very much. What would you respond?
Thank you very much, Timothy, for this discussion. So, yes, indeed, the fifth freedom, the freedom of movement of innovation, very good point. Thank you very much for raising that. We will definitely incorporate that into the paper. Well, I think whether to call it natural experiment or not, it's a bit of a philosophical question. We can, I can agree on that. We can call it a case study. I think it's fine with us as well. In terms of the setup and put it as a fragmentation story, well, I think it is a fragmentation story in the end of the day, because, we are promised this idea that the talent and the labor can flow freely, and in the end of the day, the reality is that it doesn't. So it's one of the aspects of this fragmentation that we wanted to showcase. And I think it's a very good, case study, let's call it like that, to do so. In terms of the publications that in the end of the day should not be the measure of the productivity, I agree on that. Thank you very much for raising that point, and we can elaborate in the discussion of our results in the paper on that. Thank you very much for the ideas also for the different heterogeneous effects that we can explore. Well, papers versus monographs, yeah, that's a good point. So definitely we will look into that. In terms of the type of the contract, I think there will be some shortages of data. So I don't think we will be able to collect the data on the type of the contract, we look at these junior, mid-career, and senior researchers, and we measure the career stage based on the years since the first publication. So it's not since the type of the contract, or it's not connected to the contract, but rather it's about their publications. And fieldwork, yes. So we have a co-author from Central European University, so hopefully he can help us with collecting some more data from, I don't know, interviews and just talking to his colleagues and people there. So yes, thank you very much.
Yeah, thank you very much. We have a question.
Hello, and here I'm gonna try to push back on Olga's side. I think you both talking about different things. What you say is it sucks to be kicked out, you mean productivity drop. And when she talks European Union promised us the freedom of movement, she talks about zero cost of moving across countries and setting up. Which leads to my comment that probably you can differentiate these two things in your research design, and you can look at the researchers who were more linked to the outside world with their work. Like, for example, if they co-authored more with Hungarians, you control that in your research design. So, and that would somehow talk about whether it was a productivity drop or something else. So just like satiation with controls, you can have a section where you address these things. And then you have both, which is really cool.
Yeah, thank you very much. We actually distinguish between researchers with co-authors from Hungary and Austria, but we can also look into other countries as well, so we know where the co-authors are from, so that's definitely something that we can explore. Thank you.
Do we have more questions from the audience? Okay, thank you very much, Olga, for this very interesting and timely topic. So we move forward with our agenda, and the next presenter is Nicola Gavei from Bank of Latvia, with the paper A Short Drop or a Sudden Stop, Sanctions, Trade Shocks and Firms' Adjustment Margins. Nicola, do you hear us?
Yes, I do.
Yes.
Do you hear me?
Yes, we can hear you. The floor is yours.
Okay. Do you see my slide as well? Yeah.
Yes.
Okay, so hello everyone. My name is Nicola. I'm really pleased to be part of this program. First of all, I would like to thank the organizers for organizing this event, and also for accepting this paper and allowing me to present it to you this afternoon. So I'm from Bank of Latvia, but I'm also from the Stockholm School of Economics in Riga, which has historical links with the Kiev School of Economics. So I had many opportunities to visit the Kiev School of Economics in the past. I wish I could have made it to Kiev again this time, but for logistical reasons that was not possible, but soon. So the paper I'm going to talk about is entitled Sanctions, Trade Shocks and Firm Adjustment Margins. So as the title indicates, we talk about sanctions, trade shocks and firms' adjustment margins. So since the beginning of the full-scale invasion back in February 22, there was overall 16 different packages of sanctions that were imposed by the European Union between February 22 and December 23. There are many different types of sanctions, but two broad types of sanctions are covering a lot of them. We can consider general trade sanctions, like for instance the ban from the SWIFT system. And on the other hand, a lot of trade restrictions on specific goods. So what was banned either for export or for imports based on product codes. For EU firms that were trading with Russia before the beginning of the war, this type of trade shock constitutes some sort of exogenous hit or exogenous trade shock for them. So you can trade and almost overnight you cannot export your production to your trade partners in Russia. So there is a lot of literature that is focusing on the effect of sanctions on trade flows, especially regarding the 2014 wave of sanctions, again, between the European Union and Russia. What I will try to do in this paper, nevertheless, it's not to focus on trade flow by itself, but more on the reaction of firms that were hit by the shock. So how do firms respond when trade suddenly stops? So more precisely, what I will try to do in this paper is to study the different margins that firms that are impacted can use in order to absorb the shock in the context of the 2022 Russian invasion of Ukraine and the subsequent trade restrictions imposed by the EU. So I will take the perspective of the sanctioning side, as I will use administrative data from Latvia, and I will use different sets of administrative data that will so underpin this analysis. Different motivations for this. So first of all, before 22, Russia was still in the top 5 trading partners of Latvia, both on the export side and on the import side. So nearly 1 exporter out of 5 was still trading with Russia. I will use detailed trade data and firm level data. And I will link these administrative data sets to the list of products that went under EU sanctions. So I will try to study what are the adjustment margins that firms use to absorb adverse shocks in the short run. I focus here and I put it in bold in the short run because so far I have data only till the end of 2022. So most of, as I will argue, most of the trade sanctions were imposed in the first part of 2022. So it gives, let's say, a 6 to 9 months for firms to adjust. And so this is what I will measure in the end. So I will study also the exit, so whether a firm is shutting down, employment effect, beyond just this extensive margin, trade, turnover, and profit. I will study separately exporters and importers, but for some reasons that I will explain later, I will mostly discuss in this presentation on exporters. What will be the empirical strategy? Well, I will take the set of firms that are hit by the shock, and I will compare those that are, let's say, receiving a light shock to those receiving a very hard shock. So, first of all, what is the set of impacted firms? Well, I will argue that this is not as straightforward as it may sound, and just that taking overall all the firms that were trading with Russia in 2021 or just before the shock might be a bit misleading. So second of all, also, once we have a set of impacted firms, how to measure the magnitude of the shock at the firm level. And so I will measure this magnitude using 2 different measures that I will use at the same time, the exposure and the bite. So what is the exposure? It's how much depending is a firm on Russian market. So in a way, the ratio of exports to Russia over turnover. And what is the bite? It's given what you are exporting to Russia, what is the share of your export in 2021 that would subsequently fall on the sanction list. Okay, so I will use those 2 different measures at the same time for measuring the impact or the magnitude of the shock at the firm level. And then equipped with this measurement and this set of impacted firm, I will use a simple difference in differences approach where I will use this measurement in heterogeneity of the shock as some sort of continuous treatment intensity. So the main takeaways here, so firms with low exposure to Russia are highly likely to exit the Russian market. So basically, sanctions or no sanctions, in terms of whatever I'm exporting to Russia or importing from Russia, if I just have a very marginal part of my turnover that is made in Russia, I prefer to leave the market directly. So on top of that, firms that are continuing, that remain in the Russian market, they drastically decrease their trade flows. Also, overall, only the most impacted firms, so those that are the most heavily impacted by the trade disruptions, are impacted beyond trade. So the trade loss is partially compensated by higher probability to start trading with CIS countries. So there is a lot of evidence at the aggregate level, but here I show that at least I show some evidence, supportive evidence that this is the same firms that were trading with Russia that cannot do it, and so that start exporting to CIS countries. And I see also some negative employment response at both the intensive and the extensive margins. And finally, a significant drop in turnover and profitability. But here, all those negative consequences, again, it is only for a very small set of firms, so those that were doing a large part, or generating a large part of their turnover in Russia. Okay, so in terms of data, so I have access to customs data at the monthly level, well, actually at the transaction level, but I aggregate it at the monthly one and then at the yearly one. So I have the value of the export or the import, I have the country of origin or destination, and I have a 8-digit product code. I link this to firm general information at the yearly level, so where I have the sector, the registration year, etc. And I also have access to all basically the balance sheets and the income statement of nearly all the firms in the country, including then those that are trading with Russia in the past. I have also access to matched employee data, so at the monthly level. So this is from where I can gather information about the number of employees at a precise point in time and also the wage of employees. And I can also see at the monthly level which firm is exiting the market, so shutting down, and precisely when. I have, unfortunately, so far, again, data up to December 2022. So as I said, and I want to put the emphasis on this, what I will show is really focusing on the short-term effect. In terms of data map, so I have all the firms, I have employees, I have firm financials, so balance sheets and income statements, and I can also link it to trade data where I have basically all the trade that is done. Now from the trade part, I also gathered all the information regarding the sanction packages and the trade restrictions imposed on specific goods that were imposed by the European Union. And so I can link it, thanks to the HS classification, to the trade operated by firms in Latvia. Okay, so I guess this is not something that I should put emphasis on in this specific conference, but still, so I'm talking to you from Riga, so exactly here, and we share a 300 kilometers border with Russia. So this is also for geographical reasons that historically the trade between Latvia and Russia was fairly high. So overall, the trade, the aggregate trade between the two countries. So in terms of export and import, so in green, this is the overall amount of exports. In orange, this is the trade of goods that fell under sanction in the first part of 2022, and in blue, the goods that fell under sanction in the second part of 2022. So as you can see, it is sanctions that mostly kick in the first part of 2022. For imports, we have similar figures here with actually a larger part of the overall trade that fell under sanction. Well, this is mostly due to petrol and gas issues and wood as well. So this is the aggregate level. Now, in terms of the number of firms that are exporting and importing, so trading with Russia. So for the number of exporting firms, we had something that was constantly decreasing over time, and this decrease actually started before 2014. Okay, so here it is in red, the aggregate amount of firms. In red, firms that are making more than 50% of their exports to Russia. And in blue, firms, the number of firms that are only exporting to Russia. And similar figures for importers, where you see that there is a very sharp drop in 2022. Now, what types of product we are exporting and importing? So the largest export that we're doing to Russia is related to alcohol, basically. Then in the second part, well, it's more machinery and mechanical appliance and nuclear reactors. But this is HS code 84, that is the second in terms of importance in value. Pharmaceutical products also is fairly important, and this is to almost 100% local production here, where we have a few very large pharmaceutical plants that are having Russia as their main export country, and so that is explaining the presence of pharmaceutical products in the list pretty high here. What do we import? Fuel, iron and steel, wood, fertilizers. So this is by far those 5 types of goods that we are importing from Russia. So this is for the background. Now the 2 main problems for the analysis. What is the set of firms that actually experienced a trade shock? And second, how to measure the magnitude of the shock at the firm level. So to find a set of firms that are actually experiencing trade disruption, a naive first idea that I went through at first is to consider all the firms that were trading with Russia in 2021 as hit, or firms that were hit. Nevertheless, paying a little bit more attention to the data, it turns out that up to 40% of firms trading with Russia in year T, they ceased to do so in year T+1 in the pre-war period, or pre-full-scale invasion period. So here, this is the number of firms that is plotted on the y-axis per year, and we have each year the number of firms exiting and entering the Russian market for exporters and from the importers' side. So even though the number of firms overall trading with Russia is fairly stable over time, we have actually from one year to the next a lot of things going on and a large number of firms exiting and entering the market. Okay, so just taking into account all the firms that were trading with Russia in 2021 as firms that experienced a trade shock, that would be somehow misleading, because a lot of those firms, in the absence of the invasion, would have stopped trading with Russia anyway. Okay, so if I don't account for this, it would lead to an overestimation of the trade disruption and an underestimation of firms' response. What I tried to do to adjust for this, well, this is the best I could come up with, is to try to predict, based on the pre-full-scale invasion era, to predict what are the firms that would have kept trading with Russia had the war not started, or had the full-scale invasion not happened. So how do I do that? Well, I take all the informations about firms trading with Russia in 2021, between 2010 and 2020, actually. And I take all the characteristics of those firms and also in terms of composition of their trade. So for exporters, I have the types of goods, the number of months, the period of the year when there is an export, the overall value of trade with Russia in particular, the overall trade with any other partner for that type of goods. So a lot of information that is characterizing the trade between a specific firm and the probability to export again or import again in the following year. Then I have all this information and I use a simple algorithm for classification. So I use several, but the best performing one is gradient boosting. And so, as I said, I trained the model on the 2010-2020 period in order to predict in 2021 which firm would have kept trading with Russia in 2022 had the war not started or had the full-scale invasion not started. Okay, I also do the same, but instead of 2010, 2015, so to exclude the part that is related to before the invasion of Crimea, but the results are basically the same. So with this simple approach, I estimate that approximately 70% of exporters and 65% of importers would have kept trading with Russia in 2022. From those that were trading with Russia in 2021. Yeah, this is what I mentioned here. So I have a set of firms that were directly hit in the sense that in the absence of the full-scale invasion, they would have kept trading with Russia. Now, in terms of magnitude of the shock. So this is also something that was not that easy to figure out, at least for me. But a starting point in the literature is to use the export under sanction to a given country, so in our case Russia, divided by the turnover. So what is the value of all my exports just before the shock, that is falling under sanctions subsequently, divided by the turnover. Nevertheless, this ratio that was used in several other papers, we can divide it in two terms, or we can decompose it in two terms. The exports to Russia over turnover, so which I will call exposure, and the exports under sanctions to Russia divided by exports to Russia, so the byte. In a sense that I can have some firms that are exporting a little bit to Russia in 2021, but from their little bit of exports, everything is falling under sanctions in 2022. Yeah. On the other hand, I have some firms that may be highly exposed to Russia, but that are spared by direct sanctions, so sanctions on specific goods. So I will have a high measure of exposure, and I will have 0 for byte. Okay, so if I just use this measure, I would capture both at the same time. But in the 2022 shock, just the mere exposure is highly likely to have a directly hit on firms, because we're talking about disconnection from SWIFT, we're talking about moral concerns, we're talking about a much larger scale than other waves of sanctions that were studied in previous papers that were focusing on this part only. So I will measure firm level shock via 3 components: the exposure, the byte, and the interaction between the two. So here, just quickly, the exposure to Russia in terms of export over turnover or import over turnover in 21. So a large number of firms that are exporting to Russia in 21, they are just generating a small part of their turnover on the Russian market. On the other hand, some firms are generating 100% of their turnover in Russia. So the distribution is overall the same for importers, with a relatively small number, but still they are companies that were importing a large part of their turnover from Russia. So here is the byte, conditional on being hit by sanctions, actually. So again, it moves from 0 to 1, so we have full support, and we have actually quite a lot of importers that were importing goods, and only goods that subsequently were put on the sanction list. Here it's to a large extent driven by wood in particular. So we have a measure of the magnitude of the shock. We also have a set of firms that are likely to be the one that would have kept trading with Russia in 2022 had the full-scale invasion not started. Now what to do? So I will take the growth rate of whatever outcome between the end of 2022 and the end of 2021, and I will regress it, so on the measures of the magnitude that I described before, so the exposure, the byte, and the interaction, controlling for a bunch of other controls. So I have firm age, the sector, labor share, profitability, some others that we can add, but this is the main set that I have in the paper. So for the sample, I use firms trading with Russia in 21 that were predicted to continue trading in 22 had the war not started. So I have a bit more than 600 exporters and a bit less than 1,000 importers. And I exploit, as I mentioned at the beginning, the heterogeneity in the magnitude of the shock among impacted firms. So why do I do that? Well, the main reason is that there is no proper control group. If I use any other type of firms that were exporting somewhere, it is highly likely that this other type of firm has been indirectly impacted by the rerouting or change in the export strategy of firms that were previously impacted or that were previously trading with Russia. So there is this reason, and the second one is that firms trading with Russia in 2021, they may be special in a sense that a lot of firms that were trading after 2014 decided to stay on the Russian market for the reason that maybe they have different types of risk-taking compared to those that withdrawn from the market in 2014 or before. Okay, no signs of pre-trend for exporters. The parallel trend assumption is less convincing for importers, so I will focus on the first case here. So far, I didn't talk about the caps on luxury goods. I won't consider it because, well, this is just a specific cap, and it's very hard to see, as I don't have the number of units, what is the unit price in each transaction for each type of good. So what I can do here is just to exclude all the firms that are also trading sanctioned luxury goods. I can remove them from the analysis and the results remain the same. Also, I assume a linear relationship here in what I presented in the previous slide, but alternatively, I can also show the results, not in this presentation, but in the paper, when I use categorical variables for byte and for exposure instead of the continuous one, and I will mention it a little bit here. So for the results, to quantify the magnitude of the trade disruption, first of all, what is the probability for a firm to stop trading with Russia? So no trade with Russia in 2022, and I consider also no trade with Russia after March 22, so to eliminate those that were just trading in January, February, and that stopped later on. Then in the second part, for firms maintaining trade, what is the percentage change in value of export and import? So all the results, it will look like this. So on the left-hand side, I will have exporters, and on the right-hand side, I will have importers. And how does it look? I'm plotting the predicted probability here to exit the Russian market based on, here the x-axis is the exports to Russia over turnover. So this is the exposure measure that I was describing before. And I plot two lines. One is the predicted probability in dotted line if 0% of my exports to Russia are subsequently falling on the sanction list, and for a firm that is hit by the average percentage of sanction, so meaning that here 36% of my production or my exports to Russia in 2021 would subsequently fall on the sanction list in 2022. Okay, and so here it is just a histogram that is indicating the exposure, the distribution of exposure in my sample. Okay, so here this is what I said in the introduction. Firms that are the least exposed to Russia, meaning that only a few euros or a very small part of their turnover is generated in Russia, they are those that are the most likely to exit the Russian market. The larger your exposure, the smaller the probability to exit. Well, I guess this is something that is fairly intuitive. The same thing happens for importers here. Now, conditional on remaining on the Russian market in 22, irrespective of whether or not you are hit by sanctions for both sets of groups, for both sets of firms, the predicted probability is very, very negative. So the amount of goods traded with Russia, conditional on remaining on the Russian market, is much smaller than it used to be. It's a little bit particular for importers, but the idea is about the same. So we have trade with Russia that is severely hit. Well, this is not something that is very surprising, but how do firms absorb the shock beyond just this direct trade response? So here in the first part, I will show the probability for a firm to shut down by the end of 2022, and the probability for firms remaining in operations, the percentage change in employment by the end of 2022. So how does that look? Well, the probability to close, well, is increasing for firms that are heavily exposed to the Russian market. So we have close to 10% probability of shutting down for firms that are hit by direct sanctions and that are highly exposed to the Russian market. And so here we are at the end of 2022. Everything here is measured at the end of 2022. Okay, now the thing is, those firms that have a much higher probability to shut down, but there are very few. So it's concentrated among those firms here. I mentioned that I also have specification where I have categorization of exposure and of sanction. This is driven by those that are highly exposed to the Russian market, not by the others. In terms of employment, conditional on not shutting down, well, you have up to 10% decrease in employment for the firms that were the most heavily impacted here. I have information on employee data at the monthly level. I also check what is happening for the precise timing of the employment response. And it turns out that the negative employment response shows up as early as May, June. So it's very short run reaction that we can detect in the data here. Now for surviving firms, how did the trade shock affect total trade? Well, overall, what I see is that there was a decrease in the exports and the imports of highly affected firms, but an increase in total exports for low affected exporters. Now the thing is, did firms manage to start trading with new partners? By new, I put it in quotation mark because also at the aggregate level, there is a lot of evidence that trade with neighboring countries of Russia suddenly start to import a lot of goods that were subsequently banned in Russia. So here what I'm trying to check is what's the probability at the firm level to start trading with CIS countries. So I exclude the very few firms that were previously exporting or importing from CIS countries, and then I check this probability here. And so what I see is that the probability to start exporting to CIS is also increasing with the overall level of exposure to the Russian market. So in a way, it's firms that were the most affected by the trade sanctions, and not only sanctions, but by the trade shock overall, that started to export to CIS countries. Here it's the same, but only start exporting sanctioned goods to CIS countries. So we also have clearly an increase in the probability to start exporting that type of goods if you were previously highly exposed to the Russian market. Okay, now it's the other side. Yes. Now, in terms of firms' performance, so this is the last set of results. This is the last set of results. I'm doing the same thing here, but with change in turnover and change in profitability. So what I see is that, no, this is the other side. Turnover, percentage change, well, for firms that were only having a low level of exposure to Russia, well, they even had a slight increase in their turnover. But for firms that were highly exposed, there was indeed a decrease in the turnover. The same for profitability, and this is also for the importers part.
I'm sorry, Nicola, you have one minute left, okay?
Yeah, this is the last slide basically before the conclusion. Just at the categorization level, this overall movements here, they are driven by the small set of firms, again, that are the most exposed. So for low level of exposure and average level of exposure, so all the firms that have, I think, below 25% of their turnover that is generating in Russia, there is basically no effect. And I'm going in the wrong side. And here I'm reaching the conclusion. So to come back to this, to sum it up, firms with low exposure to Russia, they are highly likely to exit the Russian markets. Overall, only the most impacted firms are impacted beyond trade, with a higher probability to shut down and also a higher probability to export to CIS countries, and a decrease in turnover and profitability. So ultimately, this is concentrated within a very small set of firms. The direct impact of the bite of sanctions on specific goods is of second-order importance. I'm talking here about the direct impact only. So whether or not you are directly shot by sanctions, but this can have obviously a scarecrow effect that is discouraging non-impacted firms to stop trading or at least to mitigate it. So this is more directly a second-order importance. Main limits, there are many. I have only the direct effect, I have only very short-term effects, and because of the design of the study, I only have firms trading with Russia before the war, so I'm not focusing on the part of trade that could have existed but is not existing because of the conditions and the sanctions and the war. And I now just have to say thank you very much for your attention, and I'm very looking forward to the discussion and the questions. Thank you very much.
Thank you very much, Nicola. I invite Hanna Onishingov from University of Michigan, I guess, but soon it will be Bank of England, right? Yeah, for the discussion. The floor is yours.
Okay. I will try to be very fast, not to keep you long from Rogoff and his keynote speech. I have a great privilege to discuss Nicholas's paper. It was exciting, and as for someone presenting it and discussing it in the central bank and giving my comments, I think would be really valuable for the broader course of the literature. So first of all, for those, I would like to give you a macroeconomic ideas about what are the trade sanctions and what is their importance in the world. Here is what is their share in the world. So here is the graph from the overview of development and international trade, WTO, its annual report, which says that there has been a sharp pickup in the amount of the imported goods which are in the world which are under import restrictive measures. That includes direct sanctions and other kind of measures. But what I want you to pay attention to that in the 2024, it reached $600 billion. And I looked quickly, it's GDP of Argentina. Right? So the amount of sanctions that builds up in this world is really big. And it's almost 2.5% of total world imports. And if you do a back of the envelope calculations, the trade sanctions, like just the sanctions as themselves, will be in between 0.9 to 1.9% of the total import. And given this huge importance, the question that we ask, what are the impact of these sanctions? Although sanctions, trade sanctions are sort of a straightforward instrument that's used by many countries as a tool for national security and their trade policies, they are sort of easy to implement if you have a political will. There is little known, little known about what is their impact on the overall economy and on the firms. And most research about sanctions is focused on the political effectiveness of sanctions, and fewer studies focused on Russian sanctions in 2014. And only now it builds up for 2022. And given the amount of empirical evidence, there is still a sharp need in the work about what are the mechanisms that drive these sanctions, economic mechanisms which make them effective, whether it's a supply chain disruptions, financial constraints like cut-off from SWIFT, or firm-level adaptations or potential cleansing effects. And given all of this, the Nicholas paper is a fascinating example of the paper that produces it focuses not only on one outcome, but provides evidence on many outcomes that could be potentially built up in one big paper about the mechanisms of the sanctions. Very briefly, I don't want to take time. So Nicholas' paper studies the Latvian firms and their response to 2022 Russia-related shocks. He puts together an amazing data set which every empirical economist would love to work with, which is the customs, financial, and employment data. And probably as people who work in central bank, you don't think what's up with that, but people who don't have access to this amazing data, just the sheer existence of them and possibility to work with them is a breakthrough for the trade economist or macroeconomist. They then employ a very ingenious and interesting approach using the machine learning to identify the truly affected firms, which is another innovation. And it's in line with the modern thing that people talk about, mixing up the machine learning with other sciences. And this paper showed that the firms with marginal exposures to Russia just quickly exit the market, and the firms that had big exposure largely keep training and staying in the business. However, for those firms, the firms that were largely exposed to it, their fork of the development was whether either to stay in the market or exit this market, not like the firms that had a lower exposure. The major losses for these firms comes from the employment and profitability. Given all of these results, I was left hungry for more, since you just have all of these amazing outcomes and you would love to build up a story. And that's what I will try to do with this discussion. So how could we interpret this firm's response to the sanctions? What indeed this exposure, besides the decision of trading with Russia, like why just a mere exposure would, what at the firm level would lead to this behavior? My take on this, it could be the proxy to the firm's productivity. It can be just a sheer trade dependency and the network effect, or maybe something else. But I would suggest to the audience and to Nicholas to look at the Melitz type of model. Melitz type of model is the most common trade model, which considers many sectors in many countries, and it allows many firms with different productivity. So a lot of heterogeneity, which could be nicely packed into a really closed form solution. That's why I suggest this model. And I looked up for several studies, and it would be indeed, the Melitz model would predict that the more productive firms are better able to reorient exports and remain on the market after sanctions. And I draw this conclusion from looking at the similar exercises with this kind of models, which consider different import tariffs. In this kind of model, sanctions could be modeled very closely to what is presented on empirical exercise. So, for example, the shock could be done, or analysis of the oh my gosh, I forgot the word. The scenario analysis could be done on two ways. The first one, you can introduce a productivity cutoff shock, which could be the counterpart of that in the empirical analysis would be the targeted good specific sanctions, what the Nicholas called bite. So you can introduce the cutoff into a certain sector in the targeted economy. The other one, the counterpart for exposure or broad-based sanctions, can be an increase in variable trade cost for the group of firms within the economy. The interesting part, although, as I said, some predictions about the exit of the firm could already be drawn from the previous studies, what will remain unknown is what would this model imply about the employment and wages and at the firm and at the aggregate level, which would be important for the central bank. The other thing is why model would be really helpful is that there is a macroeconomic effects which are indeed very complex. From the one side, sanctions force the firms out of the market, increasing unemployment. But from other side, the most productive firms will remain on the market, which means that for the whole economy, for the recovery in the long run, it's actually beneficial. Or the other thing that would matter for the whole economy are the sectoral composition and elasticity of substitution. And I know that it's a lot to ask from the empirical paper to provide the model. But as a reader, I would really benefit from having some back of the envelope calculations about the aggregate effect. So how do we add up together all this heterogeneous effect on the firms? What would be the next step? Like, what do we learn about that beyond their effectiveness? So this is my major comment. I have a set of some minor points. I was really moved by using the machine learning in this paper, and I think another robustness check which can be used in this paper is not only to predict the firms that would rather stay on the Russian market, but try to predict firms that would, in the outside scenario, actually move and enter in the Russian market. For that, the empirical specification, you will again predict which firms potentially could enter Russian market, and you use the analog of the bite for those firms. Obviously, exposure is not available, it will be zero. But for example, having a regression on the left-hand side where the firm actually entered the market or not, and on the right-hand side, what proportion of the export of this firm would be under sanctions, it would be another twist on accounting and estimating the effect of the sanctions on the firms. The other question that I had is that looking at the CIS rerouting analysis, looking at the starking result that firms actually start to trade with CIS countries, trying to avoid circumvent the sanction. Nicholas in his paper focuses only on those who had never had a prior trade relationship with that countries. From my point of view, it would be also interesting to look to the firms that actually had them, because rerouting would be so much easier. And there is this anecdotal evidence about the Land Rover company, the company that produces Land Rovers, that started to trade their Land Rovers to Russia through Georgia, because they had salons both in Russia and Georgia. And so just looking at that subset of the firms, I bet their rerouting will be off charts. And if not, then that's a question, why not? The last comment would be about adding additional controls to the standard of the literature. Most of the papers that I see about the firm behavior would have control for the firm size, leverage, or liquidity of those firms, or their sales growth, which in this case linked to turnover. And just like having them, maybe they wouldn't change the main result, but just having them as a robustness check would be really beneficial, I think, for the paper and making it clearer for the reader. I really enjoyed the discussion about the employment and wages. A deeper discussion about the employment and wages outcome would also be another nice twist. Wages were not, as Nicola mentioned that he has a data, so having a block about not only about the firm employment, but where these people go. Are they permanently exiting into unemployment? Are they switching into the other industries? And what happens to their wages would be also good and of general audience interest. And the very minor comment is that consider clustering standard errors at the sector level of robustness, because sectors were affected, and there is a correlation and a correlation in exposure based on sectors. So that would be just like another robustness check. Wrapping up, I think this paper tackles like a really important and really timely question, which has a growing importance. Losing the overall in the world GDP of Argentina is not good. And it's important not only for policy, but also for research. I'm at all with the data set, impressively rich, very well constructed. I don't know how much time it took. Kudos for that. And my main thoughts are that some theoretical framing of the paper would, or like some add-on about aggregate implication would really make it more compelling, and for those readers who are hungry for more would be satisfied and just sleep well without thinking about that at night. And as the people say, a few robustness check never hurt anybody. So yeah, if you would like that, that would be great. Thank you, Nicholas. Sorry for rush discussion.
Thank you very much. Thank you very much. As we are running out of time, Nicola, do you want to have a short response to the discussion?
Well, I just have to say thank you very much. There are a lot of things to think about. I also feel that, yeah, from a theoretical part, it lacks a little bit of flesh from this part. Well, I think I should stop here and just thank you everyone, and Anna in particular. So thank you very much and have a good rest of the conference.
Thank you very much, Nicola. Thank you all the participants, and thank you all the speakers of this panel. And now I will pass the word to Yuri Gorodnichenko from University of Berkeley, but he also is an advisor to the governor of the National Bank of Ukraine. And I want Yuri to introduce the keynote speech that we have today.
Thank you very much, Alexander. Good day to everybody, and thanks for joining the conference. My name is Yuri Gorodnichenko. I'm a professor of economics at UC Berkeley, and I'm also an advisor to the National Bank of Ukraine. I'm very happy to introduce our keynote speaker today, Professor Kenneth Rogoff. He has long and most distinguished career in economics and policy making. He has been at Harvard since 1999, but he played many other roles elsewhere. For example, he was the chief economist at the International Monetary Fund in 2001, 2003. I think nearly everyone in this audience has used his textbook in international economics. I certainly did. He is a most prolific author, not only in terms of academic work, but also in terms of commenting on economic developments in the US and globally. For example, he contributed to various reports on Ukraine during the war and post-war reconstruction. I'm sure everybody in this room is most grateful for his continuous support of Ukraine. I could talk for a long time describing his many awards, prizes, accolades, including in chess. But in the interest of time, I will just mention his most recent book, How Dollar, Your Problem, an insider view of 7 turbulent decades of global finance and the road ahead. If you have not read it, I highly recommend it. I read it in one go. It's a great book. And without further ado, Professor Rogoff, the floor is yours.
Thank you so much, Yuri, and thank you to everyone. Sorry, just forgot the basics of turning off my phone. Thank you to everyone who's here. I'm sorry I'm not there in person, but I have certainly been working with Yuri and many of you who work together on reports on the Ukraine, and very important. And remarkably, particularly because of Yuri, not because of myself, I mean, I think the reports I've been very proud of, incredibly great analysis. I just saw the end of the last session where the author had to apologize for not having enough theory. I don't have any in this talk. I'm not actually using any slides. I have, I hope, a fun issue to talk about. I'm going to talk about the possible role of the euro in the future of the global currency system. So it certainly stems from this book that Yuri mentioned. I have in the background here that I was just published a little over a month ago. Although it's with a university press, they work like molasses. All my books are with university presses, and it means I wrote it, longer ago than that. But the book it covers a lot of ground, and I'll say that in a moment. But it certainly embodies, I think, research papers I'm very proud of. So there's work on China. The book has 6 chapters on China, but I have a 2025 paper in the Journal of International Economics with Yuan Chen Yang, and actually a couple other papers with her. It actually involves the underground economy. So that's important because cryptocurrencies, as I probably don't need to tell this audience, compete with paper currency in the underground economy. And there's a paper with Francesco Papata that's just in, again, this year in the Journal of the European Economic Association. And a couple of years ago, I had a paper with Carmen Reinhardt and Clemens, Graf von Luckner. Actually, Yuri was our editor at the Journal of Monetary Economics, and we're very grateful the paper was accepted, but showing that indeed cryptocurrencies are used in actual transactions in a significant way around the economy. And there's possibly, there are more papers I could list, but possibly the 2 most important beyond the China one is a paper about real interest rates that was in the August 2024 American Economic Review. I'll talk about that in a bit. And in the Quarterly Journal of Economics a few years ago with Carmen Reinhardt and Ethan Olszewski. So that's a rather long-winded apology. The last one was about exchange rate regimes. So that's a rather long-winded apology. So, it's funny, I get asked a lot, well, if not the dollar, what else? And I think it's the wrong way to look at things. The right way to look at things is what's the market share of the dollar and how much might that shrink in the coming years. So I actually argue, based following on the work, the QJE paper with Ilzitsky and Reinhardt, that in some ways, by our measure, the dollar actually peaked in 2015. There are other measures that go that way. There are other measures that go the other way. Reserves have been in continual decline, but there are other measures. Our measure we regard as a portmanteau measure. That means all-encompassing measure that looks at how central banks manage their exchange rates and argue that it's been going down. And probably the book was actually finished before I knew who would win the election. I was not particularly enthusiastic about the macroeconomic plans of either candidate, and I was concerned in both cases about challenges to Federal Reserve independence. But for sure, Donald Trump, with his April 2nd Liberation Day, has, well, I didn't pay him to do that, but if I had, it was very good for, it was very good for the thesis in my book. When you write an academic book, you're trying to write something that people might disagree with, but then in 5 or 10 years, they'll think was right. That's actually the ideal kind of academic paper. So Donald Trump maybe accelerated that process a little bit. We can talk about it. But circling back to the euro, people say, well, oh, it's got so many flaws. There's not a capital market union. German bunds is the closest substitute to the dollar, but there's only 10% as many German bunds as there are dollars outstanding. There's not a common fiscal policy, et cetera, et cetera. But I think the right way to look at it's not if the euro will pass the dollar. The right way to look at it is, will the euro gain market share? There's a tremendous amount of trade between Europe and Latin America, a tremendous amount of trade between Europe and Asia, and more of it could be dollar-denominated, more of the financial instruments, euro-denominated, more of the financial instruments, euro-denominated going forward. And why do I say that? It's not so much the euro. The euro hasn't gotten any better, and I'm going to come to that. Wow, it could. It hasn't. But the dollar's gotten worse. So I'm a big basketball fan, and I can well understand if you didn't follow this, but the Boston Celtics won the NBA championship last year, and they seemed on their way to winning it this year, but in the semifinals, they lost to New York's team, the New York Knicks, a much inferior team, because their 2 best players were injured. And that's how I'd look at the euro and the dollar. It's not that the euro suddenly become wonderful and all its flaws are fixed, but there are reasons that you might want to change. And a theme I'm going to pick up on momentarily is that part of becoming a broader currency and extending beyond just being a regional currency is building up military capacity, being a geopolitical power. It's actually a central piece of being an important global currency for reasons you might not think of. And so I actually have a lot in my book about that. And I had told a lot of people about this for years. I was actually very pleased to see a few weeks after my book came out, Christine Lagarde had a big speech, you may have seen it, that having geopolitical capacity, having military power is essential to making the euro a global currency. So I'm going to come back to that, of why that might be. I mean, for you, of course, there's some very obvious reasons, but I think there are some more subtle reasons. Let me just, there are a lot of reasons I wrote the book having to do with generally my frustration with the profession for looking at short-term trends and pretending they would go on forever. That, of course, is a theme of my work this time is different with Carmen Reinhardt. But just to pick a few examples, I think the most important one was this idea that real interest rates would get lower and lower and lower and lower. You must have seen some presentation by Larry Summers about secular stagnation, where he's now said it's over with, but he wasn't saying that when we were debating it again and again around the world 10 years ago. He was saying it would last forever. I was saying, no, I quote some things in the book. I said, nobody's going to be talking about it in 10 years. It's going to be forgotten in 10 years. Because if you look at the history of real interest rates, they're very volatile. And we're talking about long-term, 10-year, think of real interest rates, not short-term real interest rates. These are very, very volatile. They were zero in the 1930s, too. They were low at times. They've been high at times. But although there's a very slight trend, which might even be positive now, there's a very slight trend over the years. Basically, there's a lot of regression to mean in real interest rates. And you can look at, I'm not showing any tables, you can look at the 8th century graph that we have in our AER paper about real interest rates. But you can look at just the last couple hundred years, excuse me, it's really something that's quite striking. So that's an example where I think economists just pretend everything's changed. And there's so many papers about demographics, productivity, lower forever. Another example was that China would grow forever. And I had written papers now, 7 or 8 years ago, looking at their housing and real estate problems, academic papers looking at a very micro data of what was going on. That's another example. But the dollar is also one, that the idea that it's just going to get more and more and more powerful just because it's efficient to have one currency is silly. There are lots of reasons that hasn't happened over time, that there have been periods of multiple currencies, periods where things go up and down, and to think it could go on forever, I think is an overstatement. There are, it was already 10 years ago. So let me give a little history to put this in context. So the dollar was starting to become very important in the early late 1920s, maybe pulled ahead of the pound, but then we defaulted on our debt. Yes, we defaulted on our debt in 1933. That's not really subject to debate, even though it is. Our Supreme Court ruled that. The price of gold was $20 an ounce, and not overnight, but over a short period, our president said, no, $35 an ounce. Now, if Argentina did that, I heard that mentioned at the end of the last discussion, we'd kind of call it a default. And if you were in England or you were India or any of the countries holding large amounts of dollars, you would have thought that was a default. Of course it was. And the share of dollars in reserve fell from 60 to 20% fairly quickly after that. Then it rebuilt when the Bretton Woods system was formed after World War II, which put the dollar at the center of, I'm going to use in parentheses, global system, where the European, Japan, Canada, the countries in the system had to peg their exchange rates to the dollar, and they had to hold very large amounts of dollar reserves in order to do that, in some ways eventually reaching the same kind of levels that the Asian countries have today, trillions and trillions of dollars. But then but the US could do whatever it wanted, but we had to trade the dollars for gold. We had to give people gold for dollars if they asked for it. Not individuals, but countries. And that system rolled along for a long time. It wasn't really sustainable because the US gold supply was limited. The European countries, Japan, were growing very fast. The United States is very, very good at printing dollars. We did a good job of that, but we didn't have the gold to pay for the dollars. And so it became apparent to economists, most famously Robert Triffin, that this was subject to the mother of all runs if the countries of the world didn't go along with it. And but I don't think anyone quite knew when an end was coming. Triffin predicted that actually in 1959. And in 1971, I think the typical expert you can find some discussion thought it would go on for another 10 or 20 years, that it would last. But Nixon said, nope, you can't do it anymore. You can't have gold for your dollars. And the Europeans were furious, of course, as was everyone. And they went, Nixon sent his Treasury Secretary, John R. Connolly, he's a Texan, you can read about him. He went to Rome, and the Europeans are saying, what are we going to do with our money? What are we going to do with our dollars? And Connolly said, well, it's our dollar, it's your problem. And that speaks to me because I don't like the arrogance of it. I'm very proud to be an American, but I think the arrogance is not a good way to have allies and to cooperate. But also the irony, because we hadn't yet invented the idea of independent central banks and inflation targeting. And we were lost in the wilderness. We had inflation for a long time. I have a lot in the book about central bank independence, inflation targeting. I think I wrote the first paper on this back in the early 1980s when the idea of having an institution that was independent was considered insane. And by the way, I couldn't get my paper published. It was rejected at all the journals. I got a note from Robert Barrow, who was one of the people who influenced me. He believed in having a rule. He said, well, something to the effect of, the institution's just a veil. The government can just, fire the head of the central bank and do whatever it wants any day. I think there are frictions in these institutions that are important. It took us time to figure it out. But that wasn't good for the dollar either. The dollar, there are a lot of different measures, but the dollar reserves fell dramatically. They fell from maybe 70% of reserves to 50% of reserves over the next 15 years. Not only that, but I said that the world was orbiting around the dollar. It's not exactly true. The advanced countries were orbiting around the dollar. The rest of the world was not globalized. China wasn't globalized. The Soviet Union was doing its own thing. India was essentially a closed economy. Latin America had the Rao-Prebisch theory that you should have huge protection, and they were very close. I could go on and on. It wasn't really that much of the world, if you look at a map, that was in the Bretton Woods system. When we went off in 1971, the US lost Europe. It never came back. It never came back to the dollar. And I think when you look at today and Liberation Day and Donald Trump, I think what you're going to see at the end of this is China certainly going to delink from the dollar. It's been happening slowly. Now it's happening much faster. The Chinese are well aware of what the world did to the Russians, and applause to the world for doing that. But the sanction, not just the sanctions, but the seizing of Russian central bank assets, and I think some of you in the audience have written about that. That's very, very important. But if you're China, the Russian assets were at least estimated to be from 300 to 350 billion. China, at least as of the beginning of this year, probably held $2 trillion in assets. That's an estimate I give in the book based on the graduate student, Matthew Ferrante, did a thesis that tried to estimate this, but it's a very large number. They're looking at that, and they're looking at the sanctions. And so they're taking a lot of steps to move away. And then those are the problems and Europe's not very happy with the status quo either, because it gives the United States just too much power. And on the inside, I won't get into it, but the US fiscal deficit is unsustainable. It's a complex question. I don't want to trivialize it. But basically, the fact that the interest rates have not gone down, as Paul Krugman, Larry Summers, Olivier Blanchard, I could go on and on, many journal articles, In fact, I can count 15 articles in the top journals claiming they were going to go down forever. Might not be true. Maybe they'll be true, but might not be true. Now they've risen the last few years. U.S. interest payments, you again may be aware, they were just a few $100 billion 2.5, 3 years ago. They're now hitting $1 trillion. They're more than our defense spending, and they're going to continue to rise. Even if interest rates stay constant, they're going to continue to rise as the U.S. rolls over debt. So that's been a big change. It's a vulnerability. And we can talk about Federal Reserve independence, which everybody reads about Trump, but as someone who teaches at Harvard and has good connections to progressive economists who advise politicians, they all want to get rid of Fed independence too. So there are challenges. Okay, I could go on. And then there's Liberation Day, which, tariffs are not as crazy as one might think. I don't favor it. Oleg Skokie and Dmitry Mukin have an interesting recent paper you may have seen talking about the optimal tariff, which they said could be 10% for the United States, although they note that involves a lot of assumptions and, of course, no retaliation when I promise you eventually there will be retaliation. Okay, let's come to the euro. So right now, clearly the RMB is going to break off. And I think the big picture on what happens here is that Nixon was Europe breaking away and lost forever to the dollar. And I think something broadly similar is going to happen over the next 10 years with the renminbi. It's not going to become an international currency. The euro has not yet, not really. But it is going to be a regional currency in Asia, and Asia is huge. Asia, using the metric that Pilsudski and Reinhardt and I have in our QJE paper, is half the dollar block. So it's potentially a big deal. Why is there room? Why is there room for Europe? Well, I gave the example of the Boston Celtics. Just everybody's looking for something, and there's so I think Europe will benefit no matter what. But if you ask what are things Europe could do, there are, I think, a few obvious ones. So first and foremost, they need a capital markets union. And I know you've heard that before, but let me just explain it to you. Forgive me for, some of you in the audience might not be specialists in this. If you want to have an integrated bond market, a genuinely integrated bond market, forget about a euro bond. I'm not even talking about that, but you want, I don't know, one of the big European companies, LMVH, that's a fashion company. Most of the big European companies right now are fashion companies, which is a little embarrassing, but it's true. If you want LMVH to issue a bond across all the countries, it's very helpful to have a common bankruptcy law so that if you're heard by a judge in Spain, he may have a different interpretation. The judge in Spain may favor the Spanish creditors. That happens in the US, but at least it's the same law that they're being governed by. That's not the case. They have not agreed to that. This is crazy. And so that's a big change that eventually needs to take place in Europe. Another thing that needs to take place in Europe for the Europe to do even better, again, I want to be clear, the euro is going to gain against the dollar if Europe does nothing. The US is worse. People are looking for diversification. Another thing is certainly issue a euro bond. Olivier Blanchard issued a paper with the Peterson Institute, I think 3 weeks ago, suggesting to convert a significant amount of European debt into euro bonds to create liquidity. I think he picked 25%. And that would also create conditions where it would be easier for Europe to issue more bonds. Now, this isn't an original idea. I think some of you may know the Bruegel Institute in Belgium had an idea 15 years ago or something like that for red bonds, blue bonds. I don't know if any of you have seen this, but anyway, I teach this regularly in my course. It's kind of fun to debate about. Bruegel had a plan very, very much like Olivier's to pick 60%. I think the 60% is a non-starter, so Olivier was smart to pick 25%. And even if they pick 15% or 10%, I think this is helpful to have a liquid market. One of the things that makes the dollar so potent is the huge, huge liquidity of US markets. So that's an area Europe can strengthen. There are limits to it because there's not yet a common fiscal policy. If to have a common fiscal policy, you need to have the European Parliament do more than just pass regulations, which it passes too many of. You need to have it have some fiscal power, and so, but there's room to just improve. Not necessarily to reinvent Europe, but to improve. And of course, there's this necessity of remilitarizing in Europe. That's an absolute necessity. I think if you think this is entirely a Donald Trump phenomenon, I regret to report to you that's wrong. It's an American voter phenomenon. If Harris, who by now many people have even forgotten who she was, but she was the candidate running against Donald Trump in the election, she would have cut the U.S. defense budget. That was part of her agenda. That's what Biden was cutting it every year. And the U.S. doesn't have the reach to cover the Middle East, to cover Taiwan and the South China Sea, which I think the U.S. regards as very important, and also to reach into Europe. Europe was going to have to defend itself. And these, as my book states, and I think I've seen in some places, these figures of reaching 2% of GDP, it's a joke. I mean, if Europe doesn't just have current expenditures, it needs to make up for years of deferred investment, deferred research and development. But on the bright side of this, since it has to be done anyway, I think it will have quite an influence on Europe as the euro as a more international currency. So why do I say this? Well, the obvious thing is your money's safer in a place that can defend itself. You just feel safer. It's common sense. There are more subtle reasons, though. And I would say also, if you're a country that has a regional security arrangement with Europe, you'd feel better if you're more likely to hold reserves with Europe, given a regional security arrangement. They're connected, how your reserves will be respected. But I think the big things, or maybe the biggest single thing, something completely different. That military power gives the United States disproportionate ability to make the rules of the game. So with Donald Trump, it's just very transparent. He'll say to a country, I don't like what you're doing. And if you don't obeying my free speech laws, you're taxing the US companies too much. If you're too woke for Donald Trump, I don't know, I'm throwing that out sarcastically, but just whatever comes to his mind, maybe he won't defend you anymore. He uses it, and absolutely uses it in negotiations over the global financial system. And the United States has done that for years. Donald Trump's very crude and direct, but if you listen to the Watergate tapes, that was Richard Nixon, he taping all the conversations in the White House there now, except for the ones he destroyed. A lot of them have been released. You can see him saying some similar things. Lyndon Johnson, if you look at his memoirs and biographies of him, of course we do. Of course we use that. We say, okay, let's negotiate over how the IMF will be organized. Let's negotiate over how the rails of the global financial system will work. Let's have a big common discussion. But having the military power makes a big difference. And I think as Europe is able to assert itself more militarily, it will make a difference. In the chapter on my book I give a lot of the benefits of being the reserve currency, and they're familiar to you, but being able to impose sanctions is one, being able to get lower interest rates is one. I also talk about the costs, and I list military as a cost. Now, you can sort of debate, well, how much of it are you doing because you need to defend yourself anyway? How much of it are you doing because you are want to be the global currency? I don't think you can ignore the latter. So if you look at discussions of why we should strengthen our military, particularly when they're being sold to the Senate and the House in the United States, very frequently they mention, thanks to our strong military, we're getting lower interest rates. We're getting a stronger dollar. It's a lot of money. I mean, it's the exorbitant privilege that the United States gets is anywhere from 0.5% to 1% a year. But this applies to all debt, mortgage debt, car loans. So you can easily get a figure on the same order of magnitude as what we spend on military. And there's room potentially for Europe to share that. So I don't pretend any of these things are easy, and I'm not someone who says the dollar is going out of business. Rather, I think we're moving towards a more tripolar system, maybe a fourth being crypto in the underground economy. We're moving towards a more tripolar system where the dollar might be first, but it's coming down. And, if you had this conference 20 years ago, that's actually what everyone was saying. Barry Eichengreen, Jeff Frankel, many, many other papers written about this. Everybody thought the euro was going to do great. They thought the euro would get some exorbitant privilege. Nobody thought China would be pegging to the dollar for as long as it did. It sort of slowed down in 2015. And in fact, because of China's choices, which I think are idiosyncratic to their president, because Europe admitted Greece into the euro prematurely, the dollar just rose and rose. And I think a lot of that is now unwinding and possibly more. Finally, I think if you look at the history of the United States and the dollar, the United States is a great country. It's a great economy. Many of you are, written about it or exposed to that. We've also been lucky in a number of ways. We were, I think, lucky that the Russia and the Soviet Union managed itself as badly as it did. It could have been more like China. There was a moment in the mid-'60s that seemed possible. Certainly, we were lucky with Japan. Japan was, if I can use Trumpian language, kicking our ass in the 1980s. Japan's stock market was worth more than the US stock market by the late 1980s. The Japanese housing stock was worth more than the US housing stock, much, much more at the end of the 1980s. Now you say, well, that's a joke. Japan could never compete with the United States. It's nonsense. Well, that's silly. I mean, the UK ruled the world with a much, it's an island nation, small nation. And even before them, the Dutch, which are truly tiny nation, was the global currency in the 1600s. Japan was at that they're a third the population of the US, but at that time they were half. And I think Japan made some huge mistakes, but the number one mistake was agreeing to this rapid deregulation and appreciation of their currency. I write about it. That's an area, by the way, I think it's important for economists to admit their mistakes. I, for years, said that was nonsense. That had nothing to do with the United States. The Plaza Accord was in 1985, and Japan didn't really fall apart till 1992. But I come to think differently over time. Certainly in other examples, Europe, I mentioned Europe admitting Greece into the euro. Europe would have a larger global footprint. The euro would be a larger share of reserves. Europe would just in general not have gone through a severe crisis, but for what happened in the with admitting Greece. You can pick other countries, but I think particularly prematurely admitting Greece, which made it hard to work on. I apologize to Greek colleagues, but I think you know it's true. And China has made some wrong choices. They're in a lot of hot water now, and I talk about them. So I think there's a sense in which the United States has been good, but it's also been lucky. It didn't have to be. And I think certainly with the Trump regime, and I'm not political at all, and my book's not political, but okay, I mean, this doesn't feel like a lucky moment for the United States. It feels like a moment when our institutions are under assault. The United States, having your money is not safe in the United States the way that it once was. Nothing in the world is really the same. So this is an opportunity for Europe. I was very glad to see Christine Lagarde really step in. But I forgot to mention, Europe's moving way ahead on having a central bank digital currency. I know Ukraine's very advanced in digitalizing many things, but the United States isn't even trying. In fact, Donald Trump has forbid the Federal Reserve from even studying the issue right now. I don't know how you do that. But Europe has shifted from just looking at a wholesale digital currency, which between banks and financial firms, to looking at a retail digital currency. So China's doing that too. And both China and Europe are talking about how they can internationalize it, how you can do payments. And I think a thing a lot of people miss about that is that it's another completely separate mechanism for doing transactions outside the eyes of US authorities. That it's not just a question of what do you denominate transactions in, how are they executed, how does the information exchange? And these are things other countries are looking at. So why don't I stop here, if that's okay, Yuri, and maybe take questions. I apologize that this isn't in the class of really great papers that you're getting in the style of this presentation. My book is sort of in between, I would say, of trying to be very accessible and even entertaining, but there's a certain amount of heavy material in it as well, which I didn't bring here.
Thank you, Ken. This was great. I will use my privilege as the moderator to ask a few questions myself, and then ask people from the audience to contribute their questions. If you're online, please type your questions in the Q&A or in the chat. I see Nicola Vernon has a question about the immobilized foreign reserves of Russia, and I had a similar question about that. We know it's a lot of money. You mentioned $300 billion, maybe $350 billion. Most of this is in Europe, and Ukraine has been asking to seize these assets and transfer these resources to Ukraine to buy weapons, to support the economy, and also potentially finance reconstruction of Ukraine after the war. Now, one concern we often hear is that this is going to be a bad policy move because this is going to undermine the euro as a global currency, right? So people kind of flee the dollar because they're worried that Donald Trump or somebody else can unilaterally, freeze assets, seize assets, sort of arbitrary policies. What are your thoughts on this matter? What should Europe do about that?
Well, I think Yuri, because we talked about it when we were doing our report, that I feel Europe should just give Ukraine the money, not the Russian money, just give them the money. They can do what they want with the assets. If Europe wants to pay itself back, it can do it. It can decide what's optimal. It's not such a large amount of money in the scheme of things for Europe. I do think it's a delicate question. I don't think it's a no-brainer that you take it away. Countries over history have typically, the policies have been mixed, whether they default on debt to foreign combatants. So I'm going to take a second to tell a story about my book in 2009 with Carmen Reinhardt. Before we published the book, we released a number of papers giving our default dates, and we sent it to scholars all over. Is this right? Are we missing anything? And we didn't send it to central banks. We didn't send it to finance ministers, but we got a letter from the number 3 at the Bank of Japan, not the Bank of Japan, the Finance Ministry of Japan, a very powerful person who manages their foreign exchange reserves and their debt. He is the debt manager. And he said, this is wrong. We did not default in World War II. This never happened. And we said, well, Moody's and Standard & Poor list you as having defaulted. And he said, well, they're wrong. And so then we produced, first of all, this huge, bold headline from the December 1941 New York Times, Japan defaults on its debt to the US. And then we also produced secondary prices from a few years later of showing the Japanese debt selling at 5 cents on the dollar. And he finally conceded, well, okay, maybe we defaulted, but only to our enemies. And I'm telling that as a bit, a quip, but also there's mixed behavior about that over time. But Europe has to decide what's in Europe's interests. But it can, if ultimately it gives the money to Ukraine and then gets sued by Russia, finds it has to pay the money back over some peace agreement, it'll have to pay the money back. I would favor just giving money out of European taxpayers to Ukraine and telling Europe's taxpayers, we view this as backed by the Russian assets, and then they can negotiate it out.
Thank you. Alexander Farina has a question from the audience. Alexander.
Yes, Professor Rogoff, thank you very much. So we have a question here from the audience, and I will read it out loud for you. So, Professor Rogoff, you have emphasized that the strength of the US dollar depends not only on macroeconomic fundamentals, but also on America's global leadership and credibility. So now, the current debate about the seizing Russia's assets bring this into sharp focus. On the one hand, such a move risks undermining global trust in the dollar and accelerating de-dollarization. But on the other hand, failing to act decisively could be seen as a retreat of Western leadership and deterrence. How do you assess this trade-off between preserving the dollar's dominance and asserting geopolitical credibility?
Well, I mean, it's a difficult question. My same student that I mentioned, Matthew Ferrante, who graduated this year, had a paper, and I also think I've seen one in the NBR at some point about having the theme that part of providing financial leadership is punishing bad behavior. And so therefore selectively defaulting on countries which misbehave may in fact lead to a better system and strengthen confidence in the US dollar. There are papers that make that case. But again, Ukraine needs the money now, not in 10 years. And so what I would favor doing, it's a lot of money for Ukraine. It's not a lot of money for the United States or Europe. It's really not. And I would favor, I'm not talking about politically, I'm talking about economically. I would favor just giving Ukraine the money, telling the voters whatever they want to hear, and then making a decision over the longer term, depending on what surrender/peace terms Russia comes to. There's a symbolic act, certainly, to seizing the assets and saying it's Russia's money, but I think it's sort of 6 of one and half a dozen of the other. The important thing is to get the money to Ukraine, no matter how Europe does it or the United States does it. The peace treaty that comes eventually, surrender, we hope, treaty that comes afterwards, of course this will have some discussion in it, and they can renegotiate at that time. But I wouldn't leave it on Ukraine either gets the money or doesn't get the money, depending on the interpretation of that. Ukraine deserves the support and should get it now, and we should give it. And I would say especially Europe should give it. I regard part of what has happened here is that Europe had dereliction of duty in failing to provide adequate military and needs to correct that. And also in many ways is, the one through Ukraine's part of Europe. And so I would favor having Europe pay it, but Europe and the US can negotiate that. But Ukraine should get the money, but exactly how it's presented and how it's labeled, I think is secondary. And Yuri knows I push very hard for saying something like that in our reports.
Thank you very much for the answer. We also have another question.
Yeah, please, Alexander.
Yes, we have a question from Hanna Onyshenko from University of Michigan.
Hi, Kenneth. Thank you very much. I have slightly provocative and speculative question. So there are two events that could be considered in the nearest future in the US, is the big, beautiful bill passing the Senate, as well as a probable or not probable change of a head of central bank, as Trump attacked him several times along this year. Would you think that these two events happening at the same time, would they give a chance to euro as a global currency? And I mean, we've seen what happened in UK when they tried to cut taxes, and they rolled back on that. But do you think that would be a fair shot for euro if that happens?
Well, I've been have a lot about this in my book, even though I didn't know about Trump. And I think I've had an op-ed in the Wall Street Journal and the FT about the big, beautiful bill, which is, basically part of it is just keeping Trump one, but a lot of it is just campaign promises that are stupid and costly. So what's most surprising about Trump's bill, most of you wouldn't have looked at it closely. I'm not claiming I have. I think it's 1,000 pages. But most of what would surprise you is if you listen to his campaign, aside from the open borders and DEI, Biden's biggest crime was huge deficits that caused inflation. You heard that again and again. There was one campaign ad after another. And just as a point of fact, the last year of Biden's presidency, 2024, had a deficit of 6.4% of GDP, a record in peacetime outside the depth of the 2008, at the beginning of the global financial crisis in 2008, at the beginning of the pandemic in 2020. Trump is almost certainly going to exceed the 6.4%. It looks like even on the most optimistic, unrealistic assumptions, his deficits will be 7% of GDP. If you asked me in January, when I was already concerned about Trump's macroeconomics, if that was going to happen, I'd have said, you've got to be kidding. I mean, of course he's going to bring it down, and he's not. So I think we'll see what happens to bond markets. It hasn't been passed. I assume it's going to be passed. Trump still rules the Republican Party with an iron fist, and I see some changes. I've heard certainly that a number of senators are upset about it. They need to sign up, but what are they going to do? I mean, I think the Republican talking point is going to be, well, if Harris was president, it would be worse. That seems to be their talking point. On the Federal Reserve, it's a very interesting moment. Central bank independence is it's a convention. It's not in the Constitution, not in the United States. That's actually sometimes a handicap for Europe, but sometimes it's a benefit. If the United States wanted, if Congress agreed, we could just eliminate the Fed in a week and bring it into the Treasury. When I wrote my paper that was in the early 1980s on central bank independence, almost no central bank was independent. They were all under their treasury of their country. They were a unit of the treasury, which of course, from an accounting point of view, the central bank is a unit of the treasury, which, by the way, it blows my mind how many people don't understand that, but that's a fact. So it can easily be done. The Democrats, the progressives, want to do that. The journals are filled with ideas about that. So I notice a change in the screen. Have I gone away, or am I still?
No. We have 10 more minutes.
Yes, sorry, it's a technical issue here. Sorry.
No worries. I sort of like maybe a crude way to tell me to shut up, but
no. Keep talking, please.
Yeah. So, and there, so that's the Federal Reserve is a creature of Congress, but also you could cut its budget by 90%. He could do that even more easily than cutting Harvard's budget. Vivek Ramaswamy, who was a presidential candidate, he's running for Senate in Ohio now. He had an article in the Wall Street Journal, and a lot of people applauded. Why are they having research? They're using their research to look at inequality in the environment. This is nonsense. And he could cut the budget. That would be a lot of leverage. And most of all, he could add members to the Federal Reserve. There's nothing that prevents him. That's a very small thing. You might not be aware of this, but Franklin Roosevelt threatened to do that to our Supreme Court in the 1930s because the Supreme Court was about to rule that he had defaulted on their debt, which they did. And he intimidated the Supreme Court into ruling that although it was a default, they didn't give in on that, there were no damages. Now, I don't know what they meant by there were no, they awarded $1 to the creditors. And Elizabeth Warren and a number of the progressives, Ocasio-Cortez, they want to add members to the Supreme Court in order to make majorities. It's an incredibly stupid idea because it creates a cycle every time the Senate changes, the Supreme Court keeps growing. But you think that's harder to do for the Supreme Court than for the Federal Reserve? You're crazy. It's easy to do. So he's not just going to do it because he wakes up at 3 a.m. and nobody can calm him down. That's not going to happen. But if we're stressed, say the U.S. enters the war in the Middle East and it turns out to go sideways and be much more expensive than anyone expected, and then China starts doing something, seeing that the United States is distracted in the Middle East, and suddenly expenditures start rising, budget pressures start, other possibilities, cyber war, climate shock, under stress, of course Trump would do that. And I think Harris would do it too. So Federal Reserve independence is a problem that I don't think people fully absorbed. That said, the person that's still in the lead for the Federal Reserve is Kevin Warsh, who is quite conservative. I mean, he's not an inflation, he's not pro-inflation. He's more hawkish than Jay Powell. And Jay Powell's been, I think, pretty centrist. And I think the other person who's sort of a leading name for the jobs, Kevin Hassett, I think he's a very good economist. He's more political at the moment than Kevin. But, I mean, he's certainly not somebody who just loves inflation either. So I think it would take a more fundamental change where Trump really takes over the reins, where he really does what he wants to do. And I think I think that's possible because if my book predicts that that's a likely thing to happen over the next 5 to 7 years, getting a burst of inflation. I have to say, after Liberation Day, I'm now saying 4 to 5 years. Yeah, it's a worrisome situation. And going back to Europe and the dollar, that was your question. Of course, it's an opportunity for Europe.
I have a question for you to follow up on what you just said. One central theme you have in the book and in this lecture is that the fortunes of dominant currencies are changing. We had pound, we have dollar, before we had pieces of aid from Spain and so on. In the book, you have this great map where you show that countries are joining and leaving the dollar bloc. Ukraine, I think, is in the dollar bloc now. But one question that keeps coming up in Ukraine and more generally in the discussions about the European Union aspirations of Ukraine, when would be a good time for Ukraine to switch sides, so to say, and move from the dollar bloc to the euro bloc?
It's a really interesting question. I mean, I think clearly it should be in the eventually be in the euro bloc because all its neighboring countries are, and its trade and a lot of its support will be in the euro bloc. So I think the euro is going to appreciate against the dollar over the next year or two. And exchange rates are very hard to forecast, but when they're way out of line, they tend to move. I think the yen is crazy low at the moment, and the dollar, even though it's come off by 8 or 10%, still very high. So in managing your foreign exchange reserves, I would certainly be in the euro. But I mean, I think this is a second order question at the moment because I think if you just change now, people would ask, why are you doing it? What don't we know? What is the secret information that the Ukraine central bank has that we don't know? So I think you need to pick an opportune time to do it, but possibly you could do it as part of negotiations when Europe gives Ukraine a large amount of money, perhaps for post-war reconstruction. You could say, because Europe's giving us a large amount of money, it now makes sense to switch to the euro. You need to give a good reason why you're doing it. You need to explain the timing, because otherwise, as Yuri, no one trusts anything that the government says and wonders what was going on. But it's a really good question.
Thank you. We're almost out of time. I want to thank you for taking the time and join us and give this wonderful lecture. Thank you so much. And I hope to see you one day in Kyiv. Thank you.
Indeed. So thank you very much. And I look forward to coming.
Thank you.
Thank you very much. Now we have a break, and the coffee break will be in the same place where we had lunch. So see you here in 30 minutes. of the NBU Council and a good friend of ours. Victor, please, the floor is yours.
Thank you, Alexander. Dear colleagues, it's a great pleasure to be here. As you know, all conference of National Bank of Ukraine, it's a great scientific event in our country, and we are really happy to have here our friends, our colleagues from central banking areas, from academia. And I also very thankful for audience, because it is very hard to be under such energetic pressure during these days, and thank you for you all for your interest. Our section devoted to the problem of how globalization is evolving, what the future of globalization, and what the current driving forces that are reshaping globalization. But before we start, I would like to ask a question. Do we satisfied with the globalization? Or it's better to say, were we satisfied with the globalization 5 years ago, 10 years ago, or 20 years ago? It is very hard to answer, actually. And I also propose to remind the Joseph Stiglitz book that was titled Globalization and its Discontent. There he described very vulnerable topics that echoed in recent events. But having in mind the Stiglitz approach that blamed globalization, we also should remind Acemoglu and Robinson approach on the globalization. There was found a strong positive pressure toward democratization. They propose a lot of very interesting formal models that describe how globalization may really bring additional pressure in terms of democratization. But what we can see now, which political regimes accrued the most benefits of globalization? The very simple answer is autocracies. China gained incredible benefits from the globalization. The same to Vietnam, the same to Moscovia, the same to Saudi Arabia. All that countries that gain incredible wealth on globalized world are not democracies. So we should ask the question, do we satisfied with such kind of globalization? And also we should ask the question, the globalization is blamed that it's neoliberal, but can we name such kind of globalization as a neoliberal? I guess not. But anyway, following the discussion about role of technology and role of openness in strong asymmetries in the welfare distribution due to openness, we should raise the question, what drove really large and incredible distribution or distortions in wealth distribution across the countries and even within the countries? Is it because of globalization, or is it just because of technology? Is it because of openness to trade, or it's because of fabrication moving to the low countries with the low labor costs? It is very hard to distinguish the benefits from globalization and benefits from the technological advances. Why? Because technological advances are scaled up in the globalized world. Next problem. Does the globalization break up due to strategic autonomy or autarkic decisions by key players? What can we see during the recent time is that globalization is slowed down, but global economy still on the record. Because some sort of new kind of connective countries occur, like Mexico, like Vietnam, and United Arab Emirates became a new offshore center. And also we may see that this really reshape the geographical structure of global flows. And of course, this is the driving forces that require deep and comprehensive thinking about. And I suppose our session is one of the contributions to make an answer, make a deeper understanding of what is going on in the globalized world. So let me introduce our first speaker. It's Krzysztof Makarski from Narodowy Bank Polski, and his presentation, Monetary Integration on the Household Heterogeneity and Bound Internationality. I also would like to propose the next timetable, 20 minutes for main presenter and 10 minutes for discutant, after audience may have an opportunity to ask a question. Thank you. So, Krzysztof, the floor is yours.
You don't have slides? They don't have presentation.
I see with some technical challenges, and we propose some changes in the presentation lineup. So sorry, and maybe it is better start from women, or particular very young researcher from National Bank of Ukraine, Olga Bondarenko, with the paper Shockwaves from Ukraine, Trends and Gaps in Agricultural Commodity Prices. Please. Aurelia, do you hear us? You with us?
Hello, can you hear me?
Yes. We have some technical problems and we propose you to start. Are you ready?
Okay, let's try. All right, so let me then share my slides with you first, and then I can hopefully fill in the technical gaps.
Okay, Aurelia, we may see you. So,
yeah.
Aurelia Proskuta from Bank of Lithuania and Vilnius University. The topic is intermediaries in international trade, managing sanctions and geoeconomic fragmentation.
Right.
So please.
Can you see my slides? Can you please confirm?
Not.
Okay. Let me try again. If I share my screen and then
we saw
window,
it a second
let's
ago.
See. Is it okay now?
Yes, yes. Now it's okay.
All right. Okay. And is it full screen?
Yes, now it's okay.
Is it okay?
Now, yeah. So thank you.
Fantastic. Okay, all right. So, well, first of all, thanks for including our paper on the program. It's a great pity I couldn't be in Kiev today. But well, hopefully this online form will not prevent me from giving my key messages or our key messages of myself and co-authors. So this paper is co-authored together with Povlas Lastauskas and Alminas Žaldokas, and I'm from the Bank of Lithuania. Therefore, the usual disclaimer applies. The views are only those of ours and not of the bank or the fund itself. So today I'm going to present and hopefully find out and share with you the situation in which we analyze how do the trade patterns shift when political alignment changes. In particular, we are interested in how sanctions and the geopolitical polarization that happens after that among the countries is affecting the reputational risks and how those reputational risks are affecting the trade relocation across the sectors. So today I will be talking a lot about intermediaries, or sometimes I would be using wholesale or indirect exporting as synonyms. Similarly, manufacturing or producer sector will be synonyms when I'm talking about direct exporting by the firms to some other markets. And then empirically, we will be focusing on the 2014 Russia sanctions, when Russia banned a number of products to be imported to Russia from that was a geopolitically motivated trade shock. So basically all the EU countries, US and some other ally countries for the selected list of products could not be exporting the production to Russia. And then we analyze how that affected the sectoral trade patterns for the trading economy. That is Lithuania. And then we also build a theoretical model to back up our empirical findings. And we show that overall and sectoral trade is affected by relative fixed and variable trade cost shocks. And we will be looking into two indicators in particular, that is openness, so how much overall the country is trading, and then share, how much the relative trade flows, so direct or production, exports as a share of indirect or intermediation sector exports change. In our paper, we find a more nuanced role for intermediation in terms of trade shock absorption. So I'll be a bit more specific in a minute. But before that, let me just briefly touch upon the literature that we are contributing to. So, of course, first of all, this is talking about intermediation and international trade and all those models that started by incorporating intermediation technology into canonical Melitz models. So we contribute to that literature. In addition, we highlight the role of a feedback loop mechanism between intermediation and production sectors, and the double marginalization that we will have in the model will produce a more nuanced trade outcomes than in the papers that I'm citing there. Then we will be also, of course, contributing to trade wars and trade sanctions literature. So this 2014 episode, the 2014 Russia trade ban episode, has already been analyzed in a number of papers, both in terms of its macroeconomic outcomes, and you see the list of papers there, but also in terms of some firm level outcomes, and some examples are there. Here in this paper, we are concentrating on sectoral trade flows, and then we find that trade bans could be beneficial, at least partly correcting for the negative trade shock to the intermediation sector. And then to the best of our knowledge, the only other paper still in the working paper format that is talking about the reputational cost and its linkages with international, or its role in international trade, is the Corsetti et al. 2024. Finally, in terms of our results and the key message that we are portraying, we are adding to the French warring literature, in a sense that we are talking about the line, or we are similar to the line of papers that are estimating substantial cost of reshoring, or French shoring. So we find some evidence that firms are actually reluctant to give up their relationships with the former trade market, and therefore they are trying to use all the possible channels to keep exporting to some countries. So hopefully that message will be clear in the end. Just in case, the key results. So first we build a theoretical model and then provide some empirical evidence on how intermediaries help mitigating trade friction in politically misaligned markets. In terms of theory, we show that both variable and fixed rate costs affect the heterogeneous impact across the sectors, and then we document a feedback loop between producers and intermediation sector on the top of that. And then in terms of empirical insights, so after the export ban to Russia, exports of banned products, the same products that were banned of being exported to Russia via intermediaries increased, while they slightly decreased for producers. Even more interesting, the exports increased to geographically closer and politically risky markets, and intermediary firms were serving those markets. Direct exports, on the contrary, shifted to politically aligned and more distant markets. So these two results are standing a bit in a contrast with the conventional trade literature, let's say. And then well, we are claiming that these variable trade costs and geopolitical misalignment jointly determine the rise of intermediation in risky markets. And then our results complement the traditional intermediation theory that would emphasize distance and would be overlooking a geoeconomic risk element. So I have very little time, so I want to give just a few key elements of our theoretical model to be able to then interpret the empirical results. So first, we have the consumers with CES preferences, and then the standard iceberg trading costs, tau, representing all the other trade frictions as well. And then one key parameter, one key variable that we'll be tracking in our theoretical model will be lambda I star. That is the threshold value of when the direct exporting for the manufacturing firm, for the production firm, becomes profitable. So that is the first cutoff value, after which the marginal costs are low enough to be exporting directly to the market of interest. Then we have intermediation technology in the model, and intermediaries have the technology of reducing the fixed exporting cost, that is alpha lower than 1. But they, in order to export, they impose an additional intermediation markup. So wholesalers set prices taking into account the producer prices, and then with random matching assumption between producers and wholesalers, then we get the pricing of the wholesalers of the production that they export to abroad, and we get the double marginalization effect. So there is a wholesaler's margin on the top of the producer's margin. And then to put the three things together, the three equilibrium conditions together, so lambda I star, I already mentioned that that is this threshold value for direct exporting where the profits become positive. Lambda I star is the indifference condition between the producer for the producer between direct exporting and indirect exporting, and lambda PW star is the cutoff or break-even point for intermediary. I believe that it's actually easier to see those values and to trace those three values in the graph. So if on the horizontal axis we have these marginal costs, on the vertical axis we have the profits, then the red line would be indicating the profits of the direct exporter, and lambda I star would be at the point where the profits become positive. Then the intersection of the two curves, direct and indirect exporting, blue and red, lambda double star is this indifference condition between direct and indirect exporting, and then lambda PW star where it's still profitable or marginally profitable to export indirectly via the intermediary for the producer. We could have a different situation based on the parameterization, or even a weirdest case where only direct exports exist. But since we don't observe this third case in reality, it's probably not worth talking about that. And then, as I've mentioned, we would be looking into the openness and intermediated export share. So for the trade openness, and that's the bottom expression, it gives me how much the country will be traded in general, and the intermediate export share or intermediation share, that's the above expression there. And we can see that both of them, both of these parameters or shares, indices of interest are endogenous depending on tau and alpha. Tau participates in all the lambda conditions, right? And alpha as well. And then depending on the shock that we observe and the direction of the shock, we will be seeing whether the share or the openness, how the share and the openness change in the aftermath of the shock. So last few things in the model, from the theoretical model. So the testable prediction one that we derive claims that an increase in the variable trade costs, tau, would lead to a decrease in direct exporting and an increase in the share of indirect exporting via the intermediaries. So basically an increase in variable trade costs, worsens the exporting conditions for both intermediaries and direct traders. However, this feedback loop mechanism then shifts part of the direct exporters to the intermediation part. So that's a short intuition for that. I'm afraid I don't have more time to spend on the intuition of this. Then for testable prediction 2 that we will be bringing to the data, this is talking about change in the alpha, so this relative fixed exporting cost. And then we know that a decrease in the relative fixed cost of exporting, a reduction in alpha, would reduce the share of indirect exporters, with the effect being more pronounced in markets with lower variable trade costs, tau. And then again, lower alpha, of course, increases the attractiveness of indirect exporting. That's kind of easy to understand and probably intuitive to grasp. However, knowing that the ex ante, most of the direct exporting has been happening for lower variable trade costs, tau, then this shift is towards indirect exporting is more visible in lower variable trade costs, tau area. And then finally, the third testable prediction, an increase in the relative fixed cost, an increase in alpha, combined with marginal decrease in variable trade cost, tau, from an initially high level leads to a disproportionately large relocation from indirect to direct exporting. So there again, we are talking about the case where intermediaries become less attractive for the time being. However, after the initial shock and after the under high tau, then this relocation from indirect to direct exporting is stronger, is more visible for high tau areas. So now, from theory to empirics and from theory to data. So as I mentioned already, we are analyzing the episode of August 2014 when Russia, due to political tensions, banned a number of agricultural and food products of certain and certain raw materials from the EU, US, and a few other countries. Sanctions were launched quite immediately and abruptly, announced for 1 year initially, but then extended continuously. And back at the days, Lithuania was still having quite a big export share with Russia. So it's a small open economy, as you might know, with exports of 80% of its GDP. And then Russia was one of the main trading partners with 20% of Lithuania's exports back in 2013 still being directed to Russia and 18% of them being banned product exports. So if you do the math, you can already see that the shock must have been quite big for the Lithuanian firms. Then we do have this very detailed data set for the Lithuanian firms over the number of years. We have this firm times trade partner country times product level exports for a number, for all the, basically for the universe of firms and all the products being traded. So we separate, or we group these NACE codes, for industry NACE codes into producers or intermediaries. When we talk about export country characteristics and especially the reputational risks, we're using the UN General Assembly resolution, voting for this UN General Assembly resolution, and then those countries that were voting in favor, these are geopolitically aligned markets, while those that voted against, abstained, or were absent, those are treated as geopolitically misaligned markets. And then in terms of distance, we also look into the markets and countries within 1,000 kilometers. Far markets are those above 3,000 kilometers, and then medium is between 1,000 and 3,000 kilometers from Lithuania. And then, the list of banned products, or at least the largest groups of banned products, you can see it here. So then, how do we think about the trade shock and how that affected, how do we bring this to the data? So of course, the trade ban episode was a trade shock, which for all the countries, not only Lithuania, increased the variable trade cost tau for both sectors, for all the markets. So we can talk about Lithuania here, but basically all the countries that experienced the ban, it was harder to compete. Basically, there was an overproduction of banned products, and there was a higher competition of selling those products in all the remaining markets. Then when we think about the fixed cost of exporting, there we have a difference. Due to this reputational risk that when the firm is exporting its production to, say, geopolitically misaligned market directly, and the firm and the brand is recognized, we know it already from 2022 episode, right? All these Yale list of countries that didn't leave the Russian market, etc. Well, that poses direct reputational risk for the producer and potential negative externalities on the domestic markets and potentially even other export markets for their production. However, these reputational costs do not apply for the intermediation sector, since they are intermediaries. They are not labeled. They don't have their brand with them, and typically they are unknown to final consumers. So when we think about those geopolitically misaligned markets, or exports to geopolitically misaligned markets, we can see a difference in terms of alpha. So alpha is reduced for intermediation part. So this relative fixed cost changing to the is decreasing. Alpha is getting smaller when we talk about geopolitically misaligned markets and trade via intermediation. When we talk about exporting to politically aligned markets, so these are the markets to which even some subsidies by the governments existed, then we see an increase in alpha. And then in our empirical exercise, we run kind of different diffs.
Aurelia, sorry,
regression.
up to 5. Yep. Aurelia, sorry, up to 5 minutes, please. Okay.
Absolutely. Yeah, very good. I think I can make it. Right. So we do this diff and diffs estimation. We have the product times destination country and year, KCT, and then we check how the overall trade flow by the sector changed in the aftermath of the shock of this trade ban to Russia. So the first result that we see, indeed, that post 2013, exports via intermediaries have increased, while they have, well, slightly or negligibly decreased for the direct exporters, for the producers for Lithuania. So this is in line with our testable prediction one that we've seen in our theoretical model. Then when we try to dig deeper about, okay, so we see an increase of exports via intermediaries. What is the country characteristics that is encouraging that? So there we add some extra country characteristics into the regression. And we find that for the negative or non-positive votes, so geopolitically misaligned markets, the exports via intermediaries increased into closed markets, so low tau situation, while they have not changed or negligibly decreased to the medium and far markets. And this is again in line with our testable prediction 2 that I was showing and trying to give the intuition just before. And finally, when we talk about the positive vote countries, so something where alpha has been increased, so it changed into the favor of direct exporting. Indeed, the trade via production sector to the far markets, faraway markets, high tau, has increased the most. And this is in line with our testable prediction 3. So we wanted to test the feedback loop mechanism. So basically to check whether since we don't have firm-to-firm level transaction data, so we cannot really show that, okay, those producers that were previously exporting directly, now they use the intermediaries, exactly the same ones, to the markets that are geopolitically misaligned. However, we check whether the producer outcomes were more favorable if their exports consisted of those products in which the wholesale has increased their export most to the against vote countries. And then again, very briefly, indeed, we see that producer outcomes were more favorable. So either a small improvement in terms of sales or in terms of employee losses if the wholesalers held or had exports of those banned products to reputationally risky countries after the shock. So that's kind of this attenuation effects hopefully justify our feedback loop mechanism in the theoretical model. We ran a range of robustness checks, but in the interest of time, let me just show you these on the slides. On the slide, I guess the key important ones are the distant threshold manipulations, and then a different definition of the reputational cause, because maybe the UN resolution was not is not the exact or the best signal there, the best instrument there. However, we do see qualitatively similar results, even if we change one or other detail there. So in the conclusion, we analyze the intermediaries' role in international trade under the trade sanctions, under the severe trade shock that Lithuania has experienced. And then we definitely see and find the role for intermediaries, especially under geoeconomic fragmentation. So in terms of theoretical model, we find a more nuanced role for intermediation that is deviating from the conventional distant-based international trade theory. We find some even more interesting results by having this feedback loop mechanism between the producers and intermediation sector and the model. And in terms of empirical results, it's a drop in direct exports by producers. However, a relative increase in indirect exports in the aftermath of the shock. Intermediaries increasing the exports to geopolitically misaligned but distant, geographically close markets, while direct exporters increasing their exports to geopolitically aligned and far away markets. And then we claim that our reputational costs, the theoretical model that we built, and how we interpret the reputational costs that the potential direct exporters could be experiencing are behind these results and can explain these empirical findings. So thanks a lot. And then I probably keep with the slide of conclusions here, and I'm looking forward to, oh, actually, I'm looking forward to the discussion.
Okay, thank you. Thank you, Aurelia. Applause. Okay, thank you. Now I would like to invite the discussant, the Alexei Krivtsov from Bank of Canada. Alexei, are you with us?
Yes, can you hear me?
Yeah.
Can you confirm that you see my slides?
Yes.
Excellent.
Okay.
All right. Thanks for inviting me to discuss this nice paper. Let me make two disclaimers right away. One is the usual one that the views that I express are not those of the Bank of Canada. And second, as a substitute discussant, I want to apologize upfront to the authors and to the audience in case I do not give full justice to this very nice paper, but I'll give it a try. So the general context where I see this paper fitting has to do with this reversal of the global integration trend, right? So there's been this trend towards more integrated global economy that stopped and reversed around the global financial crisis. So you can see here a plot from recent paper by Fernandez Villaverde and co-authors that construct this index of geopolitical fragmentation based on a variety of variables, and it clearly shows the reversal of this trend. And so we can think of geopolitical fragmentation as a very complex, multifaceted phenomenon that is related to trade factors. So it indicates reduction in trade, declining trade flows, reduction of trading across different inter-country blocks, rise in trade restrictions, rise in policy uncertainty, escalation of tariffs, notably very recently. But there are also parts of what we understand as fragmentation that are not due to trade directly. So they have to do, for example, with a more fragmented financial markets, with restrictions on mobility of labor across jurisdictions. And finally, they have to do with rising geopolitical concerns globally, such as conflicts more generally, or wars such as Russia's invasion of Ukraine or Hamas attack on Israel. And so I see this paper as focusing more on this last aspect of what broadly is this trend in fragmentation globally. So the paper is focusing on these geopolitical reasons for why trade patterns might be disturbed and affected in various ways. So the key idea that is ingrained in the model in the paper is as follows. So if you start with a sort of classical trade system based on comparative advantage and trade cost, then you quickly realize that some of the recent patterns in trade are not captured in such a model, such in theory, right? So it would not be able to explain, for example, how the trade in products that are sanctioned. And so in the model, they add this consideration that follows some kind of geopolitical event that creates an additional barriers to trade. After such an event, what happens is that there's the additional barriers to trade have to do with blocks of countries. And so some countries within the bloc are aligned, politically aligned countries. And if the country you're trading with happens to be in a different bloc, so they would be not politically aligned. And so the interpretation is that exporters who would like to trade across the blocks, they would face this additional cost of trade that have to do with reputation, right? So if you think of you want to trade, you're an exporter, you want to trade across the bloc with a country that is sanctioned or trades with a sanctioned country, that would, if you do that would imply higher cost of trading via some kind of reputational damage to your reputation as a trader. And so that environment then creates an additional role for a different type of trading firms, intermediaries or wholesalers in this paper. Why? Because they would have, it is an assumption that these intermediaries face lower cost of accessing cross-block trade, right? And so, when the direct cost of trading across blocks is higher now because of this reputational concern, but you could circumvent that by using these intermediaries. And so in the model, that creates a meaningful dilemma, a choice for a firm who would like to export. The firm can incur higher cost of trading directly, or it can use intermediaries to trade across blocks, but that also has a different type of cost associated with having to pay intermediaries the extra fee for the service, and also at the end facing lower demand because the price of the product that you export will be higher as well. And so the main model implication is that depending on this cost of accessing these different markets and the cost of the cost of trade, there's going to be a change in the composition of trade between firms who trade domestically and export and firms who export directly versus indirectly using intermediaries. So that's the gist of the model. Now, the model is taken to the data, and I think that's a very nice underused part of the paper. So the model is applied to Lithuanian firm-level data for food producers. So the episode of interest is Russia's retaliatory import ban on agricultural food products in the EU, US, and other countries in August of 2014. And the data is very nice, firm-level data with information for firm, partner countries, and at the product level. And the time span starts in 2008, so at the beginning of this fragmentation trend. That's very nice, but also it is before the ban. So you can look at what happened between before the ban and after the ban. So that's a very nice setup in terms of data. The main finding in the data is that indirect exports, the exports using these intermediaries, increased for trade with nearby countries that at the same time involve reputational risk, whereas the other side of the export trade, direct exports, shifted the other direction. They shifted towards more distant but politically aligned countries. And as you see from my summary and from Aurelia's presentation, this is kind of how the model is designed, and the model sort of fits that prediction very nicely. So then what do you end up with? The paper has two main contributions in my view. One is it highlights this different sector, intermediation sector, as one of the key drivers of trade diversion. And so why it's useful because if you think, for example, about designing effective sanctions, say in the context of Russia's invasion of Ukraine, then this kind of setup can help you think about how to improve the effectiveness of sanctions, say on Russia in this case. And the second contribution is this interesting feature where the fact that indirect exporters collaborate with intermediaries, they share the profits from selling exports, and that impacts the initial incentive for the producers who want to choose whether to export directly or indirectly. So this share of profits between indirect producers and intermediaries creates this feedback loop and ultimately affects of how the trade composition will change. So let me offer a few comments in a few minutes. So one comment is that, as I said, one of the interesting ways of using this kind of analysis is to help think about sanctions. So in the model, in the paper, the approach to sanctions is kind of quite stylized. For example, paper mentions, if I'm not mistaken, in one case that it's a higher trade cost. You can think of that as a form of sanctions, how to capture sanctions. Or you can think of sanctions impacting reputation costs as well, which in the model is captured by fixed costs. So the first question is, how to think of sanctions within this model. Is it reputation cost, is it trade cost, or is it both? But then sort of expanding of how to take this framework to think more seriously about sanctions is that there's other elements that are necessary. And like one example, most notable element must be the target, the country that is being sanctioned. And that's important. Why? Because the effectiveness of sanctions, to assess the effectiveness, you need to understand its impact on the target country. So let me illustrate that, right? So here's the map, heat map of the total trade after the invasion of Russia of Ukraine. And what you can see is the change in total trade for countries here up to September 2023 compared to pre-invasion, right? And so the blue bloc countries here have lost a lot of trade with Russia, whereas the red countries here, they gained a lot of trade with Russia. So this illustrates to you that if you want to think about how in this setup, say in a geopolitical event like invasion of Ukraine by Russia and then ensuing sanctions and so on, how they impact, say, Lithuania here, who lost 69% of trade with Russia. But the other side of this is what happened with Russia and how it trades with different countries. And it's clearly, you can see that it trades much less with some countries outside of its bloc, and it's trading much more now with countries inside of its bloc, right? So it's sort of same thing that is happening in the model, except that it's happening for the target country. Russia is adjusting in response. And that's important to have in the model that would take a more full look at effectiveness of sanctions. But the other question here, that's not all. The other question here is that how do these different countries, different blocs, trade with each other? So blue countries, how is their trade with red countries has changed? So here's an example of the German exports to Kyrgyzstan over this time period, right? And you can see clearly that after the invasion, the trade of German export to Kyrgyzstan increased very dramatically. And so the question is, again, within this framework, how do we think of this increase, right? So the model predicts that for a country like Germany, its exports would increase for the country within its bloc, but we don't think of Kyrgyzstan as the politically aligned country with German exports. So then the model would say, well, maybe this is intermediaries, like Germany using intermediaries to trade with Kyrgyzstan. So then again, this is something you could check in the data, whether that's the interpretation. Is a lot of this increase primarily due to increase in the use of intermediaries by Germany? But there is another possibility here, which is sort of is well discussed, which is a lot of this increase in trade of goods that go to Kyrgyzstan are actually headed back to Russia. And so that's yet a third part of what's important to take into account here and sort of put a finger on is how much of this is actually diversion of trade that eventually goes from Germany via Kyrgyzstan to Russia. And in a couple of minutes, let me just give a couple of other comments. One is, in this style of model, a lot of movement that is on the extensive margin. It's a lot of analysis is about how is the marginal firm, the firm that is indifferent between, say, directly exporting and indirectly exporting, how is that firm affected? And so naturally, the model helps you focus on the change in composition. But of course, there are the intensive margins. What happens with firms above or below the marginal firms? What are these firms? Are they large firms? And how much do their exports change? And if you compare extensive margin and intensive margin after an event like this, what's the split and how well your model is addressing that? A more general comment is you could do a little bit more to support the key assumption and parameters in the model. The key assumption, for example, is that these wholesalers have advantage in accessing inter-block trade. It's something that you could probably look and try to support in the data. Tell us a little bit more about who are these different firms, direct exporters versus indirect exporters versus wholesalers. Are they different ex ante? Does it help us understand what they do after such a geopolitical shock? And it would help to not just have model tell you these qualitative testable implications, but also maybe bring at least some key parameters of the model more in line with the data. How would you quantify alpha? How would you quantify tau? And I'll finish with this slide on the feedback loop, because this is a key part of your paper, a key contribution. It would be helpful to provide a little bit more intuition, right? So the intuition you give it has something to do with the fact that there's this additional margin that is added on top of what indirect exporters earn. This additional margin is due to what the services provided by intermediaries that are then shared with the indirect exporters. So it's not. I think the test that you use in the paper is interesting and it gets there. But other idea could be based on this fact that they share the margin, right?
Alexei, so be close to finish.
All right, I'm half a bullet away. So it's interesting to use information that is related to the size of the margin, and that one information that could tell you that is the size of these firms, right? So if you could compare indirect exporters or wholesalers that are larger or smaller, then you could hypothesize that larger ones would be those that are maybe better isolated against a shock like this. Thank you.
Thank you, Alexei. Aurelia, would you like to respond?
Well, first of all, I would like to thank for a very nice summary. I guess Alexei did a really great job in summarizing the key aspects and the key takeaways from the model. So thanks a lot for that. Also, many great comments. Probably you're very right. So like this episode that we are analyzing, the 2014, we claim, you know, it was not like the sanctions itself were geopolitically motivated, but they were not like kind of targeted towards one specific country or one specific sector. It was just a ban on products. And I guess afterwards, when we think already about 2022 and what happened afterwards, and then all these European sanctions, so self-imposed export sanctions from the EU countries towards Russia, this is probably a more nuanced approach. And then we need to think how these targeted sanctions, what can, like in which aspects they are comparable to our model and in which aspects they are different. When we were showing this blue block and red block picture again, well, very visual and very insightful picture, I should say, graph and map of the world, and indeed, like probably the key message in our model is that well, the overall trade flows is not everything. We also have to look into the sectoral changes, and then direct exporters or manufacturers, they kind of reduce the trade, but then maybe wholesalers help them to circumvent the sanctions in some sense. On the other hand, we don't really know whether the same products, for example, reach Russia as the final destination, that's the missing piece, or they stay in these geopolitically misaligned markets. This story we cannot disentangle, and we were thinking several ideas how to find the ultimate destination of the banned export products, banned product export, sorry, but we don't have the answer yet. And yeah, all of our suggestions, thank you very much for those. I guess, yeah, we will take them into account seriously. So thanks a lot for your insights.
Let's continue, and I would like to invite one more, Olga Bondarenko, with presentation, Shockwaves from Ukraine, Trends and Gaps in Agricultural Commodity Prices. Please.
My name is Olga Bondarenko, and I'm from the National Bank of Ukraine, so the usual disclaimer applies. So why we are talking about this topic? Because economic headwinds of 2021-23, they remind policymakers in both emerging and even advanced economies that commodity prices do matter. And here I show the graph of the one quarter ahead forecast errors of the ECB. And as you can see, they are up to 2022, about 3/4 of this error was due to their assumptions on energy and food prices. Then this share declined a little bit, but still it was significant up to the end of 2023. For emerging markets, this problem is even more pressing because commodities occupy higher share of their CPI basket. As you can see, if for advanced economies, it's up to 20% more or less. For emerging economies, it can come up to 50%. Also, some EM countries, and this is also the case of Ukraine in the wartime, commodity export play important role for maintaining external balance and for stability on our FX market. So what policymakers typically do when they need to forecast commodity prices? First of all, many central banks go to futures markets and observe what are the prices for 1 year ahead and so on. And however, studies typically show that these forecasts are rarely better than random walk, so no change forecast, or that commodity futures prices, the predictive content of commodity futures prices declined significantly since 2000. And in the case of wheat and corn prices, there is another problem that beyond one season, these futures are thinly traded, so they offer a little guidance on how would commodity prices evolve over time. Another approach is a VAR model of Killian-Murphy style. I tried to replicate this stuff before in previous paper with corn and wheat prices, but however, you can see that if they offer some advantage on the 6 to 12 months period, in long run, they are just a linear trend, and this trend rotates depending on what period are you actually taking. So it was upward sloping before, but then it more or less became flat. So I try to put a bit of more structure on this and think about this problem in a structural way using competitive storage model. This model uses demand-supply framework but adds inventory holder to it. And I also extend it by using non-stationary variables that will, I will show you how it helped me to project trend prices of corn and wheat. And for making this trend, I also use disaggregated country-by-country analysis. And also, this is a more novel feature. This is still work in progress, so I welcome your comments. I add supplementary models that actually help to translate my trend prices into feasible forecasts for central banks. And the results of the paper show that actually we can have an alternative interpretation to the commodity price trend, which differs from something that we get from traditional statistical stuff, like HP filters or just VR models. And I also use this model to make some projections based on OECD forecasts, and I can show you that, well, the real prices are expected to decline in this case. It's still not about nominal prices, which are influenced also by inflation. But anyway, like for corn and wheat prices, we do have some downward trend. And I also show that this extended framework helps us to overpredict random walk and to overpredict these linear trend models. So I will skip probably literature for the sake of time. And now let's have a look at the model. We have a material balance equation. This equation shows, basically it brings together all the components. I call this like Q availability, and this availability comes from current harvest age and the remaining inventories from the previous period. And this availability can be either consumed or stored for the next period. The consumption is very stylized, so to say. It contains 3 components. One is traditional component with constant price elasticity. And I also add trend lambda, which is necessary for translating this model, like to make this model produce some trends. And I also add the shock component because this consumption is not always on its trend. The next part is about production. So harvest is the product of expected yield. Yield is expected because
well, it trends upward over time, but still we have some weather, some pests problem. So because of that, we never know before the harvest what will be the actual yield. What we also do not know is like how will this impact also areas planted. So we have areas which are also divided by trend and gap component, and I propose to use this to make this trend component endogenous in one case, and I keep it exogenous in the second case. When I use the endogenous case, I assume that that planting is costly, and because of that, we can derive production function, which is which uses this parameter of alpha for this is kind of elasticity of supply parameter. And the most important, I would say, part of this commodity storage framework are the inventory holders. So the basic idea is that they act as speculators. They buy inventories if they assume that there is a possibility to make a profit in the next period from holding these inventories. So now they can buy them, and they bid up prices up to the level of their expectations. However, if current price is too high, they just sell their own commodity, their own inventories, and buy no more, because that's how they make profit. And this translates into a kinked demand curve, market demand curve. So on this graph, I show that we have the blue line shows the standard consumer demand function, and orange line shows the market demand with inventory holders. So when prices are high, these two coincide, so no inventories are required. However, at a lower price level, they create additional demand, and that's why the price level is higher. However, they also act as a force to stabilize the market, because if for some reason, for instance, a bad harvest, the availability queue declines from Q1 to Q2, then if there was no speculators, the prices would increase from P1 to P2. However, because they are present, we have only increased from P star 1 to P star 2, and this is the price increase is a lot lower. So now let's come to the calibration of the model, and the first and foremost part that we need to calibrate are trends. And if for consumption, I use just USDA world consumption data, and I extract trend with HP filter. For yield and acreage, I use disaggregated country by country series, and this country by country series are then aggregated again together. I use a set of countries, not like all 190 countries, but only major exporters, importers, and selected others as defined in the USDA report. And here I would like to show why I do this instead of just taking the simple stuff. This is because this allows me to make country by country like a case study analysis, and it is important in case of Ukraine. I would like to say that neither wheat nor corn yields were impacted by Russia's invasion of Ukraine, so they remained more or less on the same track as before. However, areas planted, they got a substantial structural shift, and the areas planted became significantly lower. There are basically two reasons for that. First of all, some territories unfortunately got occupied, and the second is that there was no possibility to export at the previous levels because at the start of the invasion, some ports were closed completely, and the possibility to export through alternative routes was very limited. Actually, for that reason, I also make an alternative scenario, the one which no export was maintained, because right now, thanks to the Ukraine's armed forces operation, we do have some ports working, and unless for this operation, we could have even deeper decline in the areas planted. Yeah, I want to show that, like, because I use these trends as parameters basically in the model because of how it's built. I show that actually the effect is the trends do change the market demand function. It has a different shape depending on the balance of demand and supply trends. So this is just an illustration for both cases. I also calibrate other parameters pretty much standard. I don't stop on this. But I also have 3 structural parameters which I calibrate using, not calibrate, I estimate with the simulated method of moments. I choose 3 moments for this estimation. These are 2 first autocorrelations and the coefficient of variation. Coefficient of variation, for those who do not remember, it's a standard deviation divided by the mean. So this EXO model is the one where I take trend areas planted as they are in the data. And the endo model is like endogenous instance for endogenous. And this is the one where I use this this supply equation, which I saw a few slides before. As you can see, the EXO model can capture these moments better. And for that reason, I basically use this model later. And I also calibrate these parameters to the values that are close to the ones which are in the literature. So my findings confirm more or less the previous studies for these parameters. And now let's look at the results. So the model brings a very intuitive interpretation to price trend. Whenever supply trend outpaces demand trend, we have a decline in price trend. And whenever it's the opposite, we do have an increase in price trend. And this is something that you can see, for instance, on this graph, that it is not always the case. Like if we plotted here an HP filter, it would be a bit different. So the peaks and troughs would be shifted to some extent. So this interpretation, like economic interpretation, is a bit different from what we typically assume that we can see from the statistical method. Yeah, now let's come to the impact of the war. As you can see that even before the war, the market was already tight. We had an increase in price trend, and because the consumption growth was outpacing production growth. And now at that point, the invasion happened, and we had a structural break in this production, in areas basically of Ukraine, and then because of that in the world areas. And this translated into up to 2 to 5 percent increase in trend prices. However, if there was no sea export from Ukraine, the prices could have risen even more, beyond 10% increase, especially in case of wheat. I will also show how we can apply this model to construct projections and actually alternative scenarios, which could be done, for instance, for the climate change matters or any other matters. So here I take OECD projections of demand and supply and I adjust them a bit for some countries like Ukraine, where we have a different level. However, overall, these are this stuff, and as you can see, whenever, like for wheat, it's more visible that production is expected to outpace consumption growth a lot. For that reason, we have a visible decline in real price trends. For corn, this is a bit less because we have a higher increase in demand, probably mostly because of bioethanol and other factors. So we have a very slight decrease, still decrease, but lower in magnitude. Yeah, and here I also show that if I use this trend for a very simple R1 model as this mu factor, then this model can produce relatively better forecast. Here I show a table for the case of a relative to random walk. However, I also compare it with 3 models, the one which uses long-term mean, another uses linear trend, and this commodity storage model trend. And from this table, you can see that this model do outperform both the random walk and these models with linear trends. So in conclusion, I would like to highlight that in times of a volatile market environment, we need to resort probably to different models, and we cannot rely just on econometric models. So we can impose a bit of structure on this, and we use this. We can use this model to improve our forecasting performance, and even with so highly stylized model like a commodity storage model, we can do better. And that's for this reason we can extend and make this model useful for central banks and other institutions. So thank you for your attention.
Thank you. Thank you, Olga. I would like to invite Roman Nator from Kyiv School of Economics. Please, the floor is yours.
Thanks a lot, colleagues. Thanks a lot, Olga, for this outstanding presentation. So I want to start with a brief summary of what we've seen, of what we are talking about, and then proceed with a few critical advantages of this model compared to quote-unquote competition to other comparable model. And then I will talk a little bit about, let's say, direction for further research, because it needs some work needs to be done to bring it closer to what we see in the real world and to allow a certain flexibility in modeling and stuff like that. So in summary, this paper proposes a partial equilibrium model for global wheat and corn prices. The distinctive feature of this model is a non-stationary trend in supply and demand. So it allowed for endogenous estimation of price trends, which is a big advantage. And although you can see from this slide, you can use both endogenous and exogenous version, having this option can greatly benefit the researcher. So this model is built on competitive storage model, and that's one of the big weaknesses and one of the biggest advantages of this whole research. So it allows to estimate how shocks, especially as we see in our case, how shocks because of the Russian invasion of Ukraine can affect prices, global prices, price trends. And one of the biggest advantages of this model is one of the very few options when it comes to long-term modeling. So the main advantages it's easy to integrate this model to other models, other modeling techniques. You can use the output of this model as input for some further analysis, and that's a big advantage, one of the big advantages. We don't have a ton of assumptions, which makes this model particularly useful when compared to like some giant models that FAO or OECD uses and stuff like that. It allows a fairly simple scenario analysis, and it has a high policy relevance. So you can analyze a wide variety of different things using a fairly simple framework, which serves as a great entry tool for a lot of researchers, representatives of the Ministry of Economies, of national banks, of other entities to conduct such an analysis. So that's a huge help for other researchers. So I would want to in your response, if you have some time, maybe to discuss maybe a little bit about, maybe clarify how to use Ukraine's area reduction, how it's integrated into the trend path, because the exact mechanism is not clear from the presentation, but I believe it is useful. But now I wanted to talk about further research and talk about some limitations of this model. I believe that's an excellent work, and that's a great starting point for building up a little bit more complex models that can be more flexible for real-world modeling. So one of this model is called competitive. It relies on the assumption that the inventory holders are competitive. And in reality, we see problems, especially with countries like China, that they do not always decide on their stocks purely based on the prices of the current prices, the expectation of future prices, the cost of handling this grain and stuff like that. They might have political objections, and when we are talking about some volatile times, like the time after the Russian invasion of Ukraine, a lot of countries, they started to shift their pattern of behavior, and they started to store more grains than they need, and that's a substantial shift in the behavior. The second one is that it is about aggregation of prices. The prices are aggregated based on the marketing year in Northern Hemisphere. That's a working solution. It's fairly simple to implement, and that's another one of the big advantages of this model. But sometimes when we are talking about certain crops, sometimes as high as 50% of all production can be done in Southern Hemisphere with different marketing years, with different production cycles. And there are a few possible ways of how to handle this issue in the model. One is to allow prices to change 4 times in a year, while the production decision is made only once in a year. Or it is possible to set up two trading partners, Northern and Southern Hemisphere. It will greatly complicate this model, but it might improve the overall efficiency of the overall accuracy of this model. And this is a partial equilibrium model, and that's it might be difficult when it comes to agricultural commodities, because my decision to farm wheat, it depends on the wheat price, no doubt about that. But wheat price, for example, also depends on the price of rice, it depends on the price of soybeans, it depends on the price of other substitutes. And when modeling explicitly the production decision, I believe we might improve the accuracy of the endogenous production function if we take the substitution effect and substitution prices into account. And that's pretty much the last comment I want to make when it comes to deciding on the area, cultivated area by the producer. We might consider certain additional factors as the price of competitors, and probably the area cultivated in the previous season, because there is a thing called crop rotation, and it affects the amount of land you can cultivate in a current time. These are all extensions of this model, and it might benefit the overall usefulness of this model, but that's, in my opinion, that's an excellent research, and that's an excellent starting point. Thanks a lot.
Thank you. Olha, would you like to respond? Please.
So first of all, in China, this is like in the paper I do show that I have inventories and what are the inventory fluctuations, and for that reason I didn't use China data, so I used world data minus China. This is quite a common approach, given that it's completely true that China has non-competitive stockholders. They are, yeah. So on the Northern Hemisphere question, this is especially like relevant for corn. I do believe that that would be a great improvement. However, it requires adding trade to the model, and that was one of the my ideas of how to improve this model, actually, by adding trade. However, it increases computational burden every time you add at least something. It increases computational burden. As you could see, it's not it doesn't have any closed form solution, so you need to solve it numerically, and that's a bit of a problem. The other question is in the partial equilibrium, and so here I used the partial equilibrium model, and it was a trade-off. We face a trade-off whether we do need a big extensive model that includes rice, soybeans, and other stuff, and that's what's typically a specific agricultural sectoral organizations do. However, I wanted to keep it simple enough to limit the amount of assumptions that you need to run this model. You need this is something you can easily communicate to your boss, to the Monetary Policy Council. So we used it in that, and that's the result. So yeah, I completely agree that it would be helpful, but we need to face a trade-off here. Yeah. So on this issue of areas planted, yeah, we can try to improve this stuff, because yeah, some cobweb analysis style that rely when producers rely on past prices instead of making a rational expectation. So this is basically the question of whether we use in production function rational expectations or naive expectations. So this can be we can test this, whether this is really how producers behave or not.
Okay, thank you very much. Your applause. I have a very small question. What's the policy-making implications of your models in terms of supply versus demand shocks?
This is more as a central bank, so we do not really have a control over demand or supply for commodities, because also demand is very inelastic. As you could see from these parameters, they are really really low. So the demand is really inelastic, and my policy proposition is first of all to try to take this into account and try to improve our forecasting performance, and just to be sure that we are taking into account commodity prices when we make our forecasts, especially in countries like Ukraine.
Okay, thank you. Thank you. I guess it's a time to switch to our next presentation, and one more I would like to invite Krzysztof Makarski from Narodowy Bank Polski with a paper, with a presentation titled Monetary Integration Under Household Heterogeneity and Bound Internationality. Thank you. Krzysztof, please.
Thank you. So this is a presentation about the effects of monetary integration. It's more, for now, in the context of bounded rationality than heterogeneity. It's work in progress, so I greatly appreciate all the comments, suggestions, and so on and so forth. It's a joint work with my colleagues from Narodowy Bank Polski, Michał Brzezo-Brzezina, Paweł Goliński, I'm Krzysztof Makarski, and usual disclaimer applies. So let me start with the motivation. Why this matters. Joining monetary union is a major commitment. You know, in a sense, it's like getting married. You lose flexibility, you get stability, but you cannot live on every crisis. Most existing studies examine the effects of membership from sort of ex-ante perspective. We ask a slightly different question. We ask what would have happened in Poland had it been in the Eurozone under different entry dates. And Poland outside Eurozone offers an interesting perspective. Over the last 15 or more years, we had two major crises. We had also a period of more calm period of 2010s. We also employed the recently becoming more and more popular behavioral models, which challenge standard assumptions. And our focus is, so this does not take into account of the effects of joining the Eurozone, focuses on the effects of losing autonomous monetary policy and flexible exchange rate. I'm going to go very briefly over the literature. There's large literature focused on the effects of joining the Eurozone. There's literature on, typically conducted under Russian expectations. There is literature on optimal monetary and fiscal policy in the Eurozone. There's literature on fiscal devaluations and fiscal unions as being sort of larger objects. However, there is limited literature concerning sort of post-perspective. And also, at the same time, there is a growing literature on the effects of behavioral expectations, which affect monetary policy transmission, fiscal policy multipliers, effects of macroeconomic shocks, and exchange rate behavior, which all are relevant from the point of view of joining the monetary union. Why Poland? Poland's compelling case, closely integrated with euro area, experienced two major shocks. First shock is global financial crisis, then the most recently marked by COVID-19 pandemic and Russia's full-scale invasion of Ukraine, and then there is relatively calm 2010s. So what we do in these papers, we use a two-country new Keynesian model to start the ex-post, what would have, to be more precise, what by ex-post we mean, experience using counterfactual simulations. We check how the results change if instead of using rational expectations, you use behavioral expectations. And we check whether a fiscal policy can at least partially substitute for autonomous monetary policy. And we also check the effects of different entry dates on the effects of euro area adoption, of joining monetary union. So just to preview the results and also to guide you through the presentation, monetary union amplifies output volatility but stabilizes inflation. Expectations actually do matter compared to rational expectations, and contrary to sort of initial intuition, macroeconomic volatility is actually lower under behavioral expectations than under rational expectation. Realistic fiscal policy wouldn't have replicated the stability of autonomous monetary policy, and macroeconomic impact of joining monetary union does depend on the exchange rate at entry. Model. So this is a DSG model with rational expectations. I'm not going to spend much time on the DSG part, maybe mention what does the behavioral expectations mean. So these are the behavioral expectations a la Gabek's 2010 paper. So basically, what does it mean? It means that agents perceive future deviations from the steady state myopically. What does it mean? Imagine a variable x in the future, t+1, then you split this variable into the steady state and deviation from the steady state. The steady state you perceive correctly, but the deviation you perceive with this parameter m, which is a cognitive discounting parameter, and this is smaller than 1. What does these behavioral expectations do is they dampen the effect of expectations on current variables, and they amplify the effects of current events, current effects relative to Russian expectations. And then the additional nice feature is they nest Russian expectations. Very briefly about the model. So this is a standard New Keynesian framework with 2 countries, home and foreign. We have Ricardian and non-Ricardian households. Wages are sticky. Final goods are assembled from domestic and foreign variety. Intermediate goods are produced using capital and labor. Monetary policy follows Taylor rule. And we have expectations, behavioral expectations with Gabek-style cognitive discounting. I'm going to skip these equations in the interest of time. So the model is estimated using Bayesian estimation methods. The estimation period starts from in 2000, and it goes almost up to now. Model is estimated for Poland, which we treat as a home country, and euro area, which is treated as a foreign country. There is standard set of observables, and the prior for M is 0.85, which is sort of also standard in the literature. So what do we find from this Bayesian estimation in a nutshell? Because I don't have time to go into more details, is that behavioral expectations are strongly favored by the data of the Russian expectations. These models, they exhibit larger propagation mechanisms, therefore, shock volatility is estimated in the behavioral model are smaller than the ones estimated in Russian expectations model. And these will have implications for later on for joining the Eurozone, for the findings concerning joining the Eurozone. Working of monetary policy. So now we have set of the results. I'm going to first sort of mention what the result is, then to show it in more detail. So first result is behavioral expectations dampen the short-run effectiveness of monetary policy, and this you can see on this graph. So this is the impulse response function to monetary policy shock. And with the red line, we denote the Russian expectations model. With the blue line, men don't recognize color very well, although this is black and red, so I should be able to identify them. So this is a blue line, and this denotes behavior expectations model, and we have GDP and inflation. So as you can see, under behavioral expectations, the effects on GDP and inflation are smaller than under Russian expectations, although they are a little bit more prolonged. Then concerning the shock transmission, we have a variety of shocks in the model. I'm just going to mention 2, markup shock and consumption preference shock. So what we found is that in monetary union, what disappears is the adjustment of the nominal exchange rate. Therefore, in case of markup shock, there is a stronger GDP response, which actually is not a universal result, because, for example, in case of consumption preference shock, this effect is the opposite, but very weak. And also there is the most important here for the later on results is the markup shock. So we have a stronger GDP response due to the lack of nominal rate adjustment and weakened inflation response. And you can see it here. So and then we have also the comparison we have between the rational model and the behavioral model. So the figure is again the same. So we show the impulse response of GDP. What we show in this figure is the deviation from the steady state. And we have a markup shock, which means the markups go up. So the increase in markups results in a decline in GDP and increase in inflation. And we keep the scale between the rational model and the behavioral model the same, sort of to see the quantitatively how this changes. So as you can see, and one more thing, the blue line denotes now Poland outside the monetary union, and the red line denotes Poland in the monetary union. So as you can see, first of all, under the behavioral model, the effect is more prolonged of this shock, if you compare to rational model concerning the GDP, but also the effect of joining monetary union is much more pronounced, right? That the difference between the blue line and the red line is much larger for the behavioral model. So the joining monetary union amplifies the response of GDP to the markup shock in behavioral model much more than in the rational model. In case of inflation, there is a small difference. Inflation becomes more stable, but there is no big difference between behavioral and rational model. So this is the first one concerning the markup shock. So stronger response of GDP, weaker response of inflation. Joining monetary union amplifies response of GDP to markup shock much more in the behavioral model than in the rational model. And then going to consumption preference shock, so just to show you that these effects concerning the markup shock is not universal, it's not actually the case in the consumption preference shock. So this is an increase in preference for consumption today. Again, the lines denote the same. And as you can see, joining the monetary union looks pretty much similar in both behavioral and irrational models. So there is not much difference between these two shocks. So the findings of behavior expectation. So we have three main three main takeaways. So first of all, there is a weaker monetary policy transmission. So in a sense, if you join the monetary union, what you give up is not as powerful under behavioral expectation as under rational expectation. Second, there is a stronger propagation of certain shocks. So this actually works against joining monetary union because shocks propagate, shocks generate larger volatility of GDP. The same shocks would generate larger volatility of GDP. So that works against. And then we have the third effect is that, which I mentioned on it without showing it in more detail, that in the behavioral model, shocks, the volatilities, estimated volatilities of shocks are smaller. So you see weaker monetary policy should favor the joining monetary union, stronger propagation shocks works again, but then again, lower estimated shock volatility works in favor of monetary union. So overall, two works one direction, one works in the other direction. So the question is quantitative. So now we look at what would have results. So again, first I will mention what we find, and then I will show you this. So first of all, euro adoption amplifies output volatility and lowers inflation volatility, and effects of joining monetary union are less pronounced under behavioral expectations. And we also check if realistic fiscal policy would have replicated monetary policy stability, and we check for two instruments, government expenditure and government transfers. So in this graph you see the actual GDP. So this is three graphs, they cover GDP, inflation and real exchange rate. The red line denotes actual GDP. The blue line denotes counterfactual GDP under rational expectations, and the green line counterfactual GDP under behavioral expectations. I will not talk that much about rational expectations here, just focus on actual and counterfactual behavioral expectations. So what we find here is that this is joining like in 2010. So in the 2010s, after the EU accession, counterfactual simulations showed that GDP would have been higher and inflation would have been sort of closer to the target, right? Because these are, the inflation at that period was in the deflation area, so the joining would increase inflation. So these would have been closer to the target. Where is it coming from? It's coming from the fact that basically the real exchange would have been. So you see the higher real exchange means that sort of weaker currency, right? So the higher real exchange would sort of boost competitiveness under monetary union. So that's the first result. Euro adoption rises output volatility and lowers inflation volatility. And then the second result that, before we go to the second result, so what sort of sorry, I forgot to mention one more thing. So I mentioned 2010s, but then there is there's this big shock, which is the COVID, and then the increase in prices aftermath the full-scale war of Russia against Ukraine. And then what we see here is that the recovery would have been much slower after this crisis. And the reason for that is that we had some nominal exchange rate depreciation, and this wouldn't have happened under monetary union. So you see the real exchange rate under monetary union would have been lower, which means the stronger currency. And here, what I mentioned, you can see a little bit here. So this is the difference between actual GDP and counterfactual GDP, and this difference between actual GDP and counterfactual GDP is the split between, so what happens when you join the monetary union? You lose the autonomous monetary policy shock, you lose the exchange rate shocks, and then you lose, and then you have sort of like a systematic change because the Taylor rule responds now to the euro area-wide parameters, and then, the WIP, like there is no WIP, UIP condition anymore, you have just the real exchange rate. So the main driver was this blue line, blue bars, and the blue bars represent the risk premium shocks, which basically are responsive in DSG model for the currency movement, right? So these positive risk premium shocks, they capture the sort of appreciation of currency that wouldn't have happened under monetary union, and then these negative blue lines capture depreciation of currency after the COVID shock, which wouldn't have happened under monetary union. And then on the top of that, the monetary policy shocks, they also contributed to that, but especially during the COVID, the impact was not as large as risk premium shocks. And interestingly, and I still have to think about what this means, this sort of like the part that's associated with, systematic component of the change, they work in the opposite direction. But I have no intuition for that yet. And now, comparison of behavioral expectations and rational expectations. So as you can see, so this is in the table, you have the historical standard deviations of GDP and inflation. This is the first column. So the joining Eurozone, and this is the counterfactual under no fiscal rule, increases GDP volatility and lowers inflation volatility. So GDP volatility increases from 1.9 to 3 or to 3.9 depending on expectations, and inflation volatility falls from 4.8 to 3.93 or 3.2 depending on the expectations. Under behavioral expectations, the increase in GDP volatility is smaller. And then we check to what extent the fiscal policy can step in. So we actually allow fiscal policy changes to be quite large, to go up and down by 2.5% of GDP in terms of GDP government expenditure increase or government transfers increase. And they do something, but not nearly as well. So GDP volatility increases to 2.5 instead of to 3. And then the last result, what could have happened, counterfactual simulations with different entry dates. So we look at the so we have this, nice period. So at this time we had very weak currency, we had very strong currency. So we check first with a strong currency. So this is entry with a strong currency, and this results with. So if you enter with strong currency, the currency cannot adjust quickly, and historically it did adjust quickly. So you have like prolonged adjustment through the sort of internal devaluation, right? And this results in a lasting GDP decline and also deflation. And then if you enter with weak currency, it generates lasting boom and inflation. To conclude, monetary policy amplifies output volatility and makes inflation more stable. Expectations do matter. Compared to rational expectations, the effects are less pronounced under behavioral expectations. Realistic fiscal policy cannot substitute for autonomous inventory policy, although it does something. Macroeconomic impact of joining monetary union depends on exchange rate at entry. Thank you very much.
Okay, thank you. Thank you. I would like to invite for discussion Volodymyr Lepushinsky from National Bank of Ukraine.
So I will start. Actually, I like this paper very much. I even a bit jealous because I always had such a research question about doing this backward-looking counterfactual analysis of what could have happened if, for example, Ukraine accept full dollarization or entered currency union. I had a question, but I never provided an answer, and that colleagues actually had done. So this paper evaluates the macroeconomic consequences of joining the monetary union, specifically Poland's hypothetical accession to the euro area. It's done through non-Keynesian, neo-Keynesian open economy model with behavioral expectations instead of rational expectations, and households heterogeneity. So the key questions that were addressed, actually could skip this slide because actually they addressed several issues, like substitution of rational expectations with behavioral expectations, better fits to an actual Polish data, and the other conclusion is standard rational expectations models may overestimate euro adoption costs. What is the second, for me, like very illustrative result is that timing of entering the currency union matters a lot, and that actually showed through the this counterfactual analysis of if country enters with undervalued currency. So as a bonus, there could be a boom, of course, with higher inflation, but then goes a bust cycle. So it's there is no like actually a good outcome of that. If currency is overvalued in the timing of entering the currency union, so there will be a slump and a deflation, and it could be quite prolonged, as I assume. So it stresses the fiscal policy, and the outcome here is that fiscal policy tools alone offered limited macroeconomic stability under single currency, actually under joining the monetary union. And especially it matters for emerging markets as they have quite squeezed fiscal space. So why it matters? Because behavioral expectations here show that for accession economies, the potency of policies to has limited actually scope, and timing and initial conditions of entering the currency union are critical, and that is done through the analysis of position of real effective exchange rate, and fiscal policy has quite limited ability to smooth the business cycle, and it's actually not enough to produce good results. So there is three actually suggestions for further explorations. First one is output and inflation volatility. Smoothing is not actually equals to the welfare. So the suggestion is to have some consumption equivalent welfare by household type, hand-to-mouth vs. Ricardian. So the second one is to enhance actually financial channel, because euro area affects credit spreads, capital flows, and risk premium here and now stands for all financial frictions. And probably it will be good to recasting it to model credit access, funding volatility, or capital controls, and to have additional robustness check. For example, higher share of hand-to-mouth households, for example, like in Ukraine, and test it on different country sizes. So, of course, this paper is perfect for the topic of our conference. So, thanks a lot for it. This paper actually pushes the literature beyond rational representative agent framework, and it raises the bar for empirical counterfactuals in monetary integrational studies. So here are some questions to authors. First is a fiscal design. Could rule-based automatic stabilizers like employment insurance inside the euro area regain part of lost policy space because fiscal policy is not enough here? Behavioral, second one on behavioral heterogeneity. What if firms behave more rationally than households? Could heterogeneous expectations rules shift macro outcomes? And the third one, postponed entry scenario. If euro adoption occurred into 2023, when things look differently compared to what Poland has 20 years ago. So post-inflation, normalized effects, greater integration, and could probably be Polish economy is now more synchronized with rest of EU economy. And would GDP volatility outcome look different in this case? Thanks.
Thank you very much. Applause. Krzysztof, would you like to comment? Would you like to respond?
Sorry, very briefly. Automatic stabilizers, we think about doing that, but my guess would be that it would be similar as transfers, the effect of those. Behavior heterogeneity we can definitely do, but we haven't done that yet. 2003, I think it's a great idea. I just wouldn't agree that 2003 is post-inflation. So maybe we have to check, we have to wait a bit. We are getting there, but not yet. Thank you.
Okay, thank you. Krzysztof. Krzysztof, I have a very small, but I guess comprehensive question. What's the normative consequences from your model? Because it's looked that to join monetary union or not to join, it's related to the political interpretation of what is trade-off between GDP volatility and inflation volatility. What do you think from that?
So this is exactly the question I'm trying to avoid. So I will, along this line, answer. So this is just tells you part of the story, right? So I don't think, like losing monetary policy, I cannot, you cannot get that losing monetary policy is good unless you have a crazy monetary policy, right? So you cannot have result that losing autonomous monetary policy is a good thing. The advantages are somewhere else, and these are not studied in this paper.
Okay, okay. Please, more questions from audience? Not? Okay, thank you very much. Now let's continue and closer to our final presentation. Fernando Bronner, CREE, University Pompeu Fabra and Barcelona School of Economics, with a presentation titled Hegemonic Globalization. Fernando, please.
Hi, can you all hear me well?
Yes, we hear you well.
Okay. So thanks a lot for the invitation and the opportunity to present our work. My original intention had been to be there in person, hopefully next year. So this is joint work with Alberto Martin, who is also a colleague at CREI, Josephine Meyer, and Christoph Treves. Okay. So let me start with some brief motivation. Sort of, if you think about sort of broad trends in globalization, both trade and financial, clearly up until perhaps very recently, maybe still today, we're in the process of a very important process of globalization. This is not unprecedented. There was also a somewhat similar process at the end of the 19th century. A common feature to both episodes was existence of a hegemonic power. The first period was known as the Pax Britannica. Today, some people refer to the current process of globalization as being part of the Pax Americana. So the natural question that arises is whether there is any relationship between hegemonic power and globalization. One might argue why if it is true, or why it would be true that globalization is more likely in a unipolar world than what would happen with transition to a multipolar world. And finally, natural questions are who would gain, who would lose from a transition to a multipolar world, what would we expect to happen to globalization? So these are all questions that we'll try to address in this paper. Okay. So since I'm going to be talking about hegemons and hegemonic power, natural question is what's an hegemon? In our model, in our study, it's going to be a fairly narrow definition of a hegemon. It's basically going to be a large country or coalition of countries that, as a result of their size, has the capacity to impose regime and influence other countries. Okay. And in the past, we've had various hegemons, the United Kingdom and the US, as I just mentioned, but also other hegemons, such as the Soviet Union, perhaps China today. So I have very little time. So in the paper, we have both a theoretical section where we develop a model of alignment and globalization. And then we have an empirical section where we present a new global database on international treaties, use these treaties to measure alignment, and we study the links to international trade. So I imagine I will have more time to talk about the first part, and on the empirics, I might just show you a few plots. So let me just skip the literature. There is a large and rapidly growing literature on this topic, but in the interest of time, let me not talk about that. So let me go straight to the theory. Okay, so think of a world composed of countries. Now, countries are located in a circle, and what this circle represents are heterogeneous preferences of these countries. Okay, so on the one hand, you have a mass of small countries that are uniformly distributed in this circle. And then in addition, you may also have an hegemon, which without loss of generality, we think of as being located at 0. And this hegemon simply means that it's a country that instead of having size 0, has a positive mass. Okay. Later on, we introduce a second hegemon. This second hegemon, I will discuss the case in which is potentially has as different preferences relative to the initial hegemon as possible by locating it at 0.5 instead of at 0. And I'm going to be looking at the interaction between these hegemons and the choices they make. Now there is a model of trade, a fairly standard model of trade in the background. So basically, each region in the world, small countries have one region or one, and large countries have more regions, and each region produces a continuum of varieties. And potentially, regions in different countries are going to have an incentive to trade these different varieties. Okay, so that's the basic setup. Now, there are going to be two periods. So the second period, T1, is going to be more or less a standard. So countries are going to receive, each region is going to receive an endowment of all the varieties of the good it produces, and potentially is going to have an incentive to trade these varieties with other regions elsewhere. The part where the paper is more interesting and more novel has to do with what happens in the first period at T0. So each country is going to have to adopt a policy. Okay, and we think of these policies as fairly abstract in the paper, but in principle, it can encompass things like, I don't know, whether you're a democracy or a dictatorship, respect for human rights, whether you care or not about the environment. So you can think of policies along a number of dimensions. Here, I'm just going to think of it as just choosing a number in the circle. And when countries choose a policy, this has those two effects on them. So on the one hand, countries have heterogeneous preferences as a result. So country, say, let me just show you a picture. So in this case, I have country J at 0.5. So it could choose a policy 0.5, and in that sense, we'll be choosing a policy that's as close as possible to its preferences. Alternatively, J 0.5 could choose a policy AJ, for example, at 0.1, so that there will be some cost associated with choosing a policy that's at distance 0.4 from the preferred choice. But why would country 0.5 choose such a policy? Well, because of the second effect. So the second effect is that the gains from trade tend to fall with distance in policy. So, for example, if you have two countries and they're both democracies, everything is equal, they will tend to trade more and gain more from interacting with each other than if one is a democracy and one is an autocracy. Okay? So in this picture, once again, it could be that country 0 being at 0 means being a democracy, being 0.5 means that you're an autocracy. Well, country at 0.5, that would either the country or its government would prefer to be an autocracy, might democratize, at least to some extent, to be closer to country 0 and benefit from trading with it more. Okay, so the whole model is basically is going to reflect this trade-off of trying to choose policies that are aligned with your own idiosyncratic preferences, but on the other hand, trying to choose policies that are close to policies chosen by other countries. Okay. So a bit more formally, so the utility of a resident of a region has two components. So the red component, CIR, is a consumption aggregator that captures all the gains from trade that I described. And the second term is a loss associated with choosing a policy that's different from your preferred policy. Okay, so country I is going to suffer a loss of alpha times the distance between the chosen policy AI and the preferred policy I. Okay, so this. Now, in the paper, you can find all the details, but essentially, once you plug in all the equilibrium in goods trades and as a function of chosen actions, etc., you end up with a consumption aggregation that looks like this equation here. So what you can see is basically each integral. The integral shows you the gains from trade. So when you think about consumption of region I, it reflects gains from trade with associated with consuming with all countries in the circle. That's the first integral. And the factor 1 minus beta times the distance is the factor that determines reflects how the gains from trade are decreasing in the distance between the policies chosen by I and J. Okay, so integrate over all other countries. Once you given your policy and the policies chosen by all the other countries, there are some resulting gains from trade. And those gains from trade are decreases in the distance in action. The third term is a similar term, but reflects gains from trade with the hegemon. Eta is there because this eta is the size of the hegemon. So once again, if you choose an action that's closer to the action chosen by the hegemon, you gain more from trading with the hegemon. Okay. Parametric assumptions. Let me skip this. So the way we solve the model, again, here I'm just going to show you the results in the interest of time. So basically, first we solve the model at time 1, where we show the trade equilibrium given policies, and then we turn to period 0, in which countries strategically choose policies both that reflect these two principles I just discussed. Okay. So I think I can skip this. All this is saying is that the choice of policies is essentially Nash equilibrium in policies, where countries take as given the policies chosen by other countries. So we look for this type of Nash equilibrium. So given the policies chosen by other countries, what's my optimal policy? An equilibrium is one where no country wants to deviate from their profile of policies. Okay. So that's the model in a nutshell. So now I'm going to start showing you some properties of equilibrium of the model. So one thing that we can show, again, all of this is in the so-called unipolar world, where we just have a hegemon at 0. There are only two types of equilibrium that can exist. Okay, so we can have one equilibrium which we call the fragmentation equilibrium, in which every country just chooses an action that's equal to its preferred action. So basically, every single country chooses an action that's equal to its position in the circle. Of course, this leads to low trade volumes, because as a result of these choices, the distance in policies tend to be are as large as they can be. So in this case, a fragmentation equilibrium is an equilibrium characterized both by policy fragmentation, and countries are not aligning with each other, and at the same time, trading goods is going to be lower. On the other hand, we can have a globalization equilibrium in which every country chooses A equals 0. Okay, so the hegemon is at 0, so the hegemon chooses its preferred policies, but every other country in the world chooses to align with the hegemon because it wants to trade more with the hegemon, and in addition with every other country that's already aligned with the hegemon. And in this type of equilibrium, trade is maximized because all the countries in the world choose the same policies. So trade the hegemon, how that affects the extent to which you have equilibrium of one type or the other. When the hegemon is small, you find that under the parametric assumptions I skipped, the only equilibrium is one in which there is fragmentation. And as you start moving from the left to the right, at some point the size of the hegemon is large enough such that you can have a globalization equilibrium, but still the fragmentation equilibrium is still present. And at some point, the hegemon is so large that the only equilibrium that exists is the globalization one. Okay. Let me show some pictures. What these pictures show is the welfare of countries and global welfare, basically integrating over all countries as a function of the size of the hegemon. Okay. So on the left panel, you can see the welfare of two sort of extreme countries. On the one hand, the red line are countries that are very close to the hegemon at 0, and the blue line are countries that are as far as from the hegemon as possible at 0.5. So what you can show is that as eta u increases, we're moving from left to right. At first, the only equilibrium that exists is fragmentation. So the dashed line represents fragmentation. The country that's closest to the hegemon benefits more, even in this, as the hegemon grows, because it's close to it, you can trade a lot with it. The country that's far away trade less with the hegemon, so it doesn't benefit as much. But one of the most interesting results of the paper is what happens once the globalization equilibrium appears. And you can see that the country that's close to the hegemon suddenly benefits. So it's the upward jump from the dashed line to the solid line when the solid line appears. So why does this country benefit? Well, it itself was already aligning with the hegemon. But when you turn to a globalized world, every single country in the world starts aligning with the hegemon. And since this country is next to the hegemon anyways, it's basically the world is aligning with itself as well. So countries around zero benefit a lot from the process of globalization because they're already at their preferred action. And in addition, the rest of the world is moving towards them. So they can trade with everybody. They're very happy. But what's interesting is what happens with countries that are far from the hegemon. Okay, so countries that are far from the hegemon, in fact, actually lose as a result of globalization. Okay, and you might be saying, well, that's strange because nobody is forcing anybody to align. So if they are aligning, it must be because they benefit. And that's true. But in this equilibrium, what a country at 0.5 would be losing is that the rest of the world is suddenly shifting away from itself and towards zero. So basically, if you're a country that have preferences very different from that of the hegemon, as you move towards globalization, all the world is aligning with the hegemon. You yourself do so reluctantly, but conditional on everybody else aligning with the hegemon. It's in your interest to align as well, but you're worse off than you would have been had we all remained in fragmentation. Okay. So we call this like a reluctant alignment in the sense that you align because the world has moved away from you and you are forced to do so. So this is going to be crucial later on. If you look at global welfare, actually increases when you move to globalization. So these losses are more than compensated by the gains from other countries. Okay. Now let's imagine now we have a second hegemon, which, as I mentioned, I'm going to position at I0.5. So this country that here I was referring to that loses as a result of globalization, I'm going to place the second hegemon at that point. I'm going to make the second hegemon as different preferences from the first one as possible. Okay. So we can show is that the set of equilibria doesn't, in principle, change in this case. So you still had either fragmentation or globalization at zero, at the size of the original hegemon, but the behavior of the second hegemon can actually affect whether you have fragmentation or globalization. And the two aspects to consider depend on the following. So on the one hand, does C prefer fragmentation or globalization? Okay, and this is not obvious at first, because even if you look at this previous picture, you see that there are areas, situations where the hegemon is so large that even the country at 0.5 still benefits. So in a world where the original hegemon is very large, or the heterogeneous preferences are not that relevant, the second hegemon also prefers globalization. But it could be that if the preferences are sufficiently heterogeneous, then the second hegemon might actually prefer fragmentation. So this has to do with the preferences. The second point is whether the second hegemon has the ability to affect the equilibrium. Okay, and for this second point, what matters the most is the size of the second hegemon. Okay. Let me skip this. So here I'm going to show you a case where the second hegemon has preferences that are not too different from those of the first hegemon. This is a result of alpha not being particularly large. So this is a case where the second hegemon actually reinforces globalization. Okay, you see how when basically now in the x-axis I have the size of the second hegemon. So we're side of a situation where we have potentially multiple equilibria, but at some point the second hegemon is so large that by moving in advance to zero and align and sort of committing to align with the original hegemon, it can guarantee globalization. Okay, so this is
Fernando, sorry, be close to finish.
Yes. So in this case, actually, the second hegemon reinforces globalization. Okay, and glue. The interesting case is what happens when we have a situation of the second hegemon being what I call the reluctant alignment. So in this case, the second hegemon is actually unhappy about globalization. And at some point, it becomes large enough that it's able to affect the global equilibrium. It shifts away from zero. And as a result of that, the globalization disappears. So this is a situation where the second hegemon eventually, once it becomes large enough, destroys globalization. So there are many things I wanted to talk about regarding the formation of blocks. Let me just show you this interesting picture. So to do this here, we introduced the possibility of having a coercion in the model. I will not explain the details of how we do it, but essentially countries have to choose whether they align with the hegemon or not. If they don't, they cannot trade at all with the hegemon. So here, as the second hegemon increases, we have A to C in the x-axis. I'm showing you in the y-axis the size of the number of the share of countries that align with the hegemon. And essentially, what this shows is if at some point the second hegemon is large enough such that the world would be moving to a fragmented equilibrium, the original hegemon might start using coercion to prevent this from happening. It can succeed at some point. Eventually, A to C is so large that the share of countries that were aligned with the original hegemon is so low that the original hegemon simply stops coercing. Okay, but this is a situation where, as the second hegemon increases, it can actually prompt coercion by the original hegemon, and perhaps this has something to do with the certain things we're observing in the world. But so I told you we had constructed this database. Let me just show you a couple of stylized facts and pictures regarding the treaty. So what I'm showing you here is the number, just the raw number of treaties signed per year over the last 200 years. What I want to show you here is that during the last few years, the number of treaties has essentially halved. We have only seen this in relative terms twice in the past, and that was associated with the 2 world wars. So there is nowadays a sudden, very large reduction in treaty signing, and it's almost unprecedented, totally unprecedented since the Second World War. And this is just show you how a treaty signing can reflect a so-called alignment. So here what I'm showing you is for each country, it's painted yellow if it signs more treaties with the UK, and blue if it signs more treaty with the United States. So in the first, you can see between 1870 and 1879, most countries were signing more treaties with the UK than the United States. The beginning of the 20th century, Latin America shifted and started realigning with the US, and this is reflected in the treaties. This is regarding the US versus Soviet Union, and in the 50s, there were many countries that were aligning more with the Soviet Union. By the 80s, most of those countries had shifted and started aligning with the United States. And this is today. In the 90s, most countries were signing more treaties with the United States. And if you look at the last 10, 15 years, you see that the number of countries that's signing more treaties with China than with the United States is enormous. All of big chunk of Africa, big part of Latin America, all of Asia. Okay, suggesting that big part of the world seems to be shifting and moving its alignment from the US or the West more broadly towards China. Okay, so we have some regressions which we will skip. So let me just finish with the conclusions. So I have shown you that hegemons can prompt convergence and alignment in the policies, and as a result, facilitate globalization, but not everybody wins. Basically, globalization can actually hurt some countries, particularly those that are that have very different preferences. And then the general question that arises is whether China has reached critical size. So in our model, if China was such a reluctant alignment, was so reluctant to align with the West, it did so for a while. but now if it has reached critical size, maybe it's starting to move away from the West, and by doing so, it's carrying with it several other countries that, with a smaller China, would not have been so willing to stop aligning with the West. Perhaps you have some neighbors close by that feel that way. And then as China starts moving away from the West, it's carrying with it several other countries. This is also related with some empirical evidence on trade, how it's becoming more segmented into blocks. But again, this is we can talk more about this later on if you're interested. Okay, so I think I'm a bit over time. Sorry. Look forward to the comments of Anastasia.
Okay, thank you, Fernando. Thank you. Your applause. Now I would like to invite Anastasia Antonova, ex-Marseille School of Economics.
Yep, can you hear me?
Yes.
Okay, great. Okay, so thanks a lot for inviting me to discuss this very nice paper. So I'm gonna briefly go through my understanding of the paper and then go to the comments. So the context for this paper is the threat to US hegemony, because we know that at least since the Second World War, US has been recognized as this global hegemon, and then after the collapse of the Soviet Union, it has become this sole superpower in the world. And at the same time, we have had 2 waves of globalization during this time. And the last wave of globalization, it has ended with great financial crisis. At least some researchers think that this was the case. And then more recently, we have these 2 trends. So first is the rise of China. China has become a large economic power, and the question is whether it threatens the US hegemonic position. And the second trend is the end of globalization. So globalization has stalled, and recently there has been this increased risk of trade fragmentation. So this is the context. And then we see that there is this correlation, apparent correlation between the existence of a hegemon and international trade. And kind of then the natural question arises, how does this hegemon, how does it shape the international trade? And interestingly enough, the economic literature doesn't give an answer to this question. So there is some literature on political science, but in that literature, there is no formal analysis of this issue. And then this paper comes along. And I think that this paper makes 2 very important contributions. So first, this paper provides this framework for formally analyzing the link between globalization and hegemony. And the second contribution is this novel historical measure of political alignment across country. And since this measure goes way back into history, it really allows to test throughout history how political alignment shapes trade. And the key message, the key result of this paper is that hegemony fosters international trade, but not only with hegemon himself, but also across the allies of this hegemon. And the mechanism is kind of very intuitive if you think about it. So basically, the idea is that gains from trade with a large bloc, they outweigh the benefits of satisfying local political preference. And countries are willing to give up their political preference to align with this big trading bloc. So my overall assessment of this paper, that this paper addresses a fundamental yet timely question. It provides a comprehensive analysis, both theory and empirics, and also it's a very interesting paper to read. I recommend to everybody. So my comments will be not a critique of the paper, because the paper is great, but mostly I would like to talk about certain assumptions of the model and like what do they mean? What do those assumptions mean in the real world? So before going to my comment, let me kind of give you my overview of what's going on in this model. Of course, I dramatically simplified things here, so I apologize to the authors. But basically, the idea of this model that there are a lot of countries in the world, and each country chooses an action to minimize some loss function. Here, I've written a bit in terms of the loss function. Again, forgive me if it's not 100% mathematically rigorous, but basically, there is a loss function for each country, and this loss function, it consists of three parts. So first, there is a loss from being not aligned with your own political preference. And the strength of this loss is regulated by this parameter alpha. Then there is a loss of being non-aligned with other small economies in this world. And finally, third part of this loss function is the loss from being non-aligned with a hegemon. And then this paper uses this very neat trick. It locates all the countries on a circle. And I made an attempt to draw this circle as well. And kind of an idea that if you take a country on a circle and move its action from its own political preferences towards a hegemon, here on this figure it's a country I that moves its action, then there are two groups of countries. So first group is the country to which the country I becomes closer in terms of alignment, and this reduces the welfare loss. And on the other hand, there is a group of countries and own political preference, and from this point the country I becomes further away, and this increases the welfare loss. And this is kind of the trade-off that is present in within this model. And then my comment will be about this assumption about strong own political preference, because what authors of this paper assume, they assume that this parameter that regulates the loss from deviating from own preference is very large. So it is larger than the parameters that regulate the loss due to deviation from other countries' actions. And this assumption is very important. So to my view, this assumption, it kind of ensures the unique equilibrium with fragmentation in the absence of a hegemon. And I draw a simple example here. So basically, imagine that we had an economy with this large hegemon, and everybody was aligned with this hegemon. And then imagine that you kind of remove this hegemon. And then what happens when you remove this hegemon? It depends on how strong your own political preferences are. So if your political preferences are not strong, then what happens is that basically, even if you remove the hegemon, everybody stays aligned with each other. Nobody wants to move. And then this means that equilibrium after the hegemon, it is determined by where on the circle the hegemon was before. But what happens if you have strong political preferences? Under strong political preferences, if you remove a hegemon, everybody returns to their own political preference, and this world becomes a fragmented space. And kind of this assumption, it ensures that you have a unique equilibrium without a hegemon. But then what are the implications of this assumption? And one implication, I think, it's about kind of what does it mean for the size of the hegemon? Because I think this result was in the previous version of the paper, but it still holds for the two hegemon economy in the recent version. So basically, the result is that to have a unique globalization equilibrium, you need to have the hegemon size larger than alpha divided by beta t. Alpha divided by beta t is larger than 1 because of this assumption that I've just discussed. And what is 1 in this model? So 1 in this model is the size of the rest of the world. So it seems that in order to have this unique globalization equilibrium with hegemon, the hegemon should be like super large. It should be like 50% of GDP, of the world GDP, or larger. And the question is whether some hegemon in history was that large. Because even if you take the US in the 60s, it was like 40%, but never 50%. And also, this paper has another result for two hegemons. And when you have two hegemons, you would have unique globalization equilibrium when the total size of the two hegemons is basically larger than 1. And then if we take US plus China now, their total GDP still seems to be kind of smaller than 50% of the world. So that their total size is not large enough to pin down this unique global equilibrium. So maybe the equilibrium was unique when you had this US plus Soviet Union. This could be checked, of course. And then kind of to summarize these two comments, so basically the uniqueness of equilibrium is not that easy to obtain in this model. So because if you have strong political preferences, it's very difficult to have this large hegemon to achieve this unique equilibrium. And if you have weak political preference, then even if you remove a hegemon, it's still not guaranteed that your equilibrium is unique. So what does it mean? This means that basically indeterminacy is kind of a feature of our world, at least according to this model. And then what does indeterminacy mean in practice? Why do we observe in reality one equilibrium and not the other equilibrium? And one thought I had in mind is that maybe the real world equilibrium selection mechanism is through historical dependence, which you kind of don't have in the model, if I understand correctly, but in the real world you might have it. So kind of to give you quickly the idea what exactly I have in mind, imagine the two situations. So first situation is like a falling hegemon, and the second situation is a rising hegemon. So if we have this falling hegemon situation, so we had before we had this large hegemon, everybody was aligned with this large hegemon, and then this hegemon starts to shrink. But even though this hegemon is kind of not that large anymore, everybody chooses to stay aligned with each other because this is a large block. So this is the falling hegemon. But if you have the rising hegemon, on the contrary, you start with a situation with very small hegemon or no hegemon at all, and then this hegemon starts to grow, but it's still not large enough to align everybody around it. And then two circles in the bottom of this figure. So these are two equilibrium outcome for the same size of the hegemon, the same number of small economies. So you have this multiple equilibria, and kind of the selection might be through historical dependence. And kind of the testable implication for this behavior could be to look for a given size of hegemon in the data. Do you observe more trade alignment when the hegemon is falling, or more trade alignment when the hegemon is rising? And I think I will stop here for the interest of time. It's a very interesting paper. Thanks a lot to everybody.
Thank you, Anastasia. Thank you. It was very interesting. Fernando, would you like to comment?
Yes, thanks a lot, Anastasia, for all the great comments. Let me try to answer them as well as I can. So regarding this assumption that we make, alpha bigger than beta t. Now, this is an assumption that we make because as you imagine, these types of models with strategic complementarities tend to have potentially lots of equilibria. So one possibility is basically as you reduce alpha, you tend to have more multiplicity of equilibria. So at some point, to keep the analysis interesting, we decided to stick to parameter values where there is still potentially multiplicity, but the model is more tractable. So it has more interesting predictions. But it is true that if you could solve the model without that parameter restriction, you just have other types of equilibria. Things would be less clear cut. Now, this is not a quantitative model, but if you want to literally take literally the potentially quantitative implications of the model, now perhaps one can think of not only about the US, but also the US plus the rest of the West as being countries that are sort of a coalition of tradition of countries that have similar preferences. Once you do that, you can think of these countries as being potentially large enough. But again, we don't try to take these quantitative implications too seriously. This is more a model to try to think about the mechanisms. It's too stylized to take it to the data, potentially. Regarding the equilibrium selection, This is a static model, and these types of static models, you tend to have multiple equilibria. So what we do in the paper is we do discuss all the equilibria, but in some parts of the paper, when we try to think about particular examples, we do carry out some equilibrium selections that are very much in line with your suggestion. So, for example, in the part where we study coercion under with two hegemons, we choose the equilibria where the most countries align with the original hegemon. In the background, thinking that we are in a world where the original hegemon was dominant and you have the second hegemon that's increasing. So, but there is hysteresis in the sense that if an equilibrium was unique, even if another equilibrium appears, you still keep playing the originally unique equilibrium. So, but again, to do justice to this type of ideas, you need a more dynamic model where you'd have some state variables, perhaps technology, capital, and in those types of models, the multiple equilibria transform into hysteresis and path dependence and things that are potentially closer to the intuition that you have in mind, with which I totally agree. Okay, but thanks a lot.
Okay, thank you. Thank you, Fernando. Thank you, Anastasia. I would like to say that such comprehensive discussion do not require the questions because it's require reflection. So thank you for our discussants, thank you for our panelists, and I would like to invite Sergei Nikolaichuk, Deputy Governor of National Bank of Ukraine.
Dear colleagues, guests, and participants of our conference, both those present here and survived by the end of these 2 intensive days, and those joining us online. It is a great honor for me to deliver closing remarks of the annual research conference, Economic and Financial Integration in a Stormy and Fragmenting World, which the National Bank of Ukraine, together with Narodowy Bank Polski, has held for the 9th time. Over the course of 2 intensive days, Kyiv has become a hub for profound discussions and fresh ideas. The conference has served as a space for conversations not only about the turbulence of the global order, but also about the pathways to the new equilibrium. These were substantive, thoughtful, and practical discussions. And most importantly, we were once again reminded, in times of fragmentation and geopolitical instability, integration is not only desirable, but essential. Integration of perspectives, experience, academic approaches, and undoubtedly regional integration as a development strategy for Europe. But integration is also about culture. Even if we have different historical backgrounds, speak different languages, and face unique challenges, we are united by common European values: democracy, dignity, freedom, and responsibility. During the conference, we referred to French philosophers who laid the intellectual foundations for the united Europe, and to Ukrainian poetry that deeply resonates with the present. This, too, is a form of integration at the level of identities, meanings, and spirit. This year, I particularly wanted to emphasize the quality and focus of discussions. The conference has evolved into a platform for discussing concrete actions and next steps in Ukraine's European integration journey and in strengthening the resilience of the European Union itself, 2 directions that are closely interconnected. As ECB President Christine Lagarde noted, one of the key benefits of regional integration is the strengthening of collective resilience. And today we speak about the Ukraine-EU partnership not only in economic and political terms, but also in the realm of defense. In a world where security and the economy are inseparated, this is a fundamental shift. As the NBU Governor Andrei Pyshny aptly remarked, then commenting on defense and geopolitics, security and risks, central bankers shape the preconditions under which their mandates are fulfilled. This resonated well with President Lagarde's words that central bankers have to look out the window. And likewise with the words of Andrew Bailey, Governor of the Bank of England, who rightly pointed out that central banks are independent from governments within the bounds of the law, but not from the citizens they serve. In addition, President Lagarde rightly emphasized that the benefits of integration require systemic structural reforms, prudent macroeconomic management, and broad public support. Communication by central banks that is aimed at society as a whole is also of vital importance, and we understand this well. These challenges raise questions about the pace and depth of institutional change. The National Bank of Ukraine is actively contributing to the development of the new institutional architecture of Ukraine's path to EU membership, and contributed to the Ukraine's negotiating positions on clusters 1, 2, and 6, which have been approved and sent to our European counterparts. And it's hard not to agree with Ukraine's Vice Prime Minister, Olga Stefanishyna. If Ukraine fulfills its technical conditions swiftly and efficiently, then the opening of negotiation clusters is merely a technical decision, while any failure to open them is a political one. And we expect political honesty in this process. At the same time, we must remain realistic. It was repeatedly stated during the conference, accession to the EU is a complex process. It is a marathon, a journey without a fixed finish line. As Bank of Lithuania Governor Gediminas Šimkus aptly noted, integration is a journey, not a destination. And as chairman of Kenneth, Jacek Jastrzębski added, it is a path where a country moves along a narrow corridor, remaining true to the principles of the strong state and active civil society. Among the topics discussed were the need for a capital markets union, building a single market, and strengthening the defense industrial ecosystem. And everywhere, the key word was integration. We also discussed unity in sanctions policy, frozen Russian assets, and the need for an effective legal mechanism to use them in the interests of Ukraine's recovery. This is not only a matter of justice, it is a matter of trust in the international order. I would like to particularly highlight the strong role of conference as a platform for the academic and research community. The second day brought together leading scholars from around the world. We heard new approaches to assessing integration and examined the economics of fragmentation from a different perspective. Professor Kenneth Rogoff of Harvard University, in his speech, "Will the dollar's loss be euro's gain?" raised questions of profound relevance to our time. I sincerely thank him for his insightful analysis. The dominant role of the dollar has been gradually weakening since 2015, and these trends become especially pronounced this year. Alongside this, we observe a reassessment of the role of the major global currencies, international reserves, and settlements. In the opinion of Professor Rogoff, the world is moving increasingly toward deglobalization and fragmentation, and therefore the scenario of several competing reserve currencies is already becoming a reality. And his reverences to President Lagarde, who had previously indicated that the global role of the euro would be strengthened, looked intriguing. These 2 days were more than just discussions. We heard many expressions of support from international partners, acknowledgements of our progress, and clearly outlined future priorities. Ukraine will not stop. Our path is difficult, but we accept the challenge. And we are grateful for the support and trust. Throughout the conference, one shared thought was heard repeatedly. Ukraine is not just a country that needs support, but one that is capable of shaping Europe's future. As ECB President Christine Lagarde and NBU Governor Andrei Pyshny rightly emphasized, Ukraine is not a victim and not merely a recipient of aid, but a future driver of regional integration and European resilience. In conclusion, allow me to thank our partners, the GIZ and the IMF, and of course our co-organizer, Narodowy Bank Polski. I extend my sincere gratitude to all distinguished guests and international experts who came to Kyiv, as well as those who joined online. Thank you for the intense, deep, and open discussions. Special thank goes to the NBU team for the excellent organization, for making this dialogue possible, for your professionalism. I would also like to acknowledge the members of our academic committee, especially Yuri Gorodnichenko and Alexei Krivtsov, who for the 9th time have contributed significantly to organizing this exceptional event for Ukraine. And last but not least, I thank the defenders of Ukraine who every second hold back the aggressor, defending not only Ukraine, but all of Europe, for the sake of our common, peaceful, and just future. Thanks to them, we are able to host such conference here in Kyiv, at the NBU venue, and in Kyiv, a city that, despite the war, continues to be a heart of reform, integration, and hope. I sincerely believe that in a year we will meet here again, and that this meeting will take place under conditions of a just and lasting peace. Thank you very much.